Yes everyone, so hello, hi, namaskaram my dear warriors. I hope you guys are doing really well. So welcome you guys to another amazing revision series. This revision series is going to be on the chapter Security Valuation. This is going to be relevant for CA final students as well as for your CMA final students. So simple ground rules. This is going to be a quick revision, quick marathon for your reference. Now exams are very close, so I am not going to make it a very detailed discussion. But still, you guys know my style of teaching. My style of teaching is to ensure that you guys understand the entire subject without having the need to by heart even a single formula. So even in this session, I will try my maximum to ensure that I don't give out any formula telling that you by heart this formula. We will understand it logically. We will give ourselves frameworks. Okay, point number one. Point number two, whatever notes we have used, I'll be uploading on my Telegram channel Think with Tabish, so you guys can go there, get access of the files. So without any delay, let us start with the chapter. So this entire chapter of security valuation, I have bifurcated into two main parts. Part 1 is equity valuation, part 2 is bond or debt valuation. So let us start with the first part, which is going to be equity valuation. Yes everyone, so first let us start with the name. Every name has a story to tell. Security valuation. Security valuation, two terms are there. First is security, next is valuation. First, what is a security? Security includes so many things. In that, equity shares will be there, bonds will be there, debentures will be there, etc, etc, etc. It is defined in Companies Act. For us, not a big deal. For us, equity shares, bonds, debentures, etc. Yes, the most important part, the most beautiful part is valuation. Yes, what on earth is valuation, sir? Sir, what is valuation? Sir, valuation means valuation, sir. That's what is valuation? Yes, a name, a term is telling you a complete story. Once you've understood the term valuation, this entire chapter will make sense. What is valuation? Yes, I've first given you guys the definition, then we'll understand this. Yes, value of an asset is the present value of future cash flows discounted at required rate. Sir, we've all heard this, but I'll give you guys a perspective into what exactly is valuation. Understand, my dear students. Quickly, I'm going to explain to you guys. Pay attention, beautiful. Now, what is the difference between price and value? Sir, price is price, sir. Value is value, sir. Let us try understand. Price, yes, how much amount I'm actually paying, that is the price. So then what is value? How much benefit I am getting, that is the value. To give you guys a very simple example. Imagine you and 5 of your friends went to a restaurant, properly had food, majja food, everything crazy food you had. Yes, veg, non-veg, sweets, desserts, juice, everything you had. Your tummy is full, you guys are happy, you had a great conversation. Okay, you're very happy. Yes, in your mind, you think that, okay, you had crazy amount of food. The bill will come to 4,000 rupees is what you are thinking. Yes, in reality, the bill comes. The bill is 2,500 only. Happy or sad? Happy or sad? Sir, very happy, sir. Yes. With this example, let us try understanding. Yes, what is the price that you have actually paid? What is the price that you have actually paid? Sir, 2,500 we have paid. That is the price. How much amount I am actually paying? That is the price. How much benefit you have got? Yes, in your mind, how much benefit you got? You had great food, great ambience, great conversation. In your mind, you are thinking that 4,000 rupees benefit I got. That is the value. So value means how much benefit I am getting. Is this clear, everyone? So a simple point, yes, how much benefit I am getting, that is a value. So ideally, how much benefit I am getting, that much I am willing to pay. Suppose I am telling in my mind, 4,000 rupee benefit I got. That means 4,000 I am willing to pay. Even if they ask me 4,000, I am willing to pay that. But they have asked how much only? 2,500 only. Good or bad? Good. Happy or sad? Happy. That is what the entire chapter is all about. So in this chapter, what we are going to do, once you've understood valuation, so many chapters will fall in place. Your security valuation will fall in place. Business valuation will fall in place. In derivatives, forex, at different places, valuation will keep coming. Every time you have to understand what is value. How much benefit I am getting in very simple layman terms. Is this clear, everyone? Okay, fine. So now understand the decision making framework. How are we going to buy securities? Should I buy a security or not? How do I take the decision? Very simple. Suppose I am telling I am having so much money with me. Okay, so what all options are there? Yes, I want to buy some securities. Either I can buy a Reliance share, which is currently trading at 2,000 rupees. Just because it is trading at 2,000 rupees, should I go and buy? No, boss. Wait. First understand the value. 2000 is a price. First understand the value. Suppose there is a government of India bond which is trading at 10,000 rupees. Should I go and buy? No, wait, understand the value. Yes, there's a building. They're telling, okay, you get it at 1.5 crore, you'll keep getting rental. Should I go and buy? No, understand the value. Yes, there's a business that we are planning to start, secret business. Some secret business we are planning to start. 1 crore is investment. Should I straight away start? No, first understand the value. So, yes, what is the decision making framework? First, I will understand the value of the asset, how much benefit I am getting from that. Okay, step number 1. Step number 2, I will compare it with the price, how much price they are quoting. Using that, I will be taking a decision. Value is greater than price means, okay, good business, I will accept. Is this clear, everyone? Our first example, 4,000 rupees value we got by eating the food, but the price was 2,500 only. Happy or sad? Happy. So should I accept? Yes, I should be accept. Is this clear, everyone? From this, let us try slowly getting into each of these things. Pay attention, everyone. Yes, tell me what is value. Value means how much benefit I am getting. How much benefit I am getting. Okay. First, suppose Reliance share is there. A share is there. Tell me, today I purchased a share. How much benefit I will be getting from a share? What all I will be getting from a share? Sir, 2 things I will be getting from a share, sir. Sir, today I purchased the share. In future, what all I will get? Sir, I will get dividends periodically. Point number 1. Then, sir, when I am selling, I will be getting sale price. So, 2 things I will be getting from a share. 2 benefits. What all benefit I will be getting from a share? Dividend also I will be getting. Sale price also I will be getting. Yes or no, everyone? Simple. Suppose I am telling I purchased the Reliance share. First year I am getting 10 rupee dividend. Second year 10 rupee. Third year, 4th year, 5th year. 5 years I am holding. Every year 10 rupee dividend I am getting. At the end of it, sale price of 3,000 I am getting. So, total how much benefit I am getting? Sir, 10, 10, 10, 10, 10. 50 rupees plus 3,000. It makes it 3,050 rupees. Perfect, everyone. Yes or no? Yes or no? Yes or no? Give me a confirmation, everyone. No. Sir, why, sir? What is this, sir? Time value of money comes into picture. Yes, it is a revision. I am not going into much detail. So, first year 10 rupees I am receiving and 50 year 10 rupees I am receiving. Is it having same value? No, boss. That means what I have to do? I have to bring all the values to present value terms. Is this clear, everyone? So tell me, in case of share, what all I will get? Sir, I will be getting dividend also, sale price also. I will keep getting a different point. So what is the value? It is the present value of the future dividend and sale price discounted at the required rate. Yes or no, everyone? So what is the value of a share? It is a present value of future cash flows. In case of a share, I will be getting my dividend as well as sale price discounted at the required rate. Is this clear, everyone? Perfect, sir. Now assume a second situation. I am telling, yes, what if I purchase a GOI, Government of India bond? It is trading at 10,000 rupees. Tell me, if I purchase a bond, what all benefit I will get? Sir, firstly, interest I will keep getting, sir. Bond, sir, it is. Okay. At the end of it, whenever I am selling, redemption price or sale price I will be getting. Yes or no? So, 2 benefits I will be getting. One is the interest, one is the redemption price. Yes. Am I getting every amount in the same period? No, sir. Different period I will be getting. Assume first year 1,000 rupee interest, second year 1,000 rupee interest, third year 1,000 rupee interest, and at the end of it 10,000 redemption value. Yes. This is the benefit I am getting. Can I add all of it? No, sir. Why da? Sir, different period na, sir. Then how? What should I do, sir? Bring all of them to present value. So, value of a bond, it is the present value of future cash flows. When I am talking of a bond, what all future cash flows I will be getting? Interest plus redemption value discounted at the required rate. Is this clear, everyone? Yes. Suppose I am telling, I don't want all this nonsense. I will go purchase a building, 1.5 crore building I will buy. Maja will come. Sir, what will you do with the building, sir? Yes, I will give it out for rent. So, tell me. Yes, if I purchase a building, I give it out for rent. What all benefit I will be getting? Sir, firstly, periodically rental income I will be getting. Yes, sir. Now, at the end of the life, whenever you decide you want to sell the building, you will be in a position to sell the building as well. That means 2 cash flow I will be getting, rent as well as sale value. Yes or no, everyone? So, assume first year I am getting 5 lakh rent, second year 5 lakh rent, third year 5 lakh rent. At the end of it, I sell the entire building at 2 crore rupees. So, tell me, what is the value of a building? What is the value of a building? Yes, these cash flows I am getting. Can I directly add? No, sir. Why is that? Different time period, sir. That means it is going to be present value of future cash flow. In case of a building, future cash flow includes rent also, sale price also, discounted at the required rate. Is this clear everyone? Perfect. Now next case, suppose I started a secret business. Sir, what secret business? Majak business. Crazy. No, top secret, don't tell anyone. No maja, only in teaching. I decided, okay, we'll start a secret business. Okay, so what is the benefit I'll be getting by carrying out the business? Yes, I'll be getting sales, from that I'll be paying cost also. Yes, ultimately I will be arriving at my cash flow after tax. That is a net cash that I can take and go back home. Yes or no everyone? In business valuation chapter you will be learning this under the terms free cash flow to firm as well as free cash flow to equity. Yes or no everyone? So suppose I am telling randomly, yes, every year 20 lakh rupees cash I am getting. This is the benefit I am getting. So what is the value of the business? It is the present value of future cash flows discounted at required rate. Is this clear everyone? So I hope, yes, this line is clear for you guys. Throughout the entire world of finance, everywhere we are not focusing on price, we are focusing on value. What is value, students? It is the benefit I am getting. So what is the definition of value? Value of any asset in the world. Yes, it is the benefit that I am getting. It is the present value of future cash flow. If I buy the asset, in future what all cash flows I will get? Yes, I will bring the present value. At which rate I will discounted at required rate. Is this clear everyone? Now recently IPL is going on. Yes, so some time back, yes, Star or Jio, I am not very sure, had purchased the rights of IPL for some 3,000 crore or something. On what basis they would have taken? First they would have tried understanding the value of the right. Okay, if I purchase this right, how much benefit I will get? Yes, broadcasting income I will be getting, advertisement income I will be getting, what all I will be getting every year. So yes, cash flows, discount at required rate. You will arrive at the value, compare with the price, accordingly you take a decision. Any financing decision, valuation is what we are doing. Is this clear everyone? Yes, I've spent some time, but I hope the term, the beautiful term value is clear for you guys. Give me a confirmation, accordingly we'll continue, proceed further students. Yes everyone, so now look at this, look at the notes, beautiful notes we have prepared, pay attention everyone. Yes, value of an asset. So what is value of an asset? Yes, value of an asset is present value of future cash flows discounted at required rate of return. Different names are there for this. It is called as value of an asset. It is called as the fair value. Ideally, how much I should be paying? Fair value, fair price. It is also called as intrinsic value. It is also called as theoretical market price. Any names you get, you understand it is nothing but value of an asset. Okay, value versus price I have explained. Yes, value means how much benefit I am getting, price means how much price I am actually paying. Yes, value is dependent on three things. Yes, firstly future cash flows, how much cash I am getting in the future. Next is the required rate of return, in which rate I have to discount. Third is going to be the holding period, for how much period I am planning to hold the asset. Yes, on what basis price I will be getting. Suppose Reliance share, what is the price? I will go to market and see. Yes or no everyone? Yes, perfect. It is on what factors it is dependent? Based on demand and supply. Yes or no everyone? Okay, fine. Price is generally same for the entire market. Yes, but value is different for every person. Every person will have different expectation. One person is telling I'll hold for 10 years. One person is telling I'll hold for 2 years only. One person is telling I want 20%. One person is telling I want 10% only. Accordingly, value is going to be different for different people. Is this clear everyone? Now, value of different assets. In one single stretch, we'll understand value of all the assets. Pay attention. Value of a share. Tell me students, value of any asset. It is the present value of future cash flows discounted at required rate. Value of a share. If I buy a share, what future cash flow I will get? Dividend as well as sale price. Yes, discounted at, yes, equity. What is going to be the required rate of equity? Yes, cost of equity, KE. Basics of FM. Yes or no everyone? Bond or debenture, what all I will be getting? Interest as well as redemption price. At what rate I will be discounting? Yes, bond it is, debt it is, KD. Yes or no everyone? Yes, suppose real estate investment, what all I will be getting? Yes, rental income as well as sale price at the end of it. At which rate I will be discounting? Now normally, yes, if any business or any person is investing into a rental property, normally it will be a mix of equity as well as debt both. That is why I have taken KO. Alternatively, it can be KE also, KD also. Okay everyone. Value of a business. Yes, it is a value of future cash flows that I am going to get from a business. Yes, I have to discount, yes, at the required rate. Normally it is going to be KO, overall cost of capital. This is generic case. It can be KE also, KD also, KO also. In a real life practical scenarios, here it will be KO only. Is this clear everyone? Okay, perfect. Now next, decision making. How do we take a decision? Yes, if a value is greater than price. Suppose Reliance Limited share is there. Yes, the value, the benefit that I am getting from a share is 4,000 rupees, but price is 2,000 only. Good or bad? Good sir. Happy or sad? Happy sir. Value is greater than the price. That means the asset is underpriced. So should we buy? Yes boss, we should buy the asset. Sir, if you have already purchased means hold on to the asset. It is a good asset. Is this clear everyone? Yes, if value is equal to price, suppose Reliance Limited share is there. It is giving me a benefit of 2,000 rupees. I go in the market and check how much is the price. Price is also 2,000 only da. Yes. So that means tell me how much is the price I am paying 2,000. How much benefit I am getting? 2,000 benefit I am getting. Is it good? Yes, it is good. Is it giving me extra benefit? No. But how much benefit I want, that it is giving. Yes or no everyone? So the asset is going to be correctly priced. Still it is recommended to buy the asset, since it is giving me the required return. Yes or no everyone? But if the value is less than price, suppose price is 2,000 rupees, but I estimate future cash flow, I discount it. Yes, I am getting a benefit of 1,500 only. That means tell me, is it good? Not good. That means the asset is overpriced. That means I will not be buying the asset. If I have already purchased the asset, in that case I will be selling the asset. Is this clear everyone? Perfect. Next is the relationship between discount rate and value of an asset. Throughout entire AFM we will keep using. Yes, there is an inverse relationship between the discount rate and value of an asset. That is, if my discounting rate increases, now value of asset decreases. Discounting rate decreases, now value of asset increases. Yes. Now understand students, value of an asset, it is the present value of future cash flows which I am discounting at the required rate. Yes or no everyone? Yes, the very fact that I am discounting, yes, I am eliminating the interest. So more is the required rate, less is going to be the value of asset. Simple example I am giving. Suppose I am telling, yes, I purchased an asset. It is giving me a cash flow of 100 rupees in the first year. Okay. Suppose my required rate is 10%. That is 1 year and I am getting 100 rupees. 10% I have to eliminate. So 100 divided by 1.1, I am getting 90.9. Suppose I am telling my required rate is 11%. That means 100 divided by 1.11. How much is the value? 90.09. So tell me, my required rate increases. Value of asset, what is happening? It is decreasing. Is this clear? Accordingly, if it decreases means value of asset will increase. Is this clear everyone? Basics. But still I am making a point that I explain you guys these things. Till here whether things are fine. Shall we continue further everyone? Yes or no, yes or no, yes or no? Perfect. Now before going further, yes, to valuation of equity, yes, I want to make some things very clear. So what is it sir? Time value of money. Sir, we already know time value of money sir. Why you are spending time? Trust me, if you know time value of money, this chapter is over. Nothing else is there in this chapter. Yes, I know you might be having an idea of time value of money, but from my end, for my satisfaction, 5 minutes, I am not going to take much time, 5 minutes only will spend on time value of money. Trust me, once you are clear with time value of money, everything else will fall in place. That is my guarantee for you guys. Nothing more is there in this chapter. So for my satisfaction, time value of money let us do. Okay, basics of time value of money. Before we get into time value of money, one thing I always teach is cross multiplication. Okay, simple. Suppose 1 kg tomato I am paying 50 rupees. That means for 10 kg tomato, how much I should be paying? Simple sir, for 1 kg tomato 50 means accordingly for 10 kg it is going to be 500 rupees. Just a minute. Yes everyone, so pay attention. Yes, I am going to explain you guys cross multiplication, the most important thing. I teach the entire subject just using cross multiplication. Understand? Yes, 1 kg tomato is 50 rupees. That means 10 kg is how much? Simple answer you also know, 500 rupees. Now I will write it this way. 1 kg is 50 rupees. That means 10 kg is how much? Question mark. Cross multiplication. Yes, the pair which is having a question mark, I will be taking a cross pair. The pair which is having a question mark will be coming in the denominator. That is, I am having 1. Yes, the other pair will be going to the numerator. It is 10 into 50, which is going to be 500. So my answer is going to be 500. Yes or no everyone? Similarly, look at this everyone. For 1 kg tomato I have to pay 50 rupees. Suppose I am having 200 rupees in my pocket. How much kg tomato I will get now? 4 kg tomato. Simple logic sir, we know sir. Okay, now look at this everyone. 1 kg tomato is 50 rupees. Tell me how much money I am having? 200 rupees. That means how much kg tomato I will get? Cross multiplication. I will take the cross pair. Yes, the pair which is having a question mark comes in the division denominator. 50, the other pair goes to the numerator, 200 into 1 is 200. So 200 by 50 is going to be 4, that means it is going to be 4 kg. Is this clear everyone? Yes, basics, 4th standard maths. Entire subject I will just be using this. Now pay attention, pay attention, pay attention. In time value of money, 2 techniques I am having. One is going to be future value, that is compounding, I am going for it. One is going to be discounting, present value, I am coming back. Okay, so simple. Future value means today I am investing some money. Yes, after some point in future I will be getting. Yes, present value discounting means, okay, yes, here, yes, I want some money, here I will be getting money, that means today how much I should be investing. Is this clear everyone? Okay, one very simple example I am telling, with that we are going to create everything. Pay attention everyone. Suppose I invest 1000 rupees in bank today. Interest rate is 10% per annum. Calculate the amount after 2 years. I hope you guys know the basic formulas, but still, okay, 1 minute, how much it will take? Okay, pay attention. I am telling, suppose I invest 1 rupee in bank today. Yes, t is equal to 0, I go to bank, I tell 1 rupee is there boss, how much interest you are giving? They tell me, yes, 10% compound interest I am going to give. That means tell me first year if I am keeping 1 rupee, how much they are giving? 10% of that 0.1. That means at the end of first year, how much it will become? Sir, 1 rupee was there, sir. 0.1 I got, sir. That means 1.1 it became. Now, second year, again 10% I am getting on the 1.1. Yes, so it is going to be 1.1 into 10%, that is 0.11. So at the end of second year, how much value will become? 1.1 plus 0.11, 1.21. Yes or no, everyone? Perfect. Or the same thing I can write. Yes, 1 rupee was there. At the end of it, it becomes into 1.1. Yes, one more year I am going friend, into 1.1. So it becomes 1.21. Yes or no, everyone? Now tell me, 1 rupee if I invest today, at the end of 2 years, it becomes 1.21. Tell me how much amount I invested today? 1000 rupees. That means at the end of 2 years, how much it will become? 1000 into 1.21. It becomes how much? 1221 if I am not wrong. Yes or no? This is the future value. So can I tell future value is equal to present value? 1000 is nothing but the present value. Today how much I put? Into 1.21. How did I get? 1 plus r to the power of n. Yes or no, everyone? Simple, jujube. So future value, I am going front, include interest. So into 1 plus r to the power of n. Is this clear, everyone? Okay, boss. Now comes present value, that is coming back. I am telling, boss, I want 121 rupees after 2 years at 10% interest. That means how much should I be investing today? Simple way for us to do it, just a cross multiplication. Pay attention, everyone. Tell me, if I invest 1 rupee today, at the end of 2 years, how much I will be getting? Sir, 1.21 I will be getting. 1 rupee into 1.1 into 1.1. Yes or no, everyone? So I am telling, if I put 1 rupee today, 2 years end, I will be getting 1.21. Tell me how much money I want at the end of second year. Sir, I want 121 rupees, sir. That means how much I should be investing today? Cross multiplication, it is 121 divided by 1.21. It is going to be how much down? 100 rupees. We are not concerned with the numbers, we are concerned with the feel. Yes, tell me, I got the present value. Present value is equal to, yes, 121, which is the future value. In future, how much I am getting? Bring it back. Yes, divided by 1 plus r to the power of n. Yes or no, everyone? What is happening here? Okay. Hopefully should be fine. Yes or no, everyone? Perfect. Yes. So basics, you've been knowing this. You are at the final level. Foundation you've learned, inter you've learned, final already you've learned. This is the last rapid round. Okay, but still I'm again repeating things. Okay, yes, because the way I tell it for you guys is, yes, every time I am going front, I will tell we are going front. That means I should include interest. That means into 1 plus r to the power of n. Yes, every time I am coming back, yes, I have to eliminate interest. That means I will be doing divided by 1 plus r to the power of n. Is this clear, everyone? Give me a confirmation. Okay, now once this is clear, now understand all the cases of time value of money calculation. Now look at this, students. Majorly 99% of the cases I will have to be calculating present value. That is, I will be coming back. So why, sir, we are calculating present value? Because a decision I will be taking today. That is why all cash flow I will be bringing to present value terms. Okay, so different types of cash flows and how I will be calculating present value. Look at this, students. Cash flows I am bifurcating into two. Yes, either cash flows are for limited period or cash flows are for unlimited period. That is, cash flows are up to perpetuity. Yes, if cash flows are for limited period, again I am treating, what is the problem? Yes, if my cash flows are for limited period, again I am bifurcating further whether they are uneven cash flows, that means every year different cash flows, or even cash flows. Look at this very simple quick 1 minute example, because the entire chapter is revolving around this. Okay, so uneven cash flows. I invest in a project. Okay, required return is 10%. First year it gives me 1000 rupees, second year it gives me 2000, third year it gives me 5000. I have to calculate present value, that means today how much I have to invest. Tell me required rate is 10%. So tell me 1000 I am getting in the first year. Bring it back 1 year. Divided by 1.1. Yes or no, everyone? 2000 I am getting in the second year. Bring it back 2 years. Divided by 1.1 whole square. 5000 I am getting in the third year. Bring it back 3 years. Divided by 1.1 to the power of 3. Yes or no, everyone? So how do will I be writing? Yes, cash flow 1000 divided by 1 plus r to the power 1 plus cash flow 2 divided by 1 plus r whole square, so on and so forth. Yes or no, everyone? In this 1000 divided by 1.1 plus 2000 divided by 1.1 whole square plus 5000 divided by 1.1 to the power of 3. The same thing can also be written in the form of a table. Look at this, everyone. Yes, wherein I will be writing year, cash flow, present value factor, present value. Yes, first year how much cash flow I am getting? 1000. Second year 2000. Third year 5000. Present value factor, this 1 divided by 1.1. I am writing directly in the form of a present value factor. 1 divided by 1.1 is 0.909, 0.826, 0.751. Yes, you will multiply, you will add, you will be getting this value. Is this clear, everyone? Normally we will prefer this way. Is this clear, everyone? Okay, fine. First one is over. Yes, uneven cash flow. Every year different cash flow is there. There is no other option. Individually only I have to pull it back. Individually only I will have to pull it back. Okay, boss. But in case of even cash flow, every year same cash flow I am getting. Now how do I calculate present value? Look at the students. Required rate is 10%. First year I am getting 1000. Second year also I am getting 1000. Third year also I am getting 1000. Now first year I will have to pull it back. Yes, divided by 1.1. Second year I will have to pull it back. 2 years I should be coming back. Yes or no? 1, 2. So divided by 1.1 whole square. Yes, third year also I have to pull it back. How many years I should come back? 1, 2, 3. That means it is going to be divided by 1.1 to the power of 3. Yes or no, everyone? So I can write it as 1000 divided by 1.1. First year I am bringing it back. 1000 divided by 1.1 whole square. Second year also. 1000 divided by 1.1 to the power of 3. Third year also I am bringing it back. Yes or no, everyone? Or if you see everywhere this 1000 is common. So I can take 1000 common into 1 divided by 1.1 here plus 1 divided by 1.1 whole square plus 1 divided by 1.1 to the power of 3. Yes or no, everyone? So this becomes 1000 into 1 divided by 1.1 plus 1 divided by 1.1 whole square plus 1 divided by 1.1 to the power of 3. Yes, this gives me the present value annuity factor for 10% for 3 years. Now how do we calculate this in our calculator? 1 divided by 1.1 equals, I will get for first year, equals I will get for second year, equals I will get for third year. Yes, I will press GT, grand total. I will get the grand total of this. Is this clear, everyone? Yes, so I will be getting 1000 into 2.4865, something 2486. Okay, but I will not be doing it this way. I will be using the table. Now how will I be writing in a table? Yes, I will write in a table. Yes, year 1 to 3. Yes, first year, second year, third year. How much cash flow I am getting? 1000 cash flow I am getting. So what is going to be the present value factor? Yes, I will take my calculator. 1 divided by 1.1 equals. I will press the grand total. I will get some 2.485 something. So 1000 into 2.485, it becomes 2485. Is this clear, everyone? Okay, perfect. Now comes the third example. Beautiful. Pay attention, everyone. I invested in a project. How it is giving me cash flows? First year it is giving me 1000. Second year also 1000. Third year also 1000. Third year, yes, I am taking back my principal, which was 10,000. Now how to do it? Either individually I can discount. Yes or no, everyone? But wait. Understand, this 1000 rupees is same for all the 3 years. So what I will do? I will write year 1 to 3. I am getting 1000 rupees. Yes, present value factor at the rate of 10%. 1 divided by 1.1 equal grand total. I guess you are getting 2.485. This gives me. Now apart from this, third year I am also getting 10,000. So I will tell third year, year 3, 10,000 also I am getting. For that, what is the present value factor? Yes, present value factor of a 10% for 3 year, 0.901, 0.826, 0.751, I guess. Yes, you add, you will be getting this. Is this clear, everyone? Till here, any doubt? Give me a confirmation, everyone. So look at this, look at this. In case of uneven cash flow, every year different cash flow is there. I have no other option. I will discount individually only. But in case of even cash flow, every year same cash flow is there. I will use the present value annuity factor. Is this clear, everyone? Perfect. Now comes if cash flows are there till perpetuity. Perpetual cash flows. Now understand, in case of perpetual cash flows, my principal is never recovered. I will only keep getting the interest payment. Simple example I am telling. Yes, suppose I decide that I am going to stop teaching. Why, sir? No maja only. So what I did, I had a lump sum, 1 crore I earned. This 1 crore I invested in bank. I asked bank person how much return you will give. He told 10% I will give. Yes, suppose I have no plan to withdraw the principal only. I am telling this principal you keep. You only keep giving me interest every year. How much you are giving? 10% you are giving. Yes, calculate his annual income if he withdraws interest every year and doesn't withdraw the principal at all. Tell me, yes, at t is equal to 0. Yes, to the bank person, how much I give? 1 crore I give. First year end, how much money he will be giving? How much interest will be accrued? 1 crore into 10%, 10 lakh will be accrued. Yes or no, everyone? I will tell that income you give it to me. How much he gave me? 10 lakh he gave. 10 lakh was accrued, 10 lakh he gave me. Now, at the end of first year, how much money is there with the bank person? 1 crore only is there. Now, again he will invest for 1 year. How much return he will be generating? 10% of that 10 lakh. He will give me 10 lakh. Third year also he will give 10 lakh. Fourth year also he will give 10 lakh. Up to perpetuity, he will keep giving me 10 lakh, 10 lakh, 10 lakh. Yes or no, everyone? Perfect. Now, I just reverse the story. Pay attention. Yes, I am thinking, I am going to stop teaching. Every year I want 10 lakh rupees income. Every year how much I want? 10 lakh I want. Yes, I ask bank person, if I invest, yes, how much return you will give me? He tell 10% I will give you. That means tell me how much should I be investing so that I get an annual income of 10 lakh till perpetuity. Yes, tell me. Yes, if I invest today, every year, first year how much income I want? 10 lakh. Second year, 10 lakh. Third year, 10 lakh. So it goes on till perpetuity. Yes or no, everyone? Yes. Simple way to calculate it. I know my value is 1 crore, but understand the logic. Simple logic it is. Yes, tell me, if I invest 1 rupee in bank today, how much return they will give me? Sir, they will give me 10% of that, 0.1. Yes or no, everyone? Yes, sir. Tell me how much income I want. Sir, I want an income of 10 lakh. That means how much I should be investing? Cross multiplication. It is 10 lakh divided by 0.1, which is going to be 1 crore. Yes or no, everyone? That is the reason why I told cross multiplication, because this entire chapter, all I am going to do is just cross multiplication. Is this clear, everyone? So if I have to create a formula from this, pay attention, everyone. Yes, the present value of perpetuity. Yes, it is going to be cash flow 1. That is how much income I want. How much income I want every year? 10 lakh I want, divided by, yes, the required rate, 10% divided by the required. So look at this, present value of perpetuity is going to be cash flow 1 divided by the required rate. Till here things are fine, everyone. So look at this present value in different situation. If cash flows are only for limited period, every year different cash flows I am getting. That means what I will be doing, I will have to discount individually only. Yes or no? But every year same cash flow I am getting. I can use PVAF, present value annuity factor. Yes, if cash flows are for unlimited period, perpetuity I am getting. Yes, assume there is no growth. Every year same amount only I am getting. That means how do I calculate? Yes, it is going to be cash flow 1. First year how much money I am getting? Every year same only I will be getting. Yes, I will capitalize it, divided by required rate. Yes or no? But if there is a growth, the formula becomes cash flow 1 divided by required rate minus growth. Sir, how exactly we are getting this? Don't worry, in dividend discount model I will be explaining you guys the logic for this also. Is this clear, everyone? Till here whether things are fine? Give me a confirmation, students. This was our basics, but trust me, if this basics is over now, nothing more is there in this chapter. You will realize that there all that was just a time value of money, and we have covered that beautifully, properly. Nothing more is needed. Giving you guys a minute just to let it sink in, then we'll continue our discussion. Yes, everyone. So now let us try to get into the game actually. Till now we were just playing along with the basics. Now we are actually starting with equity valuation. So unit number 1, yes, valuation of equity shares. So how do we value equity shares? Two main approaches are there. First is dividend based valuation. Second is going to be other methods of valuation. First, let us get into dividend based valuation. Most important thing. In this altogether, four different things are there. First one is if share is held for limited period. Or second situation is if share is held for unlimited period, that is till perpetuity. In that again, if there is no growth, what to do? If there is constant growth, what to do? If there is variable growth, what to do? All these situations we will understand quickly. Yes. First, if the share is held for limited period, let us quickly have a look to get example number 1. Pay attention everyone. Yes, everywhere for every concept I have given you guys example. Once we see the example, the answer will fall in place. Pay attention everyone. Example number 1. Yes, investor intends to purchase a share of Maja Limited. Okay, following data is available. The expected dividend for 5 years is as follows. First year 100, second year 110, 120, 130, 150. Yes, at the end of 5 years, I am planning to sell. Sale price at the end of 5 years is 1200. Okay, great boss. You are required to calculate the following. Value of a share if the required rate of return is 10%. How do we calculate? Yes, the most important thing in security valuation is we have to draw a line. And understand one very important thing, students, line should always be straight. Sir, what you are telling, sir? Yes, trust me, this is your shortcut. Yes, it is not that we don't know how to calculate. It is just that just by reading the question, we won't understand. Most of the times, our mind will not be in a position to link to it. So you just draw a line, you just show 1, 2, 3, 4, 5 every year what you are getting. Aramse you will be in a position to do your calculations. So tell me what all is happening in the question. Tell me, yes, first year how much money I am getting? 100 I am getting. Second year how much I am getting? 110 I am getting. Third year how much I am getting? 120 I am getting. Fourth year how much I am getting? 130 I am getting. Fifth year how much I am getting? Sir, fifth year I am getting a dividend of 150. Apart from that, sale price also I am receiving of 1200. Now tell me, I want to understand the value of a share, that is today. What is the present value of the benefits that I am getting? What I have to do? Sir, chumma discounting we have to do, sir. This 1 year back I have to bring, this 2 year. Accordingly, every cash flow I have to bring it to t is equal to 0. That much only is there, da. Yes or no, everyone? They'll tell, yes, first year 100, second year 110, 120, 130, fifth year it is 150 plus 1200. It is 1350. Yes, write down the present value factors, calculate the present value. You will be getting some 1199 point something. Yes or no? That is the value of the share. Now, is it worth investing in the company if shares are trading in the market at 900? Tell me, students, what is the value of the share? What is the benefit that I am getting from a share? 1200 rupees benefit I am getting. But I go and check in the market. Price is how much only? 900 only. Good or bad? Good. Underpriced it is. So, should I be buying? Yes, boss, I should be buying. Yes or no, everyone? Perfect. Example number 2 also, let me quickly see. Maja Limited just paid a dividend of 10 rupee. Oh, just paid. Today, hot. 10 rupee I paid. So what is this? This is going to be D naught. Yes or no? Today I paid 10 rupees. Okay. Mr. X intends to buy share for a period of 4 years. Investor is there. He is telling for 4 years I want this share, boss. Okay. He expects dividend to increase by 10% every year. Every year how much percent dividend will increase? 10%. And expects a price of 125 at the end of 4th year. He is telling 4th year and 125 could be the price. Yes, risk-free rate is 6%, market return is 12%. Yes, first one, calculate required rate of return. Yes, if beta is 1.5. By now, yes, this is a revision. I hope you guys know calculation of required rate using CAPM. Yes, it is a risk-free rate plus beta into RM minus RF. You do that, you are getting 15%. Is this clear, everyone? Now, how do I calculate the value of the share? Yes, what is the one simple principle I have told you? We should draw a line. Yes, whether you are straight or not doesn't make a difference, but line should always be straight. Sir, what you are telling, sir? Quickly, understand. For how much years I am holding? 4 years I am holding. Tell me, today how much dividend I got? 10 rupees I got. But value of a share is present value of future cash flows. In future, what all I am getting? Tell me every year how much it will increase? 10%. That means tell me first year how much I will get? 10 into 1.1. I guess it is 11 rupees. Where is my calculator? Just a minute, I guess. Let me just get my calculator quickly. Yes, everyone. So look at this. Yes, today 10 rupee was paid. I want a future. So 10 plus 10%. First year it will be 11 plus 10%. It becomes 12.1 plus 10%. it becomes 13.31 plus 10%, it becomes 14.64. And at the end of 4th year, at what price I will be selling? 125. Yes, what is my discounting rate? 15%. So I will calculate the present value of each of these cash flows. I will arrive at the value of the share. Is this clear? Accordingly, I can comment, is it undervalued, overvalued, buy or sell? Is this clear, everyone? Perfect. So understand, if a share is held for a limited period, I am holding. Yes, in that limited period, what all I will be getting? Every year dividend I will be getting. At the end of its sale value I will be getting. What is value of share? Bring it to present value, as simple as that. Yes or no, everyone? Perfect. So it is the present value of future dividend and sale price, as simple as that. Is this clear, everyone? Perfect. Now comes the second situation. If the share is held for unlimited period, that is till perpetuity I am holding. Okay, in that first is a case of no growth. There is absolutely no growth in dividend. To give you guys a very simple example, assume I purchase the share. Yes, that share is telling me that yes, you buy today, every year 10 rupee dividend I will give you. Okay, fine, great. Yes, assume my required rate is 10%. So that means tell me, if I purchase a share today I have purchased. First year how much dividend I will get? 10 rupees. Second year 10 rupee. Third year 10 rupee. Goes on till perpetuity 10 rupee. So tell me, what is my required rate? 10%. That means tell me investment income. If I invest 1 rupees, how much income I want? 10% of that 0.1 I want. Tell me, this share is giving me every year how much income? 10 rupees. That means how much I am willing to invest in this? 10 divided by 0.1, 100 rupees I am willing to invest. Yes or no, everyone? If I have to write it down in the form of a formula, yes, 10, it is nothing but the dividend divided by 10%, it is cost of equity, required rate. Same formula we had discussed there in the basics. Yes or no? I told cash flow 1 divided by required rate. It is value at time is equal to 0. Same thing only I am writing here. Yes, so value of an asset is every year how much dividend I am getting. Capitalize it divided by KE. Yes, everyone. So situation 2, if share is held for unlimited period, there is absolutely no growth. That means I will tell I am going to capitalize the dividend. Every year how much dividend I am getting divided by cost of equity. Is this clear, everyone? Perfect. Yes, now in case of constant growth, every year one constant growth is going to be there. Yes, that is a case of Gordon's growth model. Yes, we all have heard the formula. Yes, value of a share is equal to D1 divided by KE minus G. Yes, wherein D0, yes, it is a dividend just paid by the company today. D1, it is the expected dividend at the end of year 1. Yes, how do I get it? D1, yes, it is a D0. Today how much dividend was paid? Into 1 plus G, how much growth is there? Okay, fine. G is going to be the growth rate. Okay, KE, it is the required rate of return or cost of equity. Yes, V0, it is the value of the share, intrinsic value today. Is this clear, everyone? Yes. Now this is a formula that you guys have all seen. Now let us try understanding the logic. Yes, the way, yes, in the movie MS Dhoni, they say, the man you know, the story you don't. Yes or no? The formula you know, the logic you don't. Okay, even though it is a revision, quickly in the smallest possible time, I will try quickly telling you guys the logic. Okay, pay attention, everyone. So V0, that is how much benefit I am getting today. It is a D1. First year how much dividend I am getting divided by cost of equity minus growth. Okay. Now understand, students, if there is a no growth, what was the formula for value of a share? Yes, it is a D1, that is every year how much I am getting. Simple last example. Yes, every year 10 rupees I am getting. Assume my required rate is 10%. So what I did, 10 divided by 10%. So it is a D1 divided by cost of equity. Till here my formula is there. Yes or no? Yes, D1 divided by cost of equity is there. Why am I doing a minus G, minus growth? Why am I doing? That is the only thing I want to understand. Okay. Now, how do I derive? One, there is a mathematical derivation. You can go into geometric progression, summation of all the terms is A divided by 1 minus, or all those things are there. Nonsense. Who remembers geometric progression? Logically, let us try. Simple logic. Okay, everyone. Perfect. So, logical derivation. Pay attention, students. Today, yes, I purchased shares of Maja Limited. Sir, at what price, sir? Today I purchased share at 100 rupees. Okay, okay. I am thinking I will hold for 1 year only. In 1 year, I am expecting 10 rupee dividend I will get. Okay, okay. Yes, at the end of first year, price will be 105. Okay, okay. Yes, I have to calculate the expected return or the required rate of return. Tell me, students, I invest in a share, 2 returns I will be getting. One, dividend I will be getting. Second, capital appreciation will be there. Yes or no, everyone? Yes, 10 rupees dividend I got and 5 rupees capital appreciation was there. Yes or no, everyone? So look at this. I will tell if I want in the form of a percentage. Yes, I will tell. Yes, what all return I got. Yes, pay attention, students. Yes, 10 rupee dividend I got. On how much investment? Boss, 100 rupees I invested. On that 10 rupees I got. Yes or no, everyone? Yes. Second, capital appreciation. 100 rupees I had invested. Now it became 105. So it becomes P1 minus P0. That is 5 rupees return I got. On how much? On 100 rupees. That means tell me overall how much percent return I got. 10% I got in the form of dividend. 5% I got in the form of capital appreciation. So total I got 15% return. Yes or no, everyone? Perfect. Now the same thing can I write in the form of terminologies? Tell me everyone. Yes, look at this. I have written and kept it already. Yes, cost of equity is expected return, required return is equal to, yes, 10 rupees D1 divided by, yes, P0, that is I have invested P0 100 rupees. Yes or no, everyone? Perfect. Yes, plus capital appreciation P1 minus P0 divided by P0. Yes or no, everyone? Perfect. Till here anything great we have done? Nothing, sir. Jujube only we have done. Okay, perfect. Yes, now understand P1 minus P0 divided by P0, that is my capital appreciation. This only is my growth. Tell me how will, yes, the share value grow? It is because of capital appreciation only it is going to grow. Yes or no, everyone? Yes. How do I be getting share? Yes, growth as a shareholder. Yes, when there is a capital appreciation. Yes, normal dividend return anyways I am getting. How growth will be there? When the capital value increases, accordingly growth will come. Yes or no? So this one only, P1 minus P0 divided by P0, that will be told as growth. Is this clear, everyone? So understand what my formula is going to be. I will tell KE, that is cost of equity, is equal to D1 divided by P0 plus, this is the dividend return, plus the capital appreciation. Capital appreciation I am writing it as growth. Now see how exactly I can play with the formulas. Pay attention, everyone. Yes, plus G is there. I will take it to the other side. Yes, it becomes KE minus G is equal to D1 divided by P0. Yes, I want P0, price in the numerator. I will take it to the other side. It goes this side, P0. Yes, I want this to come here. It will come to the denominator. It is D1 divided by KE minus G. So accordingly, I will be getting the formula. Yes, price of a share is equal to D1 divided by KE minus G. Is this clear, everyone? Yes. So moral of the story or lesson that we have learned is, firstly, logic is clear. Secondly, yes, G, it is nothing but the return from capital appreciation. Is this clear, everyone? Perfect. Now one more way I want to explain this logic for you guys. Pay attention, everyone. Yes, one more way, most logical way for us to understand. Yes, pay attention, everyone. Yes, approach 2. Tell me, students, suppose without growth I am telling. Yes, I want a dividend of 10 rupees every year. Required rate is 10%. Assume there is absolutely no growth. What is the value of a share? I will tell, sir, 10 rupee every year I want. Yes, it is 10%. That means total how much I want? 100 rupees I should be paying. Is this clear? Now comes the second situation. Pay attention. Now this is where the real logic is going to come. Pay attention, everyone. Yes, I want to invest in a share. Okay, boss, I invested in a share. Yes, wherein they are going to give me first year a dividend of 10 rupees. So first year how much they are giving me? 10 rupees dividend they are giving me. Okay. Required rate is how much? Total return I want is 10%. Required rate, total how much return I want? 10%. Yes, in that growth is 4%. So I have to calculate the value of a share. Firstly, let me put the formula and get. Price of a share is D1 divided by KE minus G. Tell me what is D1? 10 divided by KE was 10% minus G is 0.4%. So 10 divided by is 0.06. It comes to 166.66. Yes or no? This we have done just, yes, arithmetically. Now let us try getting the fee. Pay attention, everyone. Total how much return shareholder is requiring. How much return shareholder wants? Boss, total shareholder wants 10%. Return I will be getting in two forms. One is in the form of a dividend. One more is in the form of a capital appreciation. Capital appreciation only is my growth. Tell me how much is my growth, sir? Total 10% I want. In that my growth is going to be 4%. That means, tell me. Total 10% I want. In that 4% is growth. That means from a dividend, how much return I want? Sir, from dividend 6% only is sufficient. Yes or no everyone? Tell me, is this point clear? Yes sir. Total 10% I want. In growth I am getting 4%. That means from dividend 6% is sufficient. Now I will substitute. Tell me students, if I invest in a share, how much dividend I am getting? 10 rupees dividend I am getting. And tell me 10 rupees dividend I am getting. Yes, from a dividend how much percent return I want? Total 10% I want. In that 4% is capital appreciation, the boss. From dividend 6% only is sufficient. So 10 divided by 0.06 is going to be 166.6. This only if I am writing, yes, I will write it as P naught is equal to D1 divided by, how did I get 6%? KE minus G. That is total 10% I want. Now get the feel of KE minus G. Total 10% I want. In that 4% I am getting from capital appreciation. That means net 6% I want from dividends. So it is how much dividend I want divided by how much dividend I am getting divided by from dividend how much percent return I want. Is this clear everyone? I hope the logic, the feel is clear for you guys. So P naught, it is how much dividend I am getting divided by how much percent return I want from my dividend. So how much dividend I am getting, it is a D1 divided by how much percent return I want from dividend, that is KE minus G. Is this clear everyone? Yes or no? Give me a confirmation students. Now if things still here are clear, now let's quickly solve some simple example question. Taka we'll keep solving. Pay attention everyone. Yes, question. Yes, D1 is equal to 10 rupees, KE is equal to 15%, G is equal to 5%. So I have to calculate the value of a share, P naught. Tell me how much dividend I am getting first year, 10%. Tell me total how much return I want, 15%. In that, in the form of growth, how much I am getting, 5%. That means from dividend how much percent I want, 10%. 10 divided by 10% is going to be 100 rupees. Second case, D naught is 10 rupees. Yes, K is 15%. This is G, growth is 5%. So P naught is equal to D1 divided by cost of equity minus G. Yes, D1 is it given? No sir, D naught is given. So it is 10 rupees today. How much growth will be there? Into 1.05 gives me D1 divided by 0.15 minus 0.05. Accordingly, you will be getting the numbers. Numbers I am not doing. Pay attention. Third case, D naught is 10%. Growth is 5%. Calculate KE. If price is 105, tell me P naught is equal to D1 divided by KE minus G. Price is given given sir, 105. D1 is given no sir, but D naught is given 10 rupees. Growth is how much? 5% into 1.05 gives me D1 divided by, do I know cost of equity? No. Do I know growth? Yes sir, 5%, 0.05. Only K is missing. Accordingly, I can calculate. Okay boss. Fourth case, D naught is 10%. K is 15%. Calculate G. Growth is not given. If price is 105. Simple. P naught is equal to D1 divided by cost of equity minus growth. P naught is 105. Tell me whether D1 is directly given. No sir. D naught is given 10. For this, if I add growth, I will be getting D1 divided by cost of equity is how much? 15% minus growth is minus G. So accordingly, you simplify this. This becomes 10 into 1 is 10 plus 10 into G is 10G divided by 0.15 minus G is equal to 105. You simplify, you will be arriving at the value of G. Yes or no everyone? Perfect. Now fifth case, D1 is given 10%, K is given 15%. Calculate G if your price is 105. P naught is equal to D1 divided by cost of equity minus G. This is 105. D1 is already given 10 rupees divided by cost of equity is 0.15 minus G. G is a missing figure. Accordingly, you can keep playing. So every forms of playing, this side, that side, that is given, this is not given, all those things we have quickly seen that. Is this clear everyone? Okay. Now using this, quickly let us do some calculation. Pay attention students. Yes. Example number 5. Dividend just paid by the company is 100 rupees. Just paid. That means what is this? This is D naught. Yes. Growth is expected to be 12% for 3 years and 8% thereafter. Calculate the value of share if cost of equity is 15%. This comes for variable growth. We will do it in 2 to 3 minutes. Now pay attention. Till here we have done. Okay. Now the next thing we are having is variable growth, which is two-stage or multi-stage dividend discount model. Beautiful, maja, important area. This is where most students commit a mistake. Till now at least, yes, you guys will be in a position to by heart and do at least. Yes or no? Yes. D1 divided by K minus G almost everyone knows. But next is where students commit a mistake. So I'm taking just 1 minute of yours to tell you guys one story. Understand students? Yes, our heading is in case of perpetual dividends. Yes or no everyone? Yes, and if you see here everywhere, what we have done, we have only, yes, taken present value of dividends. Yes or no? In case of no growth, I did, yes, sorry, D divided by K. In case of constant growth, I did D1 divided by K minus G. So you should be having a question, sir, why am I only considering dividend, sir? Why sale price is not considered, sir? Whether sale price is not there? Yes, one way of telling it is, yes, that it is perpetual dividend, that means every year dividend only I am getting. But wait, there is a logic behind that. Understand, students. Pay attention, whether dividend is the only cash flow, is there no sale price? No, boss, sale price is there, but sale price is hidden. Understand, it is already adjusted. One simple example I am giving. Yes, D naught is 10 rupees, cost of equity is 15%, growth is 5%. Yes, one way of doing it is, okay, assume there is one investor who is holding this share till perpetuity. What is the value he is willing to pay? P naught is equal to D1 divided by K minus G. Yes, today it is 10 rupees. Yes, growth is 5%. Yes, 10 into 1.05 divided by cost of equity is 0.15 minus 0.05. So can you guys tell me 10 into 1.05 divided by 0.1, it is going to be 105 rupees, yes or no, everyone? Yes, this is one way of doing. Yes, now the second way of doing it is, assume I am the investor. This is the share I am going to purchase. I am telling I don't want to hold it till perpetuity, boss. I am only holding it for 2 years. Give me the value. Yes, now understand. Yes, today what is the growth? 5%. Today already how much dividend was paid? 10 rupees. Yes, that means tell me, yes, value of a share, it is the present value of future benefits. What all I will be getting? First year dividend I will get, second year dividend I will get, at the end of second year price I will be getting. Yes or no, everyone? Perfect. Now tell me, today 10 rupees was paid. If 5% growth is there, first year how much will be the dividend? 10.5. Second year how much will be the dividend plus 5%? 11.025. So first year, second year dividend I got. Now I want the price at the end of second year. I held the share for 2 years. At the end of 2 years I am telling, boss, I am going to sell it. Tell me, students, the very simple fact, price at 0 is equal to D1 divided by KE minus G. That means if I want price today, I want next period dividend divided by KE minus G. Yes or no? That means tell me, if I want P2, second yearly I am standing, I am standing here. I am telling today I want to know the price. Yes, from the perspective of P2, what is the immediately next dividend? Can you guys tell me? It is going to be D3. Yes or no? So what is going to be the value of asset, price of the asset at the end of second year? P2 is equal to D3. Next year how much dividend I am getting? Today I am standing at second year. Next year, that is third year, how much I am getting? Divided by K minus G. Yes or no? So tell me, second year how much dividend I got? 11.025. Tell me how much is the growth? 5% into 1.05 divided by cost of equity 0.15 minus 0.05. So if I do it, 11.025 into 1.05 divided by 0.1, yes, I will get the sale price of 115.7625. Is this clear, everyone? Okay, perfect. Now, yes, the only thing I have to do is bring them to present value. Tell me, first year I am getting 10.5. Second year I am getting 11.025 also. Sale price of 115.7625 also. So I have two cash flow. First year 10.5. Second year dividend is also there. Sale price is also there. Yes, I bring it to present value at 15%. I will get the value of asset as 105. First case also how much I got? 105. Second case also how much I got? 105. So what is the moral of the story? Even if you are holding it for a limited period, yes, the present value of sale price is also already adjusted in this. Is this clear, everyone? Yes or no? Give me a confirmation. Accordingly, we'll take our discussion further. Yes, everyone. So if discussion till here is clear, we'll take our discussion further to point number C, that is in case of variable growth, that is two-stage or multi-stage dividend discount model. Now understand till now what all we have done. Dividend based valuation. If share is held for a limited period, I told what all dividend I am getting as well as sale price, bring it to present value. Yes, share is held for unlimited period, perpetuity. Yes, in case of no growth, it is dividend divided by KE. Constant growth, it is D1 divided by KE minus G. Now comes variable growth. This is where beautiful Maja is going to come into picture. Okay, very simple it is going to be. Yes, just that you have to understand the question. That's all, nothing more is there. 2-3 examples are there. With that, every adjustment will be clear for you guys. Pay attention. Dividend just paid by company is 100. Today, hot, how much we paid? 100 rupees. Growth is expected to be 12% for 3 years and 8% thereafter. After that, it is going to be 8%. Calculate the value of share if cost of equity is 15%. Tell me, students, what is the first thing we should be doing? Sir, line, sir. Line should always be straight, sir. Okay. 0, 1, 2, 3. Tell me, students, today how much dividend company paid? 100 rupees. Yes, first 3 years, how much is a growth? 12% is a growth. So tell me, first year how much it will be paying? 100 plus 12%, 112. Second year how much it will be paying? Plus 12%, 125.44. Third year how much it will be paying? Plus 12%, 140.4928. Okay. Till here there was a variable growth, different growth rate was there. Now at the end of third year, what is question telling is, after third year, every year there will be 8% yes growth only. That means tell me students, assume I am standing here in third year. I am seeing front, I am seeing future from there. Tell me third year how much dividend I paid? Sir, 140.4928 I paid. From here onwards, in future, every year how much growth only is there? Sir, every year 8% only is there, sir. That means, can I calculate the price at the end of third year? Yes, sir, I can calculate P3. Tell me, from here onwards, growth is constant. In case of variable growth, what will happen? For the initial few years, some different % growth will be there. After that point, every year constant growth will be there. Is this clear, everyone? In that case, what we have to do? For the uneven growth period, individually we will calculate dividend. At the end of that uneven growth period, I will calculate the price. Then I will discount all of that. Pay attention. I will tell boss, till here your uneven high growth is over. From here onwards in future, every year how much only growth is there? Only 8% growth is there. I told okay, only 8% growth is there. Okay, let me calculate the price. Yes, P3 is equal to D4 divided by cost of equity minus G. Tell me D3, already how much dividend I paid? 140.4928. This is D3. From here onwards, how much growth will be there? 8% into 1.08 divided by cost of equity is 15% minus 0.08. So it is into 1.08 divided by 0.15 minus 0.08 is 0.07. It comes to 2167. Yes or no, everyone? 2167.6 something. Let me keep it as it is. Is this clear? Okay, perfect. 140.49. Okay. Now I want to calculate the value of share. This is where students make the maximum mistakes. They won't understand in which time these numbers are. That is why I always tell, draw a line. If you draw a line, you can never commit a mistake. So how do I calculate a value of a share? Very simple, present value of future cash flows. First year I am getting 112, bring it here. One time I will discount. Second year I am getting this. 2 years I will discount. Third year I am getting dividend also, price also. How many years I will discount? 1, 2, 3. 3 years I will be discounted. As simple as that. Look at this stepwise. I am telling. Step number 1, I will calculate dividend for the uneven growth period. That is the high growth period. 3 years uneven growth was there. So for 3 years I calculate the dividend D1, D2, D3. Okay. Next, what I will do? I will calculate price at the end of uneven growth. Where is my uneven growth ending? Third year. At the end of it, I will calculate the price. P3 is equal to D4 divided by KE minus G. Accordingly, I will do the numbering. I will get the value. Now, yes, so draw a line. You should know exactly where your cash flow is. The main reason why students commit a mistake is they don't know where this cash flow is. They will all calculate this, but they'll think it is for 4th year or some other number they'll be putting. They'll keep asking, sir, why should we do all these things? Okay. Yes. Now, from here, I will calculate value of a share. Yes. Present value, discount all of it. You will be arriving at the value of the share. Look at this step-by-step approach. I have written down the steps to solve a question. Look at this, very important. Step number 1, calculate dividend for uneven growth period. For which all period high growth is there? Yes. Dividend individually I will calculate. Step 2, I will calculate price at the end of the uneven growth. Third year uneven growth ended. At that year, I calculate price. P3 is equal to D4 divided by KE minus G. If I want price for nth year, it is dividend of n plus 1. Yes or no? P0 means D1 divided by KE minus G. P10 means D11 divided by KE minus G. Next year dividend. So for nth year means n plus 1th year dividend divided by KE minus G. Yes, now third step what I have to do? Yes, I have to bring it to present value. As simple as that. Is this clear everyone? Very simple students. 3 examples I have kept. One example we did. One more example let us do. Pay attention quickly. Fast we are going to do. Company just paid a dividend of 10 rupees. Just paid. That means it is D0. Yes, growth estimate is as follows. 10% for first 3 years. 8% for next 2 years. Then 5% thereafter. What we have to do, sir? Line we have to draw, sir. Line should always be straight, sir. Okay. 0, 1, 2, 3, 4, 5. Tell me just paid. How much we already paid? 10 rupees we already paid. Okay. Tell me first 3 years how much is the growth? 10%. So 10 I already paid plus 10% makes it 11 plus 10% makes it 12.1 plus 10% makes it 13.31. First 3 years 10%. Okay boss, done. Next 2 years is how much? 8% plus 8%. 14.37 plus 8% is how much? 15.52. Okay. And 5% thereafter. From here onwards till infinity. Every year how much percent only growth is there? 5% only is there. That means my uneven growth is over. Here at the end of 5th year, what I will also be calculating? I will also be calculating a price here. I will tell P5 is equal to D6 divided by KE minus G. Tell me the 5th year dividend is 15.52. From here onwards, which growth it will increase? 5%, 1.05 divided by cost of equity is 15%, 0.15 minus growth is 0.05. So 15.52 into 1.05 divided by 0.1, it comes to 163 rupees something, 163 something. So first year cash flow is there, second year is there, third year is there, fourth year is there, fifth year is there. I have to discount at 15%. I will discount. I will arrive at the value of the share. So story is over. Is this clear everyone? One more example is there. Quickly we'll see. Pay attention. Maja example. Company just paid a dividend of 50 rupees. Just now hot we paid. Okay, fine. Cost of equity and growth estimate is as follows. First 3 years. Okay, growth is 10%. Cost of equity is 15%. Yes, fourth year onwards, growth is 5%. Cost of equity is 13%. Pay attention. Maja is going to happen. Pay attention. Calculate intrinsic value. What is the first thing you have to do? Draw a line. Sir, line should always be straight, sir. 0, 1, 2, 3. 3 onwards till perpetuity. Already how much dividend we paid? 50 year. Tell me first 3 years how much percent growth will be there? 50%. That means first year is 55 plus 10%, 60.5 plus 10%, 66.55. Yes, my uneven growth is over. Over, sir. That means here I have to calculate the price. Tell me price at the end of third year. It is a D4 divided by KE minus G. Be very careful here. Pay attention. Yes, third year end I am standing. Here I am standing third year. I am seeing front. Next year how much dividend I will be getting. Tell me this year how much I got? 66.55. How much growth will be there fourth year onwards? 5% into 1.05 divided by KE minus G. My growth is 0.05. Yes, the most important question. Which KE I should be taking? Which KE I should be taking? Which KE I should be taking? Tell me students. Tell me. Which KE I should be taking? Simple da, simple. Tell me growth which one I have taken. From where I am calculating. From fourth year onwards I want to know. That means cost of equity also I want from fourth year onwards. Nah. Yes, what is the cost of equity here? 13% here. Is this clear everyone? So I will take 0.13 minus 0.05. Very, very important. Okay, you might commit a mistake here. Okay, so it is going to be into 1.05 divided by 0.13 minus 0.05 makes it 0.08. It gives me a price of 873. Okay, yes, now tell me, yes. Now I have, yes, 3-year cash flow. First year cash flow, second year cash flow, third year cash flow. I have to discount. Yes, sir, I have to discount. Yes, now which rate I will be using to discount? Tell me which all year cash flow I am discounting? First year, second year, third year. For first 3-year cash flow, what is my cost of equity? 15%. That means in which rate I will discount? 15%. Simple. Yes, this is the discounting rate. So for first 3 year, whatever cash flow I will be having, I will discount it 15%. Fourth year onwards, whatever cash flow will be there, I will be discounting using 13%. That is why, yes, this 873, it is the present value of fourth year to perpetuity. That is why when I was discounting, I discounted at 13% because there the rate was 13%. Now I came to first 3 years. First 3 years discounting rate is how much? 15%. So which rate I will be using? 15%. As simple as that, yes or no? So first 3 years I will be using 15% discounting. Fourth year onwards to perpetuity, my cost of equity here was 13%. Is this clear, everyone? I hope you guys will never commit this mistake. The simplest thing in the world is to draw a line. Accordingly, do the calculations individually. You will never ever commit a mistake. Is this clear, everyone? So all different variants we have done, my dear students. Okay, perfect. Yes, with that we are having some additional notes. Pay attention. First is concept of required rate of return as per CAPM we will be doing. Yes, it is RF plus beta into RM minus RF. In that, one important adjustment is if my inflation increases by X%. Suppose in your question you will see inflation increases by 2%, then what will happen? Then my risk-free rate will increase by 2%, market rate will also increase by 2%. Understand, yes, whenever I am getting the required return, it is for two factors. Yes, the required rate of return, the return I am getting as an investor, it is for two factors. One is for inflation, second is for the risk taken. Yes or no, everyone? For inflation, whatever I am getting, that is my RF. Yes or no, everyone? Okay, simple, not getting into too much detail. Pay attention, assume RF is 6%, RM is 10%, beta is 1.5. Question is asking calculate required rate. Simple, boss. Yes, it is 6 plus RM minus RF, 10 minus 6 is 4 into 1.5. 1.5 into 4, it is 6, makes it 12%. Is this clear? Okay. Now, suppose a question tells, yes, this is the existing data. Assume, calculate the required rate if inflation increases by 2%. Tell me, if inflation increases by 2%, that means what will be the revised RF? 6% previously they were paying, but now inflation increased by 2%, the boss. That means how much they should be paying me? 8%. Market was giving me 10% return, but inflation increased by 2%. That means how much market should now give me? It's 10 plus 2, it should give me 12%. That means what is my revised required rate of return? 8 plus 12 minus 8, RM minus RF into beta, which is going to be 1.5. Yes, 4 into 1.5 is 6, 6 plus 8 is going to be 14%. Is this clear, everyone? Or else, if I am having my existing required rate, for that directly I can add my inflation premium also. Is this clear? In one of the questions, this adjustment was there. Is this clear, everyone? Okay, fine. Calculation of dividend, I know how to calculate D1. It is D0 into 1 plus growth rate. Okay, fine. Yes. Now, whether dividend given in the question is D0 or D1, very simple term. Yes. If question is using the term dividend just paid, dividend paid, 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 it is D0. Or question gives you income statement, profit or loss, income statement, in that dividend is shown. Income statement is for the just immediately, yes, over year. That means it is going to be D0. In all other cases, the institute treats your dividend as a D1. Is this clear, everyone? However, if you are having any ambiguity, any doubt, yes, you can give a note and accordingly do the solution. ICI will be having both the answers. Is this clear, everyone? Give me a confirmation. Yes, everyone. So let's go ahead to the next point, that is calculation of cost of equity. Different situations wherein we might require to calculate cost of equity. Now, if cost of equity is given in the question, bingo, no tension at all. But if cost of equity is not given, we have to calculate. How do we calculate? All different situations, I have brought it at one place. Pay attention, students. What all situations can be there? Situation number 1, beta is given in the question. That is, they have given me beta, they have given me RM, they have given me RF. How do I calculate cost of equity? Required rate of return as per CAPM, that only I will tell it as my cost of equity. Yes or no, everyone? Okay, fine. That is one situation, basic. Or else, cost of equity is missing, but all other data is given. In that case, I can calculate it as a missing figure. Example number 9 will quickly go. I will show you that example. Pay attention. Yes. Calculate cost of equity. D0 is given as 100 rupees. Growth is 5%. Price is given as 2100. Tell me, students, price of a share. It is a D1 divided by cost of equity minus growth. Yes, I can write it as D0 into 1 plus G divided by cost of equity minus growth. Tell me, price of a share is given, sir. It is 2100 rupees. Yes, D0 is given 100 rupees. Growth is given 1.05. Cost of equity is given not given, sir. Growth is given 0.05. So tell me what is the only figure which is missing? Cost of equity. I can take it as a missing figure. Yes or no, everyone? Okay. So if all other data is given, only cost of equity is missing. In that case, as a balancing figure, I can take it. Okay, fine. There is no need to by heart another formula. There is another formula. No need to by heart. Keep it as missing figure. You will be getting the answer. Okay, fine. In all other situations, what we have to do? Yes, in all other situation, we will calculate cost of equity using the trial and error method. That is, cost of equity is that rate at which present value of future cash flow equals to the price of the share. Yes. Now I will show you guys an example. In that you guys see. Beautiful example, students. Yes. Company expects to pay a dividend of 50, 70 and 100 in the first 3 years. First 3 years, how much dividend it is paying? 50, 70, 100. Great, boss. Thereafter, dividend will grow constantly at 5% per annum till perpetually. 4th year onwards, constantly 5% it will increase. Great, boss. Calculate K, cost of equity, if the current market price is 750 rupees. They are asking calculate K. How do we calculate, boss? Yes, present value factors are given as follows. Yes, what all discounting rates are given? 15%, 18%. So it is a hint that my cost of equity is somewhere lying between 15 and 18%. Ideally, I should be taking that interpolation. I have to be calculating my IRR. Not getting too much into detail, but quickly let me do it. Pay attention, students. Suppose I am telling, yes, company is giving me 15% return. Tell me what all cash flows I am getting. First year I got 50 rupees dividend. Second year I got 70 rupees. Third year I got 100 rupees. Can I calculate price at the end of third year? Because 4th year onwards it is going to be constant dividend. Okay, P3 is going to be D4 divided by K minus G. Yes, third year 100 I already paid. Yes, how much growth will be there? 5% into 1.05. Suppose my cost of equity is 15%. That means it is 0.15 minus 0.05. So it is going to be 100 into 1.05 divided by 0.1. It is going to be 1050 rupees. Yes or no, everyone? So I can tell third year price is going to be, I am just keeping it here, 1050 rupees. Perfect, everyone. Yes, this figure, this price will be there if my cost of equity is how much? 15%. Yes or no, everyone? So using this, I will discount my cash flows. I will arrive at a price. Okay. However, question has given me one more discount rate, 18%. In that case, what is the value of asset? That also let me try seeing. Tell me, if 18% discount rate is there, understand, yes, if my discounting rate will change, accordingly, price of the share will also change. Yes or no? So P3 will be different for different discounting rates. So again, I will calculate. Yes. First year 50 rupees dividend, second year 70, third year 100 rupees dividend. Quickly, I am explaining to you guys. At the end of third year, I want the price. Okay, boss. I can tell it is nothing but D4 divided by KE minus G. Yes, D4 already 100 rupees we paid. Growth is 5%, 1.05. Yes, this time my cost of equity I have assumed it as 18%, 0.18 minus, yes, growth is 0.05. So it is going to be 100 into 1.05 divided by 0.13. Is going to be how much? 807. 0.69 something. Now at 18% discount rate, yes, I am having these cash flows. I will bring them to present value. I will get a value. So now understand what am I going to do? Yes, what are the steps to be followed? Step 1, I will calculate P3 at different discount rates. Okay, boss. Yes, using that, what will I be doing? Step 2, I have to be calculating the cost of equity. Yes, year 1, 2, 3. Yes, if I am discounting at 15%, first year I get a dividend, second year I get a dividend, third year I get dividend as well as price. Yes, at 15%, if I am discounting, I will get 850. Assume at 18% I am doing. First year dividend, second year dividend. Third year I will be getting dividend plus price. I discount, I will be getting 645. So tell me, students, if I am discounting all my cash flows at 15%, yes, how much is the value of the asset? 853. Yes, if I am discounting all my cash flows at 18%, how much is the value of asset? 645. Tell me, how much is the value of the asset that I want? Sir, I want a market price of 750. Yes or no, everyone? Perfect. That means how much is going to be, what is happening? Why are things like this happening today? Okay, fine. Okay, so how much is going to be cost of equity? Very simple. Tell me 15% if my cost of equity is there. How much price I should be paying? 850. Tell me from 15% to 18%, how much percent my required rate increase? 3% if I increase my discounting rate, na, value of asset will decrease by how much? Sir, from 853, na, it will come to 645. That means value of the asset will reduce by 208. Yes, including the signs I will show. That is 3% if I increase, value will decrease by 208. Tell me, I want to decrease the value by how much? I am standing here. Yes, right now the value is 853. I want it to reduce, but how much only I want it to reduce? I want to reduce and reach 750. That means how much I want it to reduce? 853 minus 750. I want it to reduce by 103 only. That means by how much percentage my rate has to increase? Cross multiplication plus it has to increase. That is why I am showing a plus from 15%. It is going to be 103 into 3 divided by 208. 103 into 3 divided by 208. It has to increase by 1.48% plus 15 makes it 16.48%. This is going to be my cost of equity. Is this clear, everyone? A simple case of interpolation. We have been doing this from Intel days. Again, quickly I have shown you guys one example. Is this clear, everyone? Perfect. So coming back to the concept, pay attention. Cost of equity, if it is not readily given in question. Beta is there, do it as per CMA. Other cases, if all other data is given, only cost of equity is missing, you can get it as missing figure in the equation. Or if multiple cash flows are there, in that case, what I have to be doing? Interpolation technique I should be using. Is this clear, everyone? Any doubts still here? Give me a confirmation, students. Yes, everyone. So the next point we are having is calculation of growth, that is the sustainable growth rate. Yes, I hope you guys are knowing G is equal to the retention ratio into return on equity. Not explaining too much into depth. Retention ratio, how much percent you are retaining, yes, which is nothing but retained earnings divided by profit available to equity shareholders, or it can also be written as 1 minus dividend payout ratio. Return on equity, it is the return for the equity, return divided by equity. Yes, for equity holders, what is the return? It is called as PATESH. I call it as PATESH, profit available to equity shareholders divided by equity. Yes, equity includes equity share capital plus reserves and surplus. Now look at this income statement, pay attention, everyone. Yes, quickly in one single minute, let me try explaining. Suppose I earned 1 rupee profit for equity shareholders. In that 0.4 I paid as dividend. That means how much money is being retained by business? 0.6 is retained by the business. Yes, company has retained the money. Will they chumma hold it with themselves? No, boss. They will be reinvesting. Tell me, equity holders' money, I am reinvesting. How much return I will get? I will earn the return on equity, because equity holders' money I am investing. Yes or no, everyone? Suppose 0.6 retained earnings was there. Yes, I reinvested. Company is giving a return on equity of 20%. So tell me how much extra growth I will be getting. Tell me how much was retained, 0.6. In that, how much return I am generating? 20% of that. So I will be generating 0.6 into 20%, 0.12. That is 12% growth will be there. How did I get? Yes, how much I retained. Yes, in this retention, how much return I am getting into the return on equity. Not explaining much in depth because you guys are playing this along. Okay. Yes, everyone. Yes, income statement, sales minus your operating cost gives you EBIT, minus interest gives you your earnings before tax. You reduce your tax, you arrive at your earnings after tax or profit after tax. Yes, from this we pay our preference dividend. Yes, we will arrive at our PATESH, profit available to equity shareholders. Okay. From this, if I reduce the dividend distributed, I will arrive at my retained earnings. Is this clear, everyone? Okay, fine. Okay. So using this, yes, equity or book value includes equity share capital plus reserves and surplus, dividend payout ratio. It is a dividend divided by profit available to equity shareholders. Okay, fine. Decision, how do I take a decision whether to buy a share or not? Yes, I compare the intrinsic value with the market price. Accordingly, I will be taking a decision. Relationship between discount rate and price, there is going to be an inverse relationship. Okay, with this our concept 1 is over. Now pay attention quickly. In 1 to 2 minutes, let me revise. Now the entire equity valuation I have summarized in 1.5 pages. Entire thing, everything. Okay, in 2 minutes you guys can quickly revise. Pay attention, everyone. So what all I have discussed. Firstly, I told value of an asset. It is present value of future cash flows discounted at required rate. Value versus price. Value means how much benefit I am getting. Price means how much amount I am paying. Yes, how do I take a decision? I will compare value with price. If value is more means I will buy the asset. Accordingly, other things. Now, valuation of equity shares. First, I told dividend based valuation. Yes, two main things. Yes, share is held for limited period or unlimited period. If it is held for limited period means, yes, in that limited period, every year how much dividend I am getting, sale price, I will bring it to present value. Okay, if it is held till perpetuity, if there is a no growth means, it is a dividend divided by cost of equity. If there is a constant growth means, it is a D1 divided by KE minus G. Yes, D1 is a first year dividend, D naught into 1 plus G. Yes, growth, how do I arrive at my growth? It is the retention ratio into the return on equity. Okay. Now, in case of variable growth, that is first few years, high growth will be there. At the end of it, constant growth will be there. What I have to do? 3 steps. Step 1, I will calculate the dividend for the uneven growth. Where there is that high growth, na, individually I will calculate dividend. Okay, fine. Step 2, where my high growth ends, yes, I will calculate the price there. Yes, calculate price at the end of that uneven growth. Yes, wherein Pn is equal to dividend n plus 1, next year dividend divided by Ke minus G. Draw a line, you will exactly understand every year how much cash flow is there. Bring it to present value, you will arrive at the value of the asset. Is this clear, everyone? This much we had discussed. Additional points, how do we calculate cost of equity also we had seen. Is this clear, everyone? Any doubts still here? Shall we continue? Yes, everyone. Now let us go ahead to concept number 2, which is other methods of valuation. Yes, we are discussing unit 1, valuation of equity shares. In that we told two main methods are there. One is a dividend based valuation. One more is other methods of valuation. Other methods, let us see. In that first one I am having is earnings based valuation. In that first I am having earnings growth model, same like a dividend growth model. Yes, tell me what was the formula of dividend growth model? D1 divided by Ke minus G. Earnings growth model is telling, boss, instead of dividend, na, you take EPS, earnings. So it becomes EPS 1 divided by Ke minus G. As simple as that. Value of asset is EPS 1 divided by Ke minus G. Now one more model we are having is Walters model. Not very important for you guys from your examination perspective. So I am not going to tell you guys the detailed derivation or logic. Yes, but the formula looks something like this for you guys. Yes, D plus E minus D into R divided by Ke whole divided by Ke. Yes or no, everyone? Perfect. So now look at this. Walter model is telling that price of a share depends on two things. First, it depends on the dividend I am getting, D. It is telling, boss, there is one more thing. It is not just dependent on the dividend. Yes, suppose the earning of a share, EPS of a share is 10 rupees. I have only paid a dividend of 4 rupees. That means balance 6, what I have done? I have a reinvested. Yes or no? I have a retained. So from that retention, I will be generating a return. Yes or no, everyone? So I will be getting returns from reinvesting the retained earnings. So look at this, 10 rupee earning was there. In that 4 rupee dividend I paid, that means 6 rupees I retained, E minus D. Yes, this I have retained, I am reinvesting into the business. I will be earning return on that into R, into the return on equity. Is this clear, everyone? Yes. So now value of the asset, not getting into the logics. But for you guys to just remember it, I have created a statement. How do I calculate value of an asset in Walter's model? Walter is telling, break it into two. Dividend is there, plus from the retention ratio I am reinvesting, from that also return I am getting. So the statement is capitalize dividend and double capitalize the return from retained. Sir, why double capitalize? I have told you I am not going to the details because this is not important for you at the final level. It was tested in inter, but still because one formula is there, one GGB question is there, I am just keeping it here. So yes, capitalize dividend, that is D divided by KE. I have capitalized. Okay, divided by required rate, plus a double capitalize. What I have to double capitalize? The return from the retained earning. Yes, firstly retained earning, which is E minus D. This I invest, I will be getting a return into R. Yes, this is the return from the retained earnings. I have to double capitalize divided by Ke square. Yes, this is going to be your formula. Is this clear, everyone? Just a simpler way for you to remember, not getting into the logic. There is a beautiful logic for you to tell why it is becoming Ke square, how it happens, all those things are there, not getting into any of those things. Simple Walter model, yes, you are just going to tell capitalize dividend plus double capitalize the return from the retained earnings. Capitalize dividend, that is a D divided by Ke, plus a double capitalize the returns from retained earnings. Retained earning is E minus D. Yes, on that the return you are getting is into or double capitalize. That means it is K square. You will be getting the answer, not getting into the logic because it will take me 10 minutes and trust me, it is not worth it here. Is this clear everyone? Okay, fine. This is over. Next comes the next point, which is going to be relative valuation. That is PE ratio, price earning ratio. Tell me students, what is the price earning ratio? What does it mean actually? Yes, suppose market price of a share is 100 rupees. EPS is 10 rupees. Calculate PE ratio. Yes, we all know the formula of PE ratio. PE, price divided by earnings. Price of the share is 100 rupees. Yes, earnings is 10 rupees. That means it is 10 times. Now understand one very simple point, students. Anywhere you find a numerator divided by denominator. Yes, what is the interpretation? The interpretation everywhere is very simple. Yes, for 1 unit of denominator, yes, how much is the numerator? Yes, I am dividing by denominator. That means for 1 unit of denominator, how much numerator is there? So look at this. I am getting P by E is equal to 10 times. That means for 1 unit of denominator, that is for 1 rupee earnings, how much price I am paying? 10 rupee price I am paying. So the very simple interpretation is for 1 rupee earning, how much price I am paying? Yes, 10 rupee price I am paying. Yes or no? Yes, for 1 rupee, look at this students. Price earnings. Tell me for 10 rupee EPS, or let me write it as earning price. For 10 rupee EPS, how much I paid? 100 rupees I paid. PE is saying P divided by E, earnings divided by earnings. For 1 rupee earning, how much price I am paying? Yes, it is 100 divided by 10 times. Is this clear everyone? So what is the interpretation of PE ratio, price to earnings? It answers how much price I am paying to get 1 rupee EPS. Price divided by earnings. Yes, if PE ratio is equal to 8 times, it means that yes, to earn 1 rupee EPS, to get 1 rupee EPS, investor is willing to pay 8 rupee price. Is this clear everyone? Perfect. So what is going to be formula of PE ratio? Yes, P divided by E. P means the market price of share. Yes, E, it is the EPS of the share. Is this clear everyone? Okay, perfect. Now it is always expressed in terms of times, 8 times, 7 times, 12 times. Now using PE ratio also I can calculate price. Sir, how sir? Understand, suppose in the question PE ratio is given, EPS is also given. That means what is the only factor which is missing? Market price is missing. Can I calculate? Yes boss. Suppose, look at this everyone. Assume EPS is 10 rupees. P ratio is 8 times. Calculate market price. Tell me P ratio formula. Yes, it is price divided by earnings. Tell me P ratio is how much? 8 times. Price do I know? I don't know sir. But earnings do I know? Yes, 10 rupees. Take it to the other side. So 10 into 8. Therefore, my price is going to be 80 rupees. Yes or no everyone? Okay. Using that, yes, again if you want you can create a formula and keep market price of a share is equal to P ratio into EPS, but who will keep by hearting all those formulas? Using the basics only we'll keep on playing. Is this clear everyone? Okay. Now using that we are having one additional formula also. Pay attention students. Yes. Investor is having a cost of equity of 15%. Calculate the target PE ratio for the investor. Now understand students, beautiful concept. If you want you can by heart and keep, but understand the logic. Investor has a cost of equity of 15%. Investor is telling, boss, if I invest money, now how much return I want? 15% return I want. So investment return. Investor is telling 1 rupee if I invest. Now 15% of that, 0.15 I want. Yes, if I invest, I am investing in a share. That means what I am paying? Price I am paying. I am getting a return from that. What I am getting? Earnings I am getting. Yes, so 1 rupee I invest, 0.15 I want. Tell me what is PE ratio? PE, price divided by earnings. That is to earn 1 rupee earnings. For 1 rupee earning, how much price I should be paying? Yes or no? That is what PE ratio is telling. For 1 rupee earnings, price divided by earnings. For 1 rupee earnings, how much price I am paying? So I just write it. Okay boss, for 1 rupee earnings, how much price I should be paying? Cross multiplication. So it is going to be PE ratio is equal to, yes, 1 divided by 0.15. Yes or no? So if I want to write it in the form of a formula, my PE ratio is equal to 1 divided by 0.15, which is nothing but cost of equity. So this formula is also there. Is this clear, everyone? So all in all, in PE ratio, two things I have to be remembering. First is the main formula, PE ratio, price by earnings. This is the market price per share divided by EPS per share. This is my main formula, but there is also an additional formula which tells price to earning ratio. It is 1 divided by cost of equity. For this also logic I have told. Is this clear, everyone? Using this, any question on PE ratio we can be solving. Now pay attention, one example I have created and kept. You guys can quickly see that. Now in that all different things I have tried incorporating. Pay attention, everyone. Yes, if market price is 500, EPS is 40, calculate PE ratio. P ratio is price divided by earnings. Price is how much? 500. Earnings is how much? 40. 500 by 40 is going to be how much? 12.5 times. Yes, this is the basic. Okay, fine. EPS is 40. PE ratio is 12.5 times. Calculate the target market price. Okay, boss. P ratio is price divided by earning. P ratio is how much? 12.5 times. Price do I know? Don't know, sir. That only we want, na? Okay, divided by earnings. EPS is how much? 40. So this goes to the other side, 12.5 into 40. Therefore, my market price is going to be 500 rupees. Yes or no? Basic games here and there we are playing. Okay. Now, third case. Shares are quoted at a PE ratio of 8 times. Okay, PE ratio is 8 times. Company retains rupees 9 per share, which is 45% of EPS. Okay, very important line here. Okay, calculate the market price of a share. Now tell me, PE ratio is given. Yes, it is price divided by earnings. Tell me, PE ratio is given how much? 8 times. Okay. Yes, price I want to know. Yes, earnings, let me try seeing. Company retains 9 rupee per share. How much we are retaining? 9 rupees I am retaining, which is 45% of EPS. 9 rupee I am retaining, which is how much percent? 45% of EPS. That means how much is EPS? 9 divided by 45%. 20 rupees is EPS. Yes or no, everyone? Basic calculations or else cross multiplication also I can do. Yes, EPS retention ratio. Tell me, 1 rupee if I earn as EPS, how much I am retaining? 45% I am retaining. That means 0.45 only I am retaining. In this case, how much is my retained earnings? 9 rupees is a retention amount. That means how much will be EPS? 9 divided by 0.45, which is going to be 20 rupees. Using this, I will calculate price. Price is going to be 20 into 8. Price is going to be 160 rupees. Is this clear, everyone? I hope this is clear. Like this, 1-2 examples questions are there in your study mat. Now, this is a beautiful question which so many students get stuck here. Pay attention. Beautiful, maja, crazy. Okay. Suggest if the stock is overvalued. Okay, when? If the stock price is 35, in the market it is trading at 35 rupees. ROE, return on equity, is 9% and EPS is 2.25. Comment using the PE multiple approach. Okay, they have told comment using PE multiple approach. But sir, in the question PE only is not there. We can calculate PE. How, sir? Yes, return on equity or cost of equity is given 9%. Using that I can calculate. Yes, we know that PE ratio is equal to 1 divided by cost of equity. Using this we can calculate. Pay attention, everyone. Yes, step 1, calculate PE ratio. Very simple thing. Investment as much as possible return. I'm not getting into formula, just logic only I'm telling. Tell me, yes, return on equity is 9%. 1 rupee if I invest 9%, 0.09 return I want. Yes, 1 rupee price I paid. Yes, how much EPS I want? 0.09 I want. PE ratio for 1 rupee earnings, how much price I should be paying? So it is going to be 1 divided by 0.09. 1 divided by 0.09 is going to be 11.11 times. Yes or no? Or else alternatively, formula also you can by heart and keep 1 divided by cost of equity. Yes or no? Okay, PE ratio I got. Using that, can I calculate value of share? Okay, PE ratio is price divided by earnings is 11.11. Price I want to know. Earnings is how much? Earnings is EPS is 2.25. Therefore, price is equal to 2.25 into 11.11 makes it 25 rupees. So tell me, ideally what is the value of share? 25 rupees only, but in the market at what price it is trading? 35 rupees. Overvalued, pakka overvalued boss. Decision making, share is going to be overvalued. Is this clear? So using PE, what all different options can be there, that also we've discussed. Is this clear everyone? Yes or no? Give me a confirmation, students. This is also over. Now point number 3, other methods for valuation. In that we have seen earnings based, PE ratio based, miscellaneous areas I am having. In that first one is FCF, free cash flow to firm based valuation. That will be discussed in a chapter business valuation. Okay, in that one example was given here. In business valuation chapter we will be doing. Next is yield based valuation. Beautiful Majja concept. One question is there in our study material. So many students ignore that question. Beautiful it is. Yes, we'll be spending somewhere around 10 minutes to understand this, but beautiful. Yes, you will not have known the logic of that. You would have sometimes ignored that question or sometimes tried by hearting or whatever it is. Give me 10 minutes. I will tell you guys the logic of that. So are you guys ready for this? So we'll take 1 minute to let this sink in, then we'll continue our discussion. Now, yield based valuation, beautiful thing. Let me give you guys a small theory, a background. Using that we will only derive. Pay attention everyone. Yes. There are going to be two different types of yields. One is the actual yield. Actual yield is nothing but the actual return, how much I am getting. Yes, actually how much return we are getting. Next is the required yield or expected yield, how much return I want. Now, value of a share. Now, I am giving you guys a very simple example. Assume there is a share which is having a face value of 100 rupees. Every year my actual return is 20%. That means tell me every year how much return I am getting. 100 into 20%, 20 rupees. So I am telling first year I get 20, second year I get 20, third year I get 20. Like this till perpetuity I keep on getting 20 rupees. Is this clear? Okay. Assume my required rate is 10% only. So if I want to calculate value of the share, how will I calculate value of a share? Yes, cash flow till perpetuity. I will tell boss every year I am getting 20 rupees. Yes, I have to calculate present value, discount it. Yes, but my required rate is how much? 10% only. That means what will be value of a share? 20 divided by 10%, it is going to be 200 rupees. Yes or no everyone? Perfect. Now tell me, can I write this 20? What is 20 rupees? This is the actual return. Every year how much return I am getting per annum divided my required rate. Yes or no everyone? So I told yes. Yes, formula is actual return per annum. Every year how much return I am getting divided by discounted at required rate. I will arrive at the value of the share. Tell me, how did I arrive at the actual return? Every year 20 rupees return I am getting. How did I get? Yes, 100 rupees is face value into my actual yield or actual return is 20%. That is how I got 20 rupees. I will tell it is face value into actual yield percentage divided by required yield. Is this clear everyone? So accordingly I will arrive at the formula, the main formula here. Yes, it is value of a share. How do I arrive? Yes, it is every year how much return I am getting. That is actual return per annum. Yes, discount it, bring it to present value. Yes, capitalize it, divided by required rate. So let me elaborate and write it. Actual return, how do I get it? It is face value into actual yield percentage divided by my required yield. Is this clear everyone? So look at this everyone. Yes, share has a face value of 100 rupees. Actual yield is 20% per annum. That means every year 100 into 20%, 20 rupees it is giving. Required yield is 10% only. So let me capitalize it at 10%. 20 divided by 10% is going to be 200 rupees. Is this clear everyone? Okay, perfect. Now some basic ratios we have to be calculating. Let me explain the basic ratios. After that we will go into the question. One question is there. Yes, I have created an example question. You see that only is there for us. Okay, but every student feels it is difficult. Student feels it is illogical. There is absolutely no logic. We are here to derive logic for that. Two ratios we have to understand. First is the interest and fixed dividend coverage ratio. Now what exactly on earth is this ratio trying to tell? Yes, it is telling me how much rupee profit is available to pay 1 rupee fixed financial obligation. Yes, how much profit is available to pay 1 rupee of fixed financial obligation. Okay boss, tell me, when I am telling fixed financial obligations, company is there, what all fixed financial obligation is there? From where all I can get money? Either I can get from equity, in that case fixed obligation is there? No sir. Or I can get from debt, debenture, fixed financial obligation is there? Yes sir. or I can get from preference share. Fixed financial obligation is there? Yes sir, it is there. So tell me, fixed financial obligation come from two places. Either I get from debt or I get from preference shareholders. Yes or no, everyone? So tell me. Yes, fixed financial obligation. Two things will be coming. One is the debenture interest. Next is going to be the preference dividend. Is this clear, everyone? Okay. Now tell me, what is the profit which is available to pay the fixed financial obligation? Tell me, students. Yes. Assume one simple story I am telling. Yes. Assume we run a business. Okay. We earned a profit after tax of 3 lakh rupees. 3 lakh rupees profit we earned. In that, debenture interest was 50,000 rupees. Tell me how much profit is available in the business after paying my tax. Sir, 3 lakh profit is available. This 3 lakh rupees profit is available for paying what all? It is available for paying my preference dividend, equity share capital, all those things. So can I tell this 3 lakh is available to pay my preference dividend? Yes or no? So how much profit is available to pay preference dividend? Sir, 3 lakh is available, sir. Now I want to know how much profit is available to pay preference dividend as well as the debenture interest. Okay, understand, just logically. I can tell you in one single minute the formula, but I am just trying to give you a small insight into the logic as to why this formula is there. Okay, tell me, students, this 3 lakh profit I got after paying 50,000 interest. That means tell me total how much profit is available to pay preference dividend also, debenture interest also. So this 3 lakh profit I got after paying interest. That means total how much profit is available for us? 3 lakh plus 50,000, 3.5 lakh. Yes or no, everyone? Perfect. Suppose I am telling, okay, yes, I paid you 10 rupees. After that I am having 50 rupees in my pocket. That means total how much I had before paying you? 60 rupees I had. As simple as that. So after paying interest, 3 lakh profit is still left with me. That means to pay you before, how much money was there? 3 lakh plus 50,000, 3.5 lakh was there. Is this clear, everyone? Okay. So total profit which is available to pay my fixed financial obligation, profit was also there, interest was also there. Is this clear, everyone? So what is this formula telling? Interest and fixed dividend coverage ratio. Yes, it is trying to tell you, yes, for 1 rupee of fixed financial obligation, how much profit is there. Yes, when I am telling fixed financial obligation, I have preference dividend as well as interest. For that, how much profit is there? It is my profit after tax plus interest. Is this clear? So that is how we are having this formula. Not getting into too much detail. From your inter days, you would have learned. Again, this ratio comes as a separate unit in basics. But because it was needed in this question, I just took out 1 minute to quickly explain you guys. In very simple terms, it is telling that, boss, suppose I am telling, yes, I have to pay interest of 1 rupee. Okay, to pay this interest of 1 rupee, 3 rupee profit is there with me. Yes, that means this ratio is telling 3 times. It is telling me the safety, the level of safety which is there. That is, to pay 1 rupee interest, 3 rupee profit I have earned and kept. So in that 3 rupee profit, 1 rupee will go off as interest. After that also 2 rupees is there with me. It shows the level of security, the level of safety that I am having. Is this clear, everyone? Forget everything. Simple formula, interest and fixed dividend coverage ratio. Yes, what I have to be paying? Sir, I have to be paying preference dividend plus interest. To pay this, how much money I have? Sir, to pay this, to pay preference dividend, I have profit after tax. To pay interest, yes, plus interest. This gives me my interest and fixed dividend coverage ratio. Okay, okay, sir. Now, yes, in my numerator, there is profit. Profit, the higher it is, the better it is. So this ratio, the higher it is, the better it is. Is this clear, everyone? Okay, quickly I have explained. It is a measure of safety. Higher it is, the better it is. Okay. Now the next thing is capital gearing ratio. What exactly on earth is capital gearing ratio? It is telling me, yes, I have taken funds to carry on business. From where all I can be taking funds? Sir, one is equity I can be taking, that is equity share capital plus reserves and surplus. Yes, next I can be taking, yes, either preference share capital or debenture. Yes or no, everyone? Yes, here I am telling, yes, how much percentage of funds is having a gearing. Gearing means a fixed financial obligation. Tell me in which all fund I am having a fixed financial obligation. If I buy from preference share capital, I have a fixed financial obligation. I have to pay preference dividend. In case of debenture, also I have to be paying. So they are telling in the yes, how much percentage of fund is having a fixed financial obligation as a percentage of my equity. So look at this. How much fixed interest bearing fund, that is debenture and preference share, is employed in the business for 1 rupee of equity. It is as good as debt to equity ratio. Tell me debt to equity ratio is what? Debt by equity. Yes, here, yes, with the debt I am including preference share also. That is debt debenture plus preference share capital divided by equity. Equity includes equity share capital plus reserves and surplus. This becomes my formula. Again, yes, interpretation of each and every formula is a very beautiful, lengthy discussion. I am bringing it down just to some 30 seconds to 45 seconds because it is a revision. Is this clear, everyone? Yes. What does it tell? Yes, capital gearing ratio. Yes, I have told you the interpretation of a ratio, numerator divided by denominator. For 1 rupee denominator, how much numerator is there? That is, if I am having 1 rupee equity in the business, yes, how much debt is there? Yes, tell me, ideally debt should be more or debt should be less? Debt should be less. Why, sir? Debt shows the amount of risk involved. More debt is there means more risk, na boss. Ideally debt should be less. Yes or no, everyone? Equity should be more. Yes. So, yes, it is showing the level of financial risk. So, lower it is, the better it is. Is this clear, everyone? Okay. A quick discussion of both the formulas. First one is interest and fixed dividend coverage ratio. Yes, tell me what all I have to pay. Yes, I have to pay preference dividend also, I have to pay interest also. To pay this, how much profit I have? So to pay preference dividend, I have profit after tax. Yes, I have to be paying interest also. So the total amount I'm having is plus interest. Yes, the higher it is, the better it is. Next is going to be my coverage ratios. Yes or no, everyone? Sorry, gearing ratios. Capital gearing ratio. It tells total how much our capital we have put. Our capital is equity. That is equity share capital plus reserves and surplus. So for 1 rupee of our fund, how much outsiders fund we have put? That is preference share capital plus debentures. Yes, more outside fund means more risk. Ideally, the lower it is, the better it is. Till here, whether things are fine? Yes, sir. Till here, things are fine. If this much is fine, we can directly go ahead to the question. We will see the question. Using the question, I will explain you guys the story, the step-by-step approach. Yes everyone, so let's quickly revise whatever we've discussed till now. Accordingly, we'll take our discussion forward. So we have started with the chapter security valuation. In that first we are discussing equity valuation. Okay, so first we have understood what are we doing in this chapter. This chapter is all about valuation. So what is value of an asset? Value of an asset is nothing but how much benefit I am getting from an asset. It is the present value of all the future cash flows discounted at the required rate. Okay, I have told what is value versus price. Yes, price means how much amount I am paying. Value means how much benefit I am going to be getting. Okay, how do I take a decision? Decision making framework is very simple. Boss, calculate the value, compare with the price. Value is more means yes, it is under price. Value is equal to price means correctly priced. Value is less, price is more means it is going to be over a price. So we'll be accordingly selling it. Okay, boss. Now then we came to valuation of equity shares. Majorly two bifurcations are there. Either I will be valuing based on dividend models, dividend based valuation, or we are having other models of valuation. Firstly, dividend based valuation. Yes, either share is held for limited period or share is held till perpetuity. If share is held for limited period, in that limited period, whatever dividend I am getting, sale price I am getting, bring it to present value terms, that is going to be the value of the asset. Okay. Share is held till perpetuity. I am going to capitalize the dividend. Okay. So if there is no growth, it is a dividend divided by cost of equity. Yes, if there is a constant growth, dividend discount model, yes, it is a D1 divided by KE minus G. Okay, perfect everyone. Wherein D1, that is a first year dividend, it is D0 into 1 plus growth, and growth, it is nothing but retention ratio into my return on equity. Okay, boss. Next, in case of variable growth, I have told you all together in 3 steps I will be doing it. Step number 1, I will calculate the dividend for the uneven or high growth period. Individually, I will calculate the dividend. Draw a line. Yes. Step 2, I will calculate the price at the end of my uneven growth. Suppose the 5th year end, yes, high growth is going to end. 5th year end, I will be calculating the price. P5 is equal to D6 divided by KE minus G. Yes, show it on a graph, show it on a line. Now all your cash flows, D1, D2, D3, D4, D5 as well as P5, bring it to present value terms. You will accordingly be arriving at the value of the share. Okay, boss, perfect. Till here we have discussed. Yes. Next, some additional notes where there calculation of cost of equity. Yes, beta is given means I will be calculating as per CAPM. Yes, if it can be calculated as a missing figure, I will be calculating it as a missing figure. In all other situations, cost of equity I will be calculating through interpolation, that is, yes, in the form of calculation of IRR. Is this clear everyone? Okay, perfect. Yes. Next thing is, yes, other method for valuation of equity. In that first we are having earnings based valuation. Yes, in that we are having earnings growth model, same as dividend discount model, but here instead of dividend I will be taking EPS. So it is EPS 1 divided by cost of equity minus growth. Then I am having Walters model. I have told you guys a very simple statement. Yes, capitalize a dividend and yes, double capitalize the return from your retained earnings. That is a D divided by K plus yes, retention ratio, that is earnings minus dividend. Yes, I will invest, I will be getting into our, yes, double capitalize, it is KE square. Yes, not getting into too much of logics there. Yes, next is price earning ratio. Price earning ratio. Price earning ratio is price divided by earnings. That is for 1 rupee EPS, how much price I am willing to pay. Yes, using this I can calculate my market price. If P ratio is given, EPS is given, accordingly I can calculate. Or there is one more formula, P ratio is equal to 1 divided by cost of equity. Using this also we will be calculating our market price of the share. Yes, then the final thing we had discussed was yield based valuation. Yes, wherein actual yield will be there, required yield will be there, some ratios have to be calculated, all those things. I have told you a proper framework. Step 1, income statement I will prepare. Yes, from sales all the way till retained earnings. Okay, boss, done step 1. Step 2, I will calculate my actual yield percentage. How to calculate actual yield? Question will tell you. So actual yield percentage, it is actual yield divided by equity share capital into 100. Okay, boss. Step 3, I will be calculating the required ratios. Yes, what are those required ratios? We will discuss. Yes, once I have calculated required ratios, step number 4, I will find out the deviation in those ratios. That is, benchmark was 3, I got 2.16 only, 0.84 difference is there. Okay, perfect. So I have calculated deviation in the ratios. Step 5, using that I will calculate the required yield. What is my required yield? Similar company, how much it is giving? Plus or minus risk premium for the change in the ratios. Okay, and once I have arrived at my required yield, now I will accordingly calculate the value of the share. Value of the share, it is actual return divided by my required yield percentage. How do I arrive at my actual return? face value into actual yield percentage divided by required yield percentage. Okay, boss. Yes, calculation of required, yes, ratios. First one is interest and fixed dividend coverage ratios. Yes, it is telling for 1 rupee of fixed financial obligation, how much profit I am having to pay that. Yes, in the denominator, fixed financial obligation, I have preference dividend plus interest. In the numerator, profit available for that, it is a PAT plus interest. Is this clear, everyone? Capital gearing ratio, it is telling for 1 rupee of my own fund, how much outside, yes, fixed income paying fund is there. Yes, own fund, which is my equity share capital plus reserves and surplus. In the numerator, yes, I am having my preference share capital as well as debenture. Is this clear, everyone? So this much we had discussed yesterday. Any doubts in this, my dear students? If everything is clear, accordingly we will go ahead to the next level. Are you guys ready? Give me a confirmation, everyone. Yes, everyone. So now let us take our discussion forward. Yes, unit number 2. Yes, we are in equity valuation. In that unit number 1, yes, equity valuation is over, dividend based models, other models is over. Now some special areas are there. Sir, what all is there, sir? 3 pointers are there. In every point, one question was there in the study material. Based on that, I have created an example. We'll see the example, with that the concept will be over. Jujube, if a question comes, a halwa, maja will be doing. Pay attention, 3 things are there. First is bonus shares. Next is buyback of shares. Next is right shares. Not getting too much into detail because basics you know already. What is bonus share, what is buyback, what is right shares, you know. But how calculations will come, how questions will come, what we have to do, what is the framework we are going to build. Okay, boss. Bonus shares. I will directly go ahead to the question. Using the question, let us try understanding. Example number 13 we are having, everyone. Pay attention. Halwa Jujibi question it is going to be. Yes, now pay attention. This is zero coupon bond. Okay. Example number 13. All of you guys pay attention. Mr. Majaman is thinking of buying shares at the rate of rupees 500, having a face value of 100 rupees. There is one share, face value is 100, currently trading at 500. We are thinking, okay, should we buy the share? Okay. What all details is giving? He is expecting a bonus of 1:4 in the 3rd year. Oh, what is he going to get? Bonus he is going to get in the 3rd year. Okay, boss, great. 1:4. For every 4 share held, he will be getting 1 share as bonus. Okay, great. Yes, annual expected dividend is 15%. Yes, dividend percentage is given. It is always going to be on the face value. Okay, great, boss. And the same ratio is expected to be maintained on the expanded capital base as well. Oh. Yes, in the 3rd year, I will be getting bonus, na? Yes, even on that extra shares also, same ratio only bonus will be getting. Okay, great, boss. He intends to sell the shares at the end of 5th year at 700 rupees per share. 5th year he will be selling at 700. Great. Incidental expenses for purchase of share and sale of share is 5%. Incidental expenses 5% will be incurring. Great, boss. He expects a minimum return of 10% per annum. He is telling, boss, at least 10% return we want. Okay, great. Should he buy the share? Okay, first requirement, should he buy the share? Second, if so, what is the maximum price he should be paying for each share? Simple. I want to calculate value of the share, but here one small adjustment is there. Till now, all calculations I was doing directly for one share. Yes, I was just showing cash flow for one share, but here the number of shares will increase. That impact I have to show. That's all. See how simple it is going to be. Yes, I have drawn a line. Yes, year 1, 2, 3, 4, 5. 3rd year bonus will be there. First, I will write down the number of shares. Yes, question has not specified. Let me do the calculation assuming 1 share I am buying. Okay, boss. Today I purchased 1 share. That means tell me how much share I am having in 1st year? Sir, 1 share. How much share I am having in 2nd year? Sir, 1 share. 3rd year, how much share I am having? Sir, 1 share. Wrong, da. Why? 3rd year, what is going to happen, da? Sir, bonus we are going to get, na, sir. That means tell me in the 3rd year how much share I will be having? Sir, 1 existing share I have. Bonus I will be getting in the ratio 1:4. That means 0.25 shares I will be getting it as bonus. That means total how much a share I will be having? 1.25 share I will be having. Is this clear, everyone? Sir. But sir, in reality 0.25 share I will not get, na, sir. This is just a calculation. I just want the ratio. Okay. Now you can assume, you can do the calculation assuming shareholder originally has 4 shares. In that case, he will be getting 1 share. That way also you can be doing the calculation. But I don't want you guys to get into all those nonsense. Okay. So yes, in this case, in this calculation, our bonus shares can be in decimals. In reality, I am not paying in decimal. Just for calculation, I am doing this. Is this clear, everyone? I hope this point is clear. Okay, boss. Third year, I had 1.25 shares. Fourth year also, I had 1.25 shares. Fifth year also, I had 1.25 shares. Is this clear, everyone? Okay, perfect. Pakka. Now, let me calculate the dividend. Tell me, students, how much dividend company is paying? 15%. Face value is 100. Tell me, first year, how much share I am having? One share I am having. So 15% means 15 rupees dividend. Second year, again 15 rupees dividend. Third year, wait. For one share, 15 rupees. Yes or no? Like that, how much share I am having? The 1.25 share I am having. That means I will be getting 18.75. Is this clear, everyone? Fourth year also dividend is 18.75. Fifth year also dividend is 18.7. Is this clear, everyone? Okay. Fifth year, I am going to sell the share. Yes, sir. That means sale value I will be getting. Yes, sir. Tell me, what is the selling price of one share? Selling price is 700 rupees. Okay, sir. So, I am selling the share. I got 700 rupees. Maja is coming. Money is coming. But tell me whether full money will come into my pocket. No, sir. What is going to happen? Sir, 5% incidental expenses is there, na, sir? Okay. That means 700 minus 5%. Whatever is the amount, only that much I will be getting 665. Now tell me, am I going to get 665 only? No, boss. When I am going to sell, tell me, fifth year and how much share I am holding? I am holding 1.25 shares. So I will be receiving money on the 1.25 shares. So on one share I am getting 665 into 1.25 shares. It is going to be how much, students? It is going to be 831.25. Is this clear, everyone? Give me a confirmation. Okay. Now all the cash flows are clear. Look at this, everyone. The most important thing we have to do for this entire chapter is draw a line, visualize. Everything will fall in place. Trust me. Okay. So yes, I will write down. Look at the framework that I have done. Step 1 is calculation of present value of all future cash flows. Okay. 1, 2, 3, 4, 5. Okay. I will write down the number of shares also. First year 1 share, second year 1 share, third year is 1.25, 1.25, 1.25, 1.25. Yes, then I will write down the cash flow. What all cash flow I am going to get? It can either be dividend or sale value. Yes, first 2 years 15 rupees cash flow. Third, fourth, fifth year 18.75 I am having. Then sale price I am having 831.25. Yes, discounting rate question has told 10%. So at 10% I will discount. Yes, I will arrive at my present value of 580.7. Is this clear, everyone? Okay. So that means what is the value of the share? How much benefit the share is giving to me? Sir, it is giving me a benefit of 580.76. That means tell me today when I am purchasing the share, maximum how much amount I am willing to pay? Sir, maximum 580.76 I am willing to pay. Yes or no, everyone? Perfect. Yes. As against that, how much I am paying today? What is the first question? Should he buy the share? Should we buy? Tell me, students, today if I have to buy the share, at what price it is available in the market? 500 rupees. So should I buy the share? Yes, sir. How much benefit I am getting? Yes, sir. Total benefit I am getting 580.76. I am paying 500 only. So I am getting a benefit of 80.76 rupees. Yes or no? Yes or no? Yes or no? No, da. Sir, why, sir? Because when you are purchasing, you have to pay the incidental expenses as well, right? So that means understand. Yes, look at this, students. Today, at t is equal to 0. Yes, I am paying 500 rupees to purchase the share. With that, 5% incidental expenses also I am paying. I guess it is coming to 25 rupees. Yes or no, everyone? So that means total how much I am paying today? 525 I am paying. That means what is the net benefit? I am telling boss 580.76 benefit I am having. Today, how much I am paying? 500 plus 5%. 525 I am paying. That means what is my net benefit, students? My net benefit is going to be 55.76. Is this clear, everyone? Give me a confirmation. Should I still be buying the share? Yes, boss, benefit is great. Is this clear, everyone? Okay, great. Second requirement. Okay, boss, if he is willing to buy the share, tell me maximum how much share price can be there. Maximum how much share price can be there. Tell me, students, if I purchase the share, total how much benefit I am getting? So I am getting a total benefit of 580.76. That means tell me maximum today, that is at t is equal to 0, how much amount I am willing to pay? Sir, maximum 580.76 I am willing to pay. Yes or no? Yes, sir. But tell me, can I pay full 580.76 as share price only? No, sir. Why? Because if I am paying 1 rupee as a share price, 5% incidental expenses also have to pay. That means my total amount will be 1.05. Yes or no? So question is asking me how much maximum price he can pay for the share. Share price they are asking. Okay, let us do the calculation, not a big deal. So what I will tell, look at the students. Yes, I have written that explanation. Total benefit I am getting is 580.76. Yes, that means maximum amount I am willing to pay is 580.76. Yes, if I am buying today means 5% incidental expenses have to be paying. So maximum amount I am willing to pay is 580.76. Okay, yes. So if I am buying a share price anyways I have to be paying. With that incidental expenses also I should be paying. Question is how much share price I am willing to pay. I don't know, sir. Whatever I don't know in life, I will take it as X. Let me assume share price as X. That means incidental expense is 5% of that, 0.05x. So 1.05x is equal to 580.76. Therefore, value of X is 580.76 divided by 1.05. It is going to be 553. So maximum how much price I am willing to pay. Maximum if the share price today is 553. Till there I am okay. Is this clear everyone? Give me a confirmation. So let us come back. Yes, simple framework for us to solve the question. If we get a question on bonus share, what we have to do? Yes, first framework is we will calculate the present value of all the future cash flows. Normal table only. Here we will write cash flow, we will write present value factor, we will write present value, we will write. With that, one extra column I will add, that is of number of shares, because number of shares are changing. Without this also you can be doing, but do a pictorial representation, understand the cash flow. Okay, okay. Two questions, yes, institute will be asking. First question is, yes, should I buy the share? How will I do? Yes, I will show, yes, the net benefit from buying the share, that is present value of all cash flows minus, yes, present value of cash outflow. Yes, I will arrive at the net benefit. Okay, boss. Then question will ask you, maximum how much I can pay? Yes, I will tell, boss, share price plus incidental expense will be equal to maximum amount payable. Maximum amount payable is equal to value of the share. Share price I don't know. I will take it as X. Accordingly, I will arrive at the value of X. Is this clear everyone? Like this one question we are having in one of the past papers. If you want, you can have a look at that, or else you do this example, it is going to be more than sufficient. Till here, is this clear everyone? Give me a confirmation. Giving you guys a minute to let this sink in. Then we are going to the next beautiful thing, which is going to be buyback of shares. Yes everyone, so we are having the next point, which is going to be buyback of shares. Now again, this is not a regular batch, so not discussing too much into detail on what is buyback, what is going to be the impact of buyback, all those things. Question how to do strictly from the examination perspective. Let us try understanding. Okay boss. Buyback means, okay, company is purchasing back its own securities. It is also called as repurchase agreement. Example number 14 is there. We will see the example. Once we see the example, beautiful way, in a very beautiful, simple way, we will understand and solve the question. Pay attention everyone. Time Pass Technologies Limited, sir, Majak name sir, has a surplus cash of 60 lakh rupees. 60 lakh extra cash they are having. They are thinking what to do, boss? No, use only. And they want to distribute 30% of it to the shareholders. They are thinking 30% of it will distribute to shareholders. That means 60 into 30%. 18 lakh they are thinking, boss, let us give to shareholder. How to give to shareholder? Either I can distribute dividend, yes, or some other forms are also there, but they are thinking, let us do one thing, let us buy back the shares. Okay, fine. The company decides to buy back the shares. It is also one way, is to distribute amount. All those things not getting it. Okay, fine. So total how much money is there to distribute? 18 lakh rupees is there. Okay. Finance manager estimates that the market price after buyback will be 10% more than the buyback price. Important line, important line, important line. Yes, finance manager is there. He is thinking and telling, after buyback, market price will be 10% more than the buyback price. That is, at what price I am buying back the shares? Yes, the market price after buyback will be 10% more than that. Suppose I purchase the shares at 10 rupees. After buyback, share value will be 10% more than that, 11 rupees. Tell me, do I know the buyback price? Sir, till now I don't know, sir. Whatever we don't know in life, whoever we don't have in life, what do we assume it as? We'll assume it as X. So what we are going to do? We will assume buyback price as X. Therefore, market price after buyback, yes, it is 10% more than that, it will become 1.1x. Yes or no everyone? Okay, perfect. Other data is given. tell me right now, yes, how many number of outstanding shares are there? 6 lakh shares are there. Right now, what is my EPS? 4 rupees is the EPS. Expected market capitalization after buyback. After buyback, what is the market capitalization? Market capitalization means total value of the shares is going to be 130 lakh. There's some new data and all is there. Don't worry, I'll give you guys a framework. In that, any question comes, aram se maja will do. Okay, pay attention. You are required to determine the price at which shares can be bought back. At which price we are going to buy back the shares. That is what we have assumed it as X. That X we have to calculate. The number of shares that can be repurchased. Okay. The impact of share repurchase on EPS, assuming that the net income remains the same. Okay. Now understand aram se step by step. Okay. Step 1, basic calculations we are going to do. Now, in case of buyback also, in case of right issue also, yes, I have prepared a special framework for you guys. Pay attention. What I am going to write. Particulars, number of shares, price per share, value. Okay, this is how we will be doing. Yes, first let me write down existing. Right now, today, how many shares are there? Sir, number of shares outstanding in the company is 6 lakh. Sir, right now 6 lakh shares are there, sir. At which price it is trading, sir? We don't know, sir. That means right now what is the value, sir? That we don't know, sir. Not available. May not be needed. Don't worry on that. Okay, fine, perfect. Yes. Total 6 lakh shares is there. In that, some shares will be bought back. That means balance shares will only be there. To give you guys a very simple number, assume total 6 lakh shares are there. 10,000 shares company bought back. That means net how much shares only will be there? 5.9 lakh only will be there. Yes or no? Yes, sir. So I am writing existing number of shares minus buyback. It is going to reduce the number of shares. Gives me the revised number of shares. Okay, fine. Now tell me one very simple thing, students. Total how much amount is there? Suppose you are the shareholder. You are telling I don't want this. Yes, sir. Yes, nonsense company shares. Yes. I am opting for buyback. You purchase this, you give me the money. I am going back. Tell me total how much money is there with the company to give it to shareholders. Sir, 60 lakh was there, sir. 30% of it wants to distribute. So 18 lakh total cash it is giving. Okay, boss. Total 18 lakh it is giving. Yes or no? Yes, sir. For every share, at what price buyback is happening? Sir, every share buyback is happening at X rupees. We didn't know the price. We assumed it as X. Every share buyback is happening at X rupees. That means, sir, can you tell total how many shares have been purchased back? Simple, boss. For one share, I am paying X rupees. Total how much amount I paid? Sir, total 18 lakh I paid. That means total how much shares have been bought back? Sir, it is 18 lakh divided by X. Yes or no, everyone? Yes, sir. So total how many shares are purchased back? 18 lakh divided by X. Is this clear, everyone? Yes, boss. That means, can you guys tell me revised how many shares are there? Tell me originally how much shares were there? Sir, 6 lakh were there. In that, how many shares are purchased back? Sir, 18 lakh by X shares are purchased back. That means revised how much shares will be there? The revised number of shares is going to be 6 lakh minus 18 lakh by X. Yes or no, everyone? Yes, sir. After buyback, how much is going to be the market price? Sir, question told me. After buyback, yes, the market price is going to be 10% more than buyback price. Buyback price was X. That means after buyback price is going to be 1.1x. Yes or no, everyone? Yes. So if I multiply number of shares into market price, gives me the market value. Question tells me after buyback, what is going to be the market value? 130 lakh. So this is going to be 130 lakh. Yes or no, everyone? Yes. So just substitute solve, you will be arriving at the number. Look at this, everyone. Yes, revised market value. It is the revised number of shares. I had 6 lakh shares. In that 18 lakh divided by X shares I purchased back. That gives me the revised number of shares. Revised market price per share is 1.1x. That gives me the revised market value, which is going to be 130 lakh. Yes, I will simplify solve this. So it gives me divided by X, 6 lakh X minus 18 lakh into 1.1x. X and X here gets cancelled. 130 lakh. 1.1 into 6 lakh. It is 6.6 lakh X minus 18 into 1.1. 19.8 lakh is equal to 130 lakh. Yes, if you simplify 130 plus 19.8 divided by 6.6, I guess you are getting the value of x as 22.69. Yes or no, everyone? And what is important in life? Who should we not forget? Sir, we should not forget who our x is. Tell me, who is our x? Buyback price is x. So the first question is the price at which shares are purchased back. Yes, it is 22.69. Second, the number of shares that are purchased back. Yes, what is the value of number of shares that are purchased back? 18 lakh divided by x, 18 lakh divided by 22.69. Yes, which is 79,330 shares are purchased back. Yes or no? Third is going to be impact of share repurchase on the EPS, assuming that net income remains same. So previous whatever EPS was there, now you will be dividing by the revised number of shares. Tell me, previously 6 lakh shares was there. For every share EPS was 4 rupees. That means what was the total income? 6 lakh into 4, 24 lakh was the total income. Question is telling now also 24 lakh only is there, but boss, right now number of shares have reduced now. So this income will be distributed over fewer number of shares. Okay, what is that fewer number of shares? Yes, previously 6 lakh was there. Yes, in that 79,330 shares reduced. That means revised I am having only 5,20,000, I guess 670 shares. That means what is going to be the revised EPS? 24 lakh divided by 520670. I guess it is coming to 4.609. Is this clear, everyone? So all the calculations we finished it off. So now pay attention, everyone. Let me just show, yes, the format for buyback of securities. Look at this, everyone. So yes, this format I am going to do. Yes, particulars, number of shares, price per share, value. Existing right now, whatever data is there, I will write down. From that, if I do a buyback, number of shares will reduce. Minus buyback gives me the revised number of shares. Okay. So how am I going to do? Yes, first step, assume that your buyback price is equal to X. Total how much amount we are going to make a buyback will be given. If buyback price is X, accordingly number of shares bought back will be available to you. Using that, what I will do? Existing number of shares minus buyback gives me the revised number of shares. Point number 1. After buyback, what is going to be the market price? That will be given as a ratio in the question. Point number 2. You multiply, you will arrive at the value after buyback that will be given to you. Simplify, story is over. Is this clear, everyone? Calculate revised market value post buyback. It is the revised number of shares into the revised price per share. Substitute and calculate the value of X. So with this, one question was there on buyback that logically I have explained. Yes, one example we have created, a framework I have given. Now the only thing that is needed for you guys is quickly see that example yourself, try it once by yourself and have this framework on the back of your mind. You can never commit a mistake. Is this clear, everyone? Giving you guys a minute to let this sink in, then we'll go ahead to the next point. Beautiful maja point. Bonus shares. So many formulas are there. Students think it is so difficult. Trust me, we are going to make it GGB for you guys. Yes, everyone. So the next point we are having is concept number 3, right shares. Yes, important. Students consider it to be difficult. Students won't get an understanding, a perspective as to how to solve it. Trust me, we are going to make it jujube. At the end of it, you are telling right shares, sir, jujube, sir, halwa, sir. Okay. Now, what is right shares? A small pictorial representation I have done. So, company is there. Original shareholders are there, new shareholders are there. Using this, I will be explaining it to you guys. Pay attention. Yes, company is there. So, original shareholder, assume you are the original shareholder. You purchase a share of the company, transaction number 1. After some time, company requires some more fund to expand business or do whatever it is. So, Companies Act tells that you should first ask your existing members. If they are having fund, get it from them, or else only get it from outside. So, what company does is, company goes for right shares. Why right shares, all those things, not getting into that. Okay, boss. Now you as the original shareholder, you are having the 3 options available with you. Yes, if you are having fund with you and if you want to purchase the share, you can purchase the share. Yes or no, everyone? Option number 1. Yes. Or option number 2, you are not having fund with you. Yes, but your friend is there, he is having fund. He wants to invest in this company. You can renounce the right, sell the right to your friend. You can tell, boss, yes, this right is available with me. Yes, the market price of the share is 100 rupees, but in the right issue, they are giving me the share at 80 rupees only. So, yes, you take this. I can transfer the right to my friend. He will purchase the share and I will get some cash income in the form of selling of the right. Option number 2. Or option number 3, I will tell, Who cares about this? Ignore the right issue. Is this clear, everyone? Three options. Original shareholder is having three options. Either accept the offer and buy the shares at a discounted price. Normally it will be available at a discounted price. Assume the original market price before was 100 rupees. Right issue, they want more money. They will not be asking you at 100 rupees. They will be asking you at a discounted price. Why? They are going to save a lot of cost on the issue cost. Yes, all those things, not getting into that. Okay. Yes. Or you can renounce or transfer or sell the right to new shareholder and get some cash income. Or third one is reject, ignore completely, don't look at that only. Okay, fine. Now what is going to happen? If the existing shareholder, original shareholder is a transferring right to the new shareholder. Yes, original shareholder is there. Suppose you are the original shareholder, you transferred the right to the new shareholder. Yes, what is the benefit both the people are having? Firstly, for the new shareholder, what is the benefit for the new shareholder? New shareholder is telling that, boss, if I go to market, yes, price is 100 rupees. But if I purchase in the form of rights, I am getting the share at 80 rupees only. That means I am having the benefit of 20 rupees. Yes or no, everyone? Perfect. New shareholder can purchase the share at a cheaper price. Okay. New shareholder can purchase the share at a cheaper price than the market. Okay, point number one. Existing shareholder, why on earth am I selling the right? Why am I giving him that benefit? Because in return, he will give me some cash income. Yes or no? Because he is getting 20 rupee benefit, he will give me some cash. So, existing shareholder will earn some cash income in the form of selling of the rights. Is this clear, everyone? Okay, perfect. Practical calculations. What all calculations are going to come? Again, we will be doing it in the form of a framework. Now, you are having so many formulas, so many nonsense is there. Yes or no? Yes, I guess N0, S1 plus N1, some formula is there. I myself don't know. To be very frank, I know one or two formulas. That too with lot of difficulty. I am not a person who by hearts formula. I don't even know the formula. Why unnecessarily by heart the formulas? Yes. So what all will be there? Firstly, we'll have to be calculating the theoretical X right price. That is after right. What is going to be the price prevailing in the market? That is one calculation. Next is going to be theoretical value of right. Third thing is going to be the value of the right per share. Yes. Next is going to be impact of right issue on the shareholders' wealth. These are the calculations that we will be having. So let us quickly see an example. With that, let us understand that. With that, let us create a framework. Not getting into any of the formulas. Okay. Pay attention, everyone. Coming to the workbook, let us see. I'll give you guys a framework on how exactly to do. Example number 15. Maja Limited has issued 100 shares which are currently trading in the market at 100 rupees each. Yes, we are there. Maja Limited is there. What we have done? 100 shares we have issued in the market. Every share right now in the market at what price it is trading? 100 rupees it is trading. Company plans to make a right issue. They want more fund. They are telling, boss, we'll do one right issue. What? Of one equity share at 80 rupees for every 2 shares held. That is, if you are holding 2 shares, now for you 1 extra share will give. Tell me total how much shares we are having? 100 shares we are having. That means how much extra shares will be issuing? 50 extra shares will be issuing. Yes or no, everyone? From every share, how much money I am getting? 80 rupees I am getting. That means total how much amount I am getting? 50 into 80, I guess 4,000 if I am not wrong. Yes or no, everyone? Okay, fine. You are required to calculate the theoretical post-right price per share. After right, how much is going to be the price per share? Simplest thing in the world. And students unnecessarily by heart. Should I tell you a simple magic? Okay. Tell me, students, very simple. Tell me, right now, how much shares are there? 100 shares are there. At what price it is there? 100 rupees. That means, can you guys tell me what is the value? Sir, 100 shares into 100 rupees, it is going to be 10,000. This is what is there right now. Yes, right issue is happening. That means company is receiving money. Yes or no, everyone? Tell me how much extra shares are issued. Sir, for every 2 shares, 1 share is issued. That means total 50 shares are issued. Yes, from every shareholder, how much money I am getting? 80 rupees. So, yes, 50 into 80. 4,000 rupees company got extra. Yes or no? That means tell me after right issue, total how many number of shares will be there? Sir, original 100 were there, sir. Extra 50 I got, sir. That means total 150 shares will be there. Yes or no? What will be the value post buyback, after buyback? Sir, originally 10,000 value was there, sir. Extra how much cash we got, sir? 4,000. That means total what will be the value? 14,000 will be value. Tell me, can I calculate what is going to be, yes, my post right price? Tell me, after buyback, what is the total value? 14,000, sir. It is for total how many shares? Sir, 150 shares, sir. That means for 1 share, what is the price? 14,000 divided by 150, 93.33. Sir, this much only, sir. This much only, da. Sir, GGB, sir. That only I told, da. This is clear. This is what you were, yes, unnecessarily by hearting getting into all those nonsense. Yes or N naught PS1, some formula is there. To be very frank, I myself don't know the formula. Okay, yes, this is all. Okay, yes, I have built a framework in which, yes, we will be getting it. Pay attention. Look at the students. Basic calculations. Yes, number of shares, price per share, value. So look at this existing. Right now, how many shares are there? 100 shares are there. At what price they are trading? 100 rupees. So what is going to be the value? 10,000. I am making a right issue. That means number of shares will increase or decrease. Sir, increase, sir. Plus increase. Why? Because of right issue. Tell me how much extra shares we are issuing? 50 extra shares. At what price we are issuing? 80 rupees. That means total what will be the value? 4,000. That means tell me students, revised how many number of shares will be there? 100 plus 50. 150 shares will be there. Revised what will be the value? 10,000 plus 4,000. 14,000. That means, can you guys tell me what is going to be the revised price per share? Sir, 14,000 is the value for 150 shares, sir. That means for every share it is a 93.33. Story is over. Swaha. Over theoretical X right price. Yes or no, everyone? So, theoretical X right price, post right price, after right issue. Yes, what is going to be the price per share? I will tell it is nothing but the revised value divided by revised number of shares. Yes or no? Who cares about the formula? 14,000 will be value. It is going to be for 150 shares. That means it is 93.33 per share. Is this clear, everyone? Any doubt till here? Give me a confirmation. Now let us go ahead to the next point. Yes, it is the theoretical value of a right. Theoretical value of a right. Now there are different ways to do this calculation. What I am going to do is, I will talk from the perspective of new shareholder. Always remember this point, students. Always remember this point. Whenever I tell theoretical value of a right, from whose perspective you are going to do the calculation? Either you can do from the perspective of existing shareholder also. I am going to do the calculation from the perspective of new shareholder. Understand? Value of the right, it is nothing but the benefit that the new shareholder is getting. Understand? Very simple jujube point. Assume I am a new shareholder. Understand. You are the existing shareholder. You were originally having the shares. Okay. Yes. You were not having the money to buy. So what you did? Assume I am your friend. You told, this right issue is there. You want to buy the shares. I told, give me the right. Okay. So assume you gave the right to me for free. Now what is the benefit that I will get? Understand? Yes. I purchase a share in the form of a right. Yes, boss. Tell me, to purchase a share, how much money I am paying? Yes, if I am having a right issue, right subscription I am having, how much amount only I am paying? 80 rupees only I am paying. 80 rupees I paid. 80 rupees I paid, I got the share. Yes or no? Where am I standing? Right issue is over. Yes, once right issue is over, post right, X right, right issue is over. What is the share price? What is the share price? Tell me, students. Theoretical post right price per share. Once right issue is over, yes, I paid 80 rupees. They gave me the share. Once right issue is over, I am seeing in the market today at what price the share is trading. 93.33 rupees it is trading. So what is the benefit I am getting? 93.33 rupees benefit I am getting. That means, can you guys tell me what is the net benefit I am getting? Boss, I paid 80 rupees only, but I got a benefit of 93.33. That means I got a benefit of 13.33. As simple as that. Is this clear, everyone? That is the value of a right. In simple terms, whenever question asks you value of a right, what I have to do? I will think from the perspective of the new shareholder. What is the benefit that new shareholder is getting? Story over. Yes or no? Yes, it is the benefit to the new shareholder. Benefit to new shareholder. So when new shareholder is purchasing the share, yes, after right issue, the value which is going to prevail in the market is post right price minus, to purchase that, how much money he paid? He paid a subscription price only. Yes or no? I paid 80 rupees only, but I got a benefit of 93.33 rupees. So I got a benefit of 13.33 rupees. Is this clear, everyone? Perfect. And every time I calculate the value of a right, Yes, I will also calculate the value of the right per share. Value of the right per share. Tell me students, total for the new shareholder, how much benefit he got? 13.33 rupees benefit he got. Now tell me, when will I be getting a right? Yes, I will be getting one right if I have two shares with me. Yes or no, everyone? So if you see the question, if you read the question, I will be getting a right of one new equity share only if I am holding two existing shares. So this benefit of 13.33 I will get when I am having two shares. This benefit is for two shares. So for one share, the benefit is, the effective benefit is divided by 2. It is going to be 13.33 divided by 2. It is 6.6. Is this clear, everyone? Yes or no? Yes, simultaneously I'll keep showing you guys here also. Yes, what are the steps to be done? Look at this. Firstly, framework to solve a question. Yes, particulars, number of shares, price, value. First I will write down the existing value. Then I will show the increase in value due to the rights issue. That gives me the revised value. So post right price or ex right price. Yes, revised, what is the value? It is for revised how many number of share? That gives me the revised price per share. Point number 1. Point number 2 is going to be, yes, the theoretical value of a right. What is the value of a right? I told you, very simple. Think from the perspective of new shareholder. How much benefit the new shareholder is getting? Yes, it is nothing but the X right price. He got the share. Yes, after that it is trading at the X right price. Minus how much amount he is paying to get the share. It is nothing but the subscription price. That gives me the value of the right. And every time you calculate value of the right, this much only if I do it is sufficient. But sometimes institute does the calculation on total, sometimes institute does the calculation on per share. So why to take risk? Let us do both the calculation. So value of a right per share, it is nothing but value of the right divided by number of shares which is required to get that one right. In our case, 13.33 is the benefit. If I have one right, to get one right, how many original shares were needed? 2 shares were needed. Divided by 2 gives me 6.6. Is this clear, everyone? Yes or no? Perfect. Yes, then comes the third thing, which is going to be the impact of right issue on the shareholders' wealth. Look at this, everyone. Third one is, show the effect of right issue on the wealth of Mr. Mandus. There is a person called Mr. Mandus. Sir, what does Mandus mean, sir? Mandus is a Malayalam term which means intelligent person. Okay, yes, so you are Mandus. Oh, okay, yes, people from Kerala will be knowing. Okay, fine. Yes, there is a person called Mr. Mandus. Okay, a shareholder who is currently having 10 shares in the following situation. Situation number 1, he exercises the right issues and purchases the shares. Situation number 2, he sells the entire rights. Situation number 3 is he does not take any action. Okay, now understand what is happening. Okay, there is a shareholder called Mr. Mandus. Tell me how many shares he had. Sir, 10 shares he had. Originally, at what price they were trading? Sir, originally they were trading at 100 rupees. That means what was my original value, existing value? Sir, originally 10 shares were there at the rate of 100 each. That means 1000 rupees was the value. Yes or no, everyone? 3 different situations they have given. Situation number 1. They are telling that, okay, he exercised the right issue. He goes for right issue and purchases new shares. That means tell me 10 existing shares were there. How much extra share he will be getting? 5 extra shares he will be getting. Yes or no, everyone? Perfect. For 5 extra shares, how much amount he will be getting? Cash outflow. 5 shares at the rate of 40. Sorry, 5 shares at the rate of 80. 8 5s are 400 cash he will be paying. Yes or no? Okay. That is going to be the cash outflow. 400 cash he paid. Now, because of that, total how many shares he is having? Yes, benefit 15 shares he is having. And every share after the right issue is trading in the market at which price? 93.33. So what is going to be the value? 93.33 into 15 shares. It is going to be 1400 rupees. Yes or no, everyone? Perfect. So I will write market value of the share after right issue. I will tell boss, revised I am having 15 shares at the rate of 93.33. So I will be having a benefit of 1400, but full 1400 can I tell as benefit? No, boss. For this right issue I purchased 5 extra shares now. So to purchase those 5 extra shares I paid at the rate of 80, that is 400 I paid. That means my net value is 1000 only. So moral of the story is, assume you are an investor. Yes, right issue has come. Yes, you exercise the right and you purchase the share. What is the impact on your wealth? Your wealth will not change. Why? 400 rupees extra you paid. Now your value is 1400. That means your net impact is going to be 0. Is this clear, everyone? So I have written down here. Look at this, everyone. If a shareholder exercises the right, yes, there is going to be no change in the wealth. Is this clear, everyone? Okay. Situation number 2. Yes, if he is selling the right, assume you are the shareholder, you are not having money. So what you did? You sold the right to me. In that case, what will be the impact on your wealth? Tell me originally how much shares you had? 10 shares you had. At what price they were trading? 100 rupees. So what was the value? 1000 rupees. Now in the revised case, yes, 10 shares you are having. Okay, 10 shares I am having. Yes, at what price only they are trading? They are trading at 93.33 only. That means their value is some 933 rupees only. Okay, wait. But now in this case, understand what you are going to do. In this case, understand what you are going to do. Yes, if you were having 10 shares means how much right you had? You had the right to purchase 5 more shares. That means, can I tell 5 rights you had? Yes or no, everyone? Perfect. And tell me, what is the value of one right? What is the value of one right? Theoretical value of a right. The value of a right is 13.33. So you are having a right. Its value is how much? 13.33. So you transfer that right to me. At what price you will transfer? You will tell this right is having a worth of 13.33. You give me 13.33. You take this. As simple as that. So yes, how much you are charging for every right? 13.33. So it is going to be 5 into 13.33. It is going to be some 67 rupees. That means what will be the value in the revised case also? 1000 only will be the value. So tell me, is there going to be a change in the wealth? Again, there is going to be no change in the wealth. Is this clear? Framework, how to do the calculation also I have told. Yes. However, sir, if everywhere there is no change in wealth, why are we doing this, sir? Wait, this is where your twist will come. Third case, assume shareholder doesn't take any action. Assume you are that Mr. Mandus. You were having 10 shares with you originally. You were very happy. You were telling, la 1000 rupees wealth is there. Yes, but company came up with the right issue. You did not have money to buy, so you did not buy the shares. You did not transfer to a third party also. You chumma, you are sitting. Now understand what will happen. Yes, revise the case. 10 shares you will be having, no doubt. But their value will now be 93.33 only. That means the revised value will be 933. Previously the value was 1000. Now the value is 933 only. That means the value will reduce by 67. So understand what will happen. Yes, if in case you ignore the right issue, yes, then the wealth will be reduced. Is this clear, everyone? Yes or no? Give me a confirmation, my dear students. Okay. Yes, everyone. Now one more extra thing is there, students. Yes, it was there in one of the most beautiful questions, okay, wherein they are asking what is the value of the right if the share is selling X right at a market price of this. I guess it was one of the RTP questions or past exam. Beautiful question it was. Okay, but that adjustment I have taken, pay attention students, that I have incorporated in this example also. So whatever examples we are giving, now that's the most comprehensive. Everything will be included in one example only. So what is happening is, he is telling calculate the value of the right. I have to calculate the value of the right, which is nothing but the benefit to the new shareholder. If the stock is selling X right at 110 rupees. So understand. Yes, this is before the right issue. Okay, tell me, before the right issue, market price of the share was how much? 100. Yes, during right issue, yes, every share could have been purchased at how much price? During right issue, the subscription price was 80 rupees only. Now, after right, post right, it can be called as post right, it can be called as after right, it can be called as X right. Okay, that is after right. So now we have an X in life. Okay, after they have gone out from our life. Okay, X right. What is happening is, theoretical X right value we calculated, which was nothing but the weighted average. We told, yes, theoretically 93.33 should have been the price. Based on that, we calculated the value of right. We told boss, yes, I am getting a benefit of 93.33. Yes, I paid 80 rupees. That means I got a benefit of 13.33. This was a theoretical. Now tell me, is it necessary in reality? Yes, in the market, shares are trading at the same price. No, boss, anything can happen. They are telling, boss, after right issue, shares were not trading in this price. Then in which price they were trading da? Yes, they are telling, yes, if stock is selling X right at 110, yes, once right issue is over na, they were selling at a price of 110 rupees. That means what is the value of the right? Tell me in this case, what is the benefit to the new shareholder? Tell me, assume I was that shareholder. I purchased the share from the right issue. Tell me how much I paid. Sir, I paid 80 rupees only, I got the share. Tell me once right issue is over, I am looking in the market, actually price is how much? Actually price is 110 boss. That means tell me how much benefit I got. I got a benefit of 30 rupees, yes or no everyone? So value of right is going to be 110 minus 80, which is going to be 30 rupees. Now obviously if you want, creating formula is one of the simplest things in the world. Tell me, if I want to create this in the form of a formula, it is my X right price minus the subscription price. Yes or no? Once you understood the logic, yes, what you've written, that you can obviously create the formula and keep it. Yes, if you want on per share also you can do. Value of the right per share. Tell me 30 rupees benefit I'll be getting only if I'm having existing 2 shares. So per share basis the benefit is going to be 15 rupees. Is this clear everyone? So that point also I have discussed. Is this clear everyone? So what is going to be the value of right if share is trading at a price other than theoretical X right price? It is going to be the X right price. Previously I was taking theoretical, here I will be taking actual, minus the subscription price. Basically it is the benefit for the new shareholder, as simple as that. Is this clear everyone? Give me a confirmation my dear students. With this, right share concept is also fully over, done and dusted. Okay, let us quickly revise that. With that, equity valuation will be fully done and dusted. Each and every point, even the smallest of the things, trust me, these are small nuances you will not be finding even in the regular classes. I have told yield based valuation, I have told bonus shares, I have told you guys buyback of shares, I have told you guys right shares. Even the smallest of the things what we are having, everything we have discussed it here. Okay everyone, so pay attention. Yes, right shares, how we will be doing. Format I have created for you guys. Number of shares, price per share gives me the value. Existing I will be writing. Yes, right share is issued, it will increase, so I will be getting revised. Revised number of shares I will be having, revised value I will be having. Yes, value divided by number of share gives me the revised price per share. It is the theoretical X right or post right price. Wait a minute, what happened? Okay, fine. Okay, then if question asks me what is the value of a right, I have told you guys very simple. All I have to remember is it is the benefit for the new shareholder. What is the benefit new shareholder is getting after right? Yes, he is getting the share. Yes, which is a trading at X right price. Yes, which is the theoretical X right price. To get this share, how much only he paid? Minus the subscription price. Now here I have put a star. Yes. Normally I will be calculating value of right based on the theoretical X right price. But if in the question actual X right price is given, question tells okay, shares are actually trading at this amount after the right issue. Yes, I will consider actual market price. Based on it, I will calculate the value of actual rate. Okay. Then I will also calculate the value of right per share. It is the value of right divided by, to get this one right now, originally how much shares were needed. Yes, number of shares to get one right. Okay, impact of right issue. Yes, if you either subscribe to the right, yes, that is purchase shares, or you sell the rights, there will be no change in wealth. But if you ignore right issue, na, your wealth will be reduced. Is this clear everyone? With this equity valuation and all the nuances we have discussed. Okay, yes, I will try coming up with a separate video wherein the entire chapter, that is equity valuation, bond valuation, we will try revising in the lowest possible time, roughly within 15 minutes. Now, if you want the entire revision, trust me, 2 pages only. Entire discussion, we have summed it up. Okay, page number 1, page number 2, everything, each and every adjustment is over. Okay, giving you guys a minute to let this sink in. After that, we'll go ahead to the next Maja point, beautiful part B of the chapter, which is going to be bond valuation. So a quick mind map of what all we have discussed. First, I've understood what is value. Then I've told, okay, valuation of equity shares. First was a dividend based valuation. Next is other methods. Dividend based valuation, I told if shares are held for limited period, perpetuity. Perpetuity in that no growth, constant growth, variable growth. Okay. Other methods of valuation. First, I've discussed earning based valuation. In that, Gordon's growth model was there. Yes, as well as that is earnings growth model was there. Then Walter's approach was there. Then PE based valuation was there. Then yield based approach was there. This was there. Some additional adjustments, cost of equity calculation, all those things were there. Next, other special pointers. In that first one was bonus issue, second is buyback, third one is going to be right issue. Over, done, understood. Giving you guys a minute to let this sink in, then we'll continue with our discussion, students. Yes everyone, so let us go ahead to part B of the chapter, which is going to be bond valuation. Again a beautiful area, maja area. Students consider it to be difficult, but trust me, it is simple. If your basics are right, if you know what is valuation, if you know time value of money, trust me, nothing more is there here also. Okay everyone, so here unit 0, it is basics and background. Basic things are there. Yes, what is bond, we know. Yes, bond versus debenture. Yes, some basic terms. Par value, coupon rate, maturity, issue price, market price, redemption price, YTM, all those things are not needed for us. Okay, different types of bond for AFM purpose. First is a redeemable bond. Yes, what is a redeemable bond? Yes, I am telling, okay, yes, I am issuing a bond. Every bond is having a face value of 100 rupees. Every year 10% interest I am paying. At the end of 5 years, I am redeeming. Redemption can be at par, premium or discount. That is one type. Or second type is irredeemable. I am telling boss, I am issuing a bond at 100 rupees. Yes, every year 10% coupon I will give you. You are asking when are you redeeming? Perpetual. Till the end of the life, I will keep on paying the interest. I will never pay back the principal. Irredeemable bond. Or there can be a zero coupon bond. So what is a zero coupon bond? Yes, it is a bond which is issued at a deep discount and redeemed at par. Suppose we are issuing a bond whose face value is 1000 rupees. Yes, it will be redeemed at the end of 5 years. At what price it will be redeemed? It will be redeemed at 1000 rupees only. But today when I am issuing, I will issue it at a deep discount. Suppose at the end of 5 years I am going to redeem at 1000 rupees. Today I will issue it, say for example 400 rupees. Is this clear? It is a special type of bond wherein there will be no interim cash flows. I am not going to pay you any interest. Every other bond periodically interest I was paying. Here I am telling boss, I will issue it at a deep discount. Redeem at par. So this only, capital gain only, yes, this will be in the form of your, yes, return. Is this clear everyone? So what is a zero coupon bond? It is a bond which is issued at a deep discount. At a good discount I am issuing, redeeming at par. I will not be making any interest payment, just this difference between the price at which you have purchased and your redemption price. That is going to be the return for the invest. Is this clear everyone? Okay, fine. Some important notes for entire bond valuation. If face value is not given, I will always assume it as 100. Redemption price is not given, I will always assume that they are redeemable at par. Yes, coupon interest is always calculated as a percentage of face value. Is this clear everyone? If this is clear, let us come to unit number 1. Is the entire bond valuation, we have split it into 4 different units. First unit, it is bond valuation and yield. In these 3 things we will be understanding. First, we will be understanding bond valuation, how to calculate the value of the bond. Second thing is bond yield, how much return I got on a bond, bond yield. Third is going to be spot rate versus forward rate of interest. Okay, so first let us come to bond valuation. It is also called as bond pricing. Say assume there is a bond. Yes, if I purchase a bond, assume that bond is for 3 years, 100 rupees is a face value. Okay, yes, it gives me coupon interest of 10%. That means first year it gives me 10 rupee interest, second year it gives me 10 rupee interest, third year also it gives me 10 rupee interest. Assume it is redeemable at par, 100 rupees. This is the cash flow I am going to get from a bond. How much amount I should be paying for the bond? Tell me. Yes, basics are clear for us. I told value of any asset in the world. What is the value? It is the present value of future cash flows discounted at required rate. In case of bond, what all cash flow I will get? Interest I will get, redemption price I will get. Yes, discounted at required rate. The required rate in case of bond is going to be KD. So what is going to be value of bond? It is going to be the present value of future interest and redemption price discounted at the required rate. As simple as that. Over, sir. Over. That's all it is there. Simplest thing in the world. Okay. Look at this everyone. It is the present value of all the future cash flows discounted at required rate. Okay. So required rate of the bond, ideally it is going to be KD, but in some cases ICI will be giving me YTM also. Okay. So whatever it is, ICI uses the term KD and YTM interchangeably. In reality they are different, but ICI uses it interchangeably. We will see whatever is given, we will be using it. Okay everyone. Yes, decision making, I will compare intrinsic value with the current market price. Accordingly I will be taking a decision. In the basics we have already covered. So in different cases, what is going to be the bond valuation? Let us try understanding, students. Yes, everyone. So the entire discussion, we've broken it down into different situations. Firstly, in case of redeemable bond. Secondly, in case of irredeemable bond. Thirdly, in case of zero coupon bond. Then some special situation. Okay. In case of redeemable bond, tell me students, in case of redeemable bond, what all I'll be getting? Interest also I'll be getting periodically. At the end of the life, redemption price also I'll be getting. What I have to do? Present value. So value of the bond is nothing but present value of is going to be present value of interest as well as the redemption price. What happened? Okay, fine. Is the present value of interest as well as redemption price. Example 1, quickly let us see, pay attention everyone. Okay, fine. Maja Limited issued a 10% bond having a nominal value of 100 rupees. Nominal means face value. Bonds are redeemable at a premium of 20% at the end of year 4, fourth year, and they are going to be redeemed. Okay, calculate the value of bond in the following situation. Situation number 1, if the required yield is 8%. Okay, what is the first thing we should be doing? Sir, we should draw line, sir. Line should always be straight. Okay, fine, sir. Tell me how many years are there? 4 years. 1, 2, 3, 4. Tell me 10% bond it is going to be, that means 10% interest I am paying on 100, 10% means 10, 10, 10, 10. Redemption is a 20% premium, so 100 plus 20% is 120. Tell me at which rate I have to discount? 8% I will discount these cash flows. So I will tell, now see how I am going to simplify. Either individually I can do, or else tell me 10 rupees is the same cash flow I am getting in 4 years. So I can write it as year 1 to 4, 10 rupees. Now apart from that, in the 4th year, I am also getting 120 rupees. Year 4, 120 rupees. Yes or no? At 8% rate, at 8% rate, even the smallest of the things I am telling, 1 divided by 1.08 is equal, 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 equal. 4 times I pressed. So 4th year rate, I am going to write it here, 0.735. I will press a GT grand total. Where is the grand total? Oh, in this calculator it is not there. But it is always suggested to get a calculator which has grand total. Okay. Yes, you will be getting the value. Now you multiply, you will arrive at the value of the bond. Is this clear everyone? Okay, sir. Perfect. Yes, it is over. Now, in case of irredeemable bond, tell me students, in case of irredeemable bond, I will only be getting interest. That interest I will keep on getting it till perpetuity. Yes, I know. Yes, in case of perpetuity, what is the formula for present value? It is interest divided by the required rate. Yes or no? I will just to show you guys the example. Assume nominal value of a perpetual bond is 100 rupees. There is a perpetual bond, face value is 100 rupees. Coupon rate is 9%. Yes, they are telling, that means every year they are going to pay 9%, 9 rupees. So first year, tell me how much interest I will get? 9. Second year, 9. Third year, 9. Fourth year, 9. Goes on up to infinity. I will keep getting 9 only. Tell me in this case whether my principal will ever be returned? No, boss. I want to calculate the value till perpetuity. How do I calculate? Simplest thing in the world. Tell me every year how much amount I am getting? 9 rupees. Tell me the required rate is how much? 15%. Yes, this 9 rupees is going to be 15%. Yes or no? Simple. Yes, investment, return. If I invest 1 rupee, yes, what is the required rate? 15%, 0.15 return I want. Now tell me in this case how much return I am getting? 9 rupees. That means how much I should have invested? 9 divided by 15%. 9 divided by 0.15. It is going to be 60 rupees. Yes or no everyone? If you want it in the form of a formula, yes, it is interest divided by KD. Capitalize your interest, as simple as that. Is this clear everyone? Okay, sir. Simple, sir. Then comes third point, which is value of a bond in case of a zero coupon bond. Yes, value of a bond, it is nothing but, tell me in case of zero coupon bond, will there be interest payment? No, sir. That means only what will be paid? Redemption price. So what is value of bond? It is the present value of redemption price. As simple as that. So it is going to be the present value of redemption price. Look at this everyone. Yes, Maja Limited issued a zero coupon bond having a face value of 1 lakh. Okay, fine, boss. Maturity period is 5 years. Okay, great, boss. It is currently trading at 55,000. Right now in market, at which price it is trading? 55,000. Yes. Suggest whether to buy or not if the required rate is 12%. You have to tell, should I buy the bond or not if the required rate is 12%. First, let me try calculating the value of the bond. Tell me students, suppose I purchase the bond today. Yes, first year, am I getting any interest? No, sir. Second year? No. Third year? No. Fourth year? No. Sir, fifth year end, na, it will be redeemed. At what value it will be redeemed? 1 lakh. Yes, I want the present value of future cash flow. Yes, what is the required rate? 12%. So I will bring it back 5 years at the rate of 12%. I will tell it is 1 lakh divided by 1.12 to the power of 5. How much is it going to be? 1 divided by 1.12, 2, 3, 4, 5 into 1 lakh. Is it going to be 56,743 rupees? Yes or no, everyone? So we arrived at the value of the bond. That means for this bond, na, 56,743 rupees I can pay. I am willing to pay. But tell me, in the market I go and see at what price it is trading. Sir, it is trading at 55,000 only, sir. Cheap or costly? Cheap, sir. Should I buy or not? Buy da. Yes or no, everyone? Step 2 is decision making. Yes, value is 56,743, but it is trading at 55,000 only. It is underpriced, so purchase the bond. Is this clear, everyone? In case of zero coupon bond, there is no interest, there is only redemption price. So what is value? It is the present value of the redemption price. As simple as that. Is this clear, everyone? Okay, perfect. Now, one special case. So many special cases are there. In that, for you guys, from your examination perspective, what can be important is in case of semi-annual interest payment. In case of semi-annual interest payment, how should we do the calculation? Very simple. Just ensure uniformity in data. Previously, every calculation I was doing yearly. Here, now every data I will convert it into semi-annual. That is for a period of 6 months. Golden rule, ensure uniformity in data. That is, convert all your data into 6 months period. Yes, one example is there. Pay attention, students. Maja Limited issued a bond having a face value of 100 rupees. Great, boss. Interest rate is 10% per annum, which is paid semi-annually. Oh. Interest is 10% per annum. But how I am paying? Semi-annually I am paying. For every 6 months I keep paying. Okay, great, boss. Bond is redeemable at 120 at the end of year 2. Calculate intrinsic value if the required rate is 12%. Okay. Golden rule is uniformity in data. Do all calculation for a period of 6 months each. So now understand how am I going to do the calculation. Every data I want in terms of 6 months. Tell me, students, coupon, that is interest. Tell me how much is the interest? It is 10% per annum. But tell me, am I paying on per annum basis? No, sir. 6 months I am paying. That means for 6 months, how much it is? It is going to be 10 into 6 by 12. It is a 5% for 6 months. Yes or no, everyone? Perfect. Required rate, that is the discounting rate, also question has given 12%. Obviously, it is going to be per annum only. But tell me, how do I want? Every calculation I want for 6 months. So this is 12% per annum. It means it is going to be 6% for 6 months. Yes or no, everyone? This also is over. Life of the bond. Tell me, life of the bond is how much? Life of the bond is 2 years. But tell me here, how do I want? I want in terms of years. No, sir. I want in terms of 6 month period. That means tell me, students. 2 years are there. Year 1, year 2. Total how much 6 months period is there? Yes, 6 months period 1, 6 months period 2, 6 months period 3, 6 months period 4. 4 6 months periods are there. Yes or no, everyone? So life of the bond is 2 years, or else I can tell it is 4 periods of 6 months each. Is this clear? Obviously nothing to be by hearted. Just remember, yes, data should be uniform. Everything should be for 6 months. As simple as that. Now I will do the pictorial representation. Pay attention. Very simple. Yes, today I buy the bond. Yes, 1, 2, 3, 4. Life of the bond is 2 years, but I want in terms of 6 months period. There are 4 such period. Okay, boss. Tell me how much interest I am getting. 100 rupees is a face value. On that 5% I am getting interest for 6 months each. That is 5 rupees, 5 rupees, 5 rupees, 5 rupees. At the end of it, it will be redeemed at what price? 120 rupees. Yes or no, everyone? Yes, I will calculate the value of the bond. Yes, the discounting rate is going to be how much? The discounting rate is going to be 6%. As simple as that. So look at this. I will just tell. Okay, boss. Year 1 to 4. That is period 1 to 4. Instead of year, I will write period. 1 to 4, I am getting a cash flow of 5 rupees. And in 4th period, I am getting 120 rupees. Yes, present value factor at the rate of 6% I will be doing. I will accordingly arrive at the value of the bond. Is this clear? Simplest thing, just a simple rule, convert every data for 6-month period. That means my coupon rate, it will be given per annum. My required rate, discounting rate, it will be given per annum. Convert it into 6 months. Yes, years, life of the bond, it will be given in terms of years. I will convert it into 6 months period. Is this clear, everyone? Yes or no? Give me a confirmation, students. Okay, fine. So if that is over, the first point, bond valuation, is over. Simple jujube. Okay. Now some important points for us which is going to be important. Firstly, relationship between YTM and price. There is an inverse relationship. YTM increases means price will decrease. YTM decreases, price increases. YTM increases, price decreases. Inverse relationship. One more thing that we should be knowing. It is a relationship between my coupon rate, YTM, and price of the bond. Okay. Beautiful point. This is not very important for you guys from the examination perspective, but let me quickly try explaining without getting into much depth. Suppose your YTM is equal to coupon. Suppose there is a 1000 rupee bond. Yes, bond having a face value of 1000 rupees. Suppose coupon rate is 10%. Okay, fine. Assume YTM is also 10%. Yes, that means tell me, students. Yes, the moral of the story is bond is currently trading at par. Yes, now understand in a very simple way. I will try to explain. Yes, it is just a relationship. You have to remember it. Yes, YTM means it is the return. In that, two components will be there. One will be the interest component. One more will be the capital gain component. Is this clear, everyone? Tell me, interest is how much? 10%. Yes. Total return is also how much? 10% only. That means tell me whether capital gain will be there. No, boss. That means face value is 1000. At what price only it will be trading? It will be trading at 1000 rupees only. That is the moral of the story. Is this clear? If YTM is equal to coupon, that means bond is trading at par. Second case, if YTM is more than coupon, suppose my coupon is 10%. Okay, yes, interest that they are giving is 10% only. But boss, my YTM is 12%. That means total for me 12% return I am getting. That means 2% return I am getting in the form of capital gain also. Tell me, when will I be getting capital gain? When I buy the share, in this case bond, at a lower price and sell at a higher price, redeem at a higher price. That means right now when I am buying the bond, yes, 1000 rupees the redemption price. Yes, did I buy at 1000? No, boss, I purchase at a lower price. That is why I am having a higher return. Yes or no? So the bond is trading at a discount. Is this clear, everyone? Third case, YTM is less than coupon. Yes, coupon is 10%, but in reality, now my actual return I saw, I am not even having 10%, boss. I have 8% only. I am telling, how on earth can this be possible? 10% interest is there now, but I am having 8% only. Why? Because I had capital loss. How on earth did I have capital loss? Redemption was 1000 rupees, but I purchased at 1200. That is why I am having a capital loss. Yes, that means I purchased at a premium. Is this clear, everyone? Bond is trading at a premium. It's not very important for the examination, but still, quickly in 1 minute, I just tried explaining these basic ratios for you guys. Is this clear, everyone? Okay, fine. Next, one more point is there with that. Yes, concept number 1 will be over. Yes, it is the calculation of expected market price based on intrinsic value. Yes, in 3-4 places, what they have done is, question will ask you, calculate intrinsic value of bond. Point number 1. Point number 2, they are telling, yes, based on the intrinsic value, calculate the expected market price. If beta is 1.05 or 1.10, what we will have to be doing? Very simple. Yes, I will take intrinsic value of the bond into beta. It gives me the expected market price. Look at this very simple example. Intrinsic value of bond is 940. Okay. Calculate the expected market price if bond has a beta value of 1.1 due to its popularity because of lower risk. So what I will be doing, intrinsic value is 940 into 1.10. So it is 940 into 1.1. It is going to be 1034. It is the expected market price. Is this clear, everyone? Yes or no? Give me a confirmation, students. With this, our concept number 1 is over. Yes, a quick look into our summary chart. Look at this bond valuation or bond pricing. Very simple. Value. It is the present value of future cash flows. In this case, I will be having interest as well as redemption price. So it is present value of interest as well as redemption price. Okay, boss. So in case of redeemable bond, it is present value of interest plus redemption price. Irredeemable bond, I am only having interest, perpetuity I am having. So it is interest divided by KD. In case of zero coupon bond, there is no interest, only redemption price. So it is present value of redemption price. Additional point, yes, YTM and price, there will be inverse relationship. Yes, one more, yes, YTM as well as coupon. How to interpret that I told. Expected price is going to be value of the bond into beta. Is this clear, everyone? And one more point was there that I have not written, is it? Okay, in case of 6 months semi-annual interest payment, yes, convert every data for 6 months period. Is this clear, everyone? Giving you guys a minute to let this sink in, then we'll continue forward to the next discussion. Yes, everyone. So now let us go ahead to concept number 2. Beautiful Majja concept. Beautiful it is going to be. Yes, what is it? It is yield of a bond. Yes, what do you mean by yield? Yield means the return. Yes, if I buy a bond, actually how much return I am getting, that is the yield of a bond. Okay, everyone. So in these 3 terms we will be understanding. First is current yield. Second is YTM, yield to maturity. Third is going to be realized yield. In that the most important for us is going to be YTM. Yes, realized yield also, yes, sometimes I guess 1 or 2 examples it is there, but let us try understanding conceptually so that nowhere we commit a mistake. Okay. First, before we get into the game, yes, KD versus yield, whether both are same or both are different. Both are different. Yes, KD, it is the required rate. Yes, ideally how much return I want, that is KD, required rate. Yes, yield means what? It is the actual return. Yes, KD is telling, yes, ideally how much return I should be getting. Ideally how much I should be getting. Yes, yield is telling actually how much return I am getting. To give you guys a very simple example. Look at this. Suppose there is a bond. If you purchase the bond, first year you will get 10 rupees interest and it will be redeemed at 100 rupees. That means first year how much you will be getting, all in all 110. Assume your required rate is 10%. That means you discount it at required rate at 10%. You will arrive at the value of the bond, it is 100 rupees. So in simple terms, you invest 100 rupees today. At the end of first year, at 10%, you will be getting 110. So your required rate of return is how much? 10%. 10% ideally I want for the risk that I am taking. But assume you go to the market to purchase this bond. 100 was the intrinsic value. But you see, is actually this bond is trading at 105. That means tell me at what price you purchased? 105 you purchased. At the end of first year, how much you are getting? 10 rupee interest as well as 100 redemption price, 110 you are getting. That means your actual return is how much only? Yes, 105 you purchased, 110 you are redeeming. That means 5 rupees only you are getting on 105 rupees. That means your actual return is 5 divided by 105. It is going to be how much? 4.76%. Is this clear, everyone? Yes, KD, it is the required rate, how much return I want. Yes, yield is the actual rate, how much return I am actually getting. Is this clear, everyone? Okay, fine. Yes, now in that 3 different things are there. First is current yield, second is YTM, third is going to be realized yield. So in a detailed way, yes, what each of these things are, this bifurcation, all those things we have written. Trust me, yes, the notes that we are using is one of the most beautiful handcrafted notes. Yes, from the basics to the most advanced things, step by step, properly we have arranged and kept. Okay, so that even after the class, when you are doing self-study also, you can understand those things. With that, in the lowest possible pages, summary chart is also there, so that every chapter just in 5 to 6 pages we can quickly summarize as well. Now quickly let me try explaining, yes, current yield versus YTM versus the realized yield. Pay attention, everyone. Quickly let us try understanding this. Okay, yes, simple example. Assume there is a 10% bond having a face value of 100 rupees. Redemption price is 110. Yes, currently it is trading in the market at 95 rupees. Okay. Yes, I want to know the actual return. Yes, what is the formula of return on investments? Yes, it is the return divided by investment. Yes or no? Now tell me, I purchase a bond. When I am telling return, what all return can be there? Sir, 2 returns can be there, sir. What all return? Firstly, every year bond gives me interest, that is one return. Second return is there can be capital gain also, that is I purchase the bond at 95 rupees. At the end of the life, it is redeemed at 110, so that 15 rupees capital gain is also there. Yes or no? So I told, if I am buying a bond, 2 returns will be there. Every year interest I will be getting, and along with that capital gain will also be there. Yes or no, everyone? Perfect. So now first let us try understanding the first 2 terms, current yield, YTM. Yes, in the current yield, it is telling in the current period how much return I will get. Tell me students, I purchased bond at 95. Yes, I will redeem at 110. That is 15 rupees capital gain I will get. When will I get? I will get this 15 rupees only if I hold the bond till maturity. Assume the maturity is 5 years. That means in the current year, will I be getting this capital gain? No, boss. In the current year, what only I will get? I will get interest only. Is this clear? So in my current yield, I am only considering the interest component. Is this clear, everyone? Yes, my current yield is telling my interest is how much percent, how much return I am getting in the form of interest. Tell me students, at what price I purchased the bond? 95. Tell me how much interest I am getting. 10 percentage of 100. So 100 into 10 percentage, 10 rupees interest I am getting. I paid 95. That means how much return I am getting? 10 divided by 95 into 100. It is going to be 10.5%. Is this clear, everyone? That is going to be my current yield. So in the current yield, we are only considering the interest component. Is this clear? Yes. YTM, yield to maturity. Tell me, if I hold the bond till maturity, what all return I will get? Interest anyways I will be getting, but boss, with that capital gain also I will be getting. Yes or no, everyone? So in case of YTM, I will consider interest also plus capital gain also. Is this clear, everyone? Okay. This in reality how the calculation happen, we will discuss it later. Now look at this, coming to our concept register. Okay, in case of current yield, I am considering only the interest income. In YTM, I will consider interest also, capital gain also. Yes, current yield, it answers the question, how much interest income I am earning in relation to the market price. So look at this, only interest income I am considering. So what is going to be the formula? Interest divided by market price into 100. Is this clear, everyone? Perfect. Okay, so shall we continue further, students? Some additional points also I would have written, which is important for MCQs. Yes, one example is current yield of a zero coupon bond is 0. Tell me students, whether zero coupon bond pays any interest? No sir. It is issued at a deep discount, no interest. It is redeemed at par. That means tell me, zero coupon bond means there is no interest. That means yes, current yield, interest is 0. That means current yield will also be 0. Yes or no, everyone? Perfect. Till here is this clear? Now normally when I am talking about current yield, the retail investors like you and me, when we are purchasing a bond, just from our perspective we are thinking, okay boss, interest is how much percent? That's the thing. But in reality, when company is issuing or when big institutional investors are paying, yes, they look at the YTM, the yield to maturity. Yes, here what all they are considering? Here interest income is taken, but along with that capital gain is also taken. So what is my YTM? It is the annualized rate of return. Total every year how much return I am getting. Yes, assuming that the bond is held till maturity. Okay, YTM, yield to maturity, and all interim cash flows are reinvested at YTM rate. Now how do we calculate our YTM? So let us come back here. Let us try understanding how to calculate YTM. Pay attention, students. Realize YTM, all those things are okay, fine. Yes, YTM concept builder. So logically, let us try understanding. There is a formula you guys would have all seen. Yes, I into 1 minus T plus, yes, I guess RP minus NP divided by N divided by RP plus NP divided by 2 into 100. All these formulas you would have seen. So logically, let us try understanding. Pay attention, everyone. Logically, pakka, let us try understanding what exactly on earth is that formula. Okay. Simple example, Maja Limited issued a 10% bond. Great. Having a face value of 100. Okay. Maturity is 5 years. Yes. The bond is issued at 95 rupees. Great, boss. Redemption price is 110 rupees. Okay. Amazing. Calculate YTM. If I am holding till maturity, how much return I am getting? Okay, boss. Today I purchased the bond. At what price I purchased the bond? 95 rupees I purchased the bond. Yes, tell me 10% interest I will be getting. So every year 10 coupon I will be getting. It will be redeemed at 110 rupees. Great, boss. Now I want to calculate the return on investment. Tell me students, what is the simplest thing for return on investment? Return or income divided by investment. Yes or no? So in simple terms, I can tell it is income divided by investment into 100. Okay, ba. Tell me, I purchased the bond. What all income I am getting? Sir, two income I am getting. First one is interest. Tell me every year how much interest I am getting. 10 rupees interest I am getting. Yes or no, everyone? Yes. Any doubt? No doubt, sir. Pakka wa? Pakka, sir. So I will tell income for a year, interest income is 10 rupees. But now tell me, is this the only income I am getting? No sir, with this capital gain is also there na. Tell me how much capital gain I am getting. Sir, if I purchase a bond today, at what price I purchase? 95. At the end of 5 years, if I hold it till maturity, if I hold for 5 years, I can redeem at 110. That means how much capital gain I will get? From 95 it becomes 110. Sir, 15 rupees capital gain I will get. But tell me, I want the income for a year, for a period. 15 rupees capital gain, is it for a year? Sir, it is for full 5 years na sir. That means for 1 year, how much is capital gain? Sir, 15 rupees is for 5 years, sir. That means for 1 year, 3 rupees. Yes or no? So I will tell the capital gain is going to be 3 rupees. That means, can you tell me the total income is going to be how much? 13 rupees. Yes or no? Yes or no? Yes or no? Yes, sir. This is going to be the total income for the period. But tell me, is it the accurate income or is it the average income? Sir, it is just average income, sir. Why da? Sir, interest is pakka, sir. Every year, exact 10 rupees I am getting, sir. Pakka. But capital gain that I have done, na, it is just the average capital gain. Why? Because today I purchased at 95. At the end of 5 years, it is 110. That means 15 rupees capital gain I will get if I hold for 5 years. Not necessary every year 3 rupees I am getting. So all I have done is I have just averaged out. I have just tried annualizing it. Is this clear? Using the concept of averages. So tell me, what is my average income for the period? 13 rupees. Now tell me, yes, my YTM or return on investment. It is return divided by investment, which is nothing but return is nothing but income divided by investment. Tell me students, when I have taken income, did I take the exact income or did I take just the average income? I took just the average income. Why sir? Exact I cannot calculate sir. Because capital gain 15 rupees I will get only if I hold till maturity. So what I have taken, I have only taken the average income. Okay. So it is the average income. That means tell me, in my numerator income I have taken average. That means my investment should also be what? It should also be average only. Divided by average investment. Yes or no everyone? Perfect. So tell me students, average income. Yes, what is the average income for the year? It is going to be 13 rupees. Interest 10 rupee was there, this 3 rupees was there. That means it is going to be 13 rupees. So now let me try calculating the average investment. Tell me students, today you purchase a bond, at what price it is available? 95 rupees. At the end of the life, yes, at what price bond will be available? Suppose 5th year end, just 1 day before this I am paying for the bond. How much? Tomorrow it will be redeemed at 110. How much you will be willing to pay? 110 you will be willing to pay. So at the end of the life it will be available at 110. That means what is your average investment? It is a 95 plus 110 divided by 2. Not getting into too much depth. I am averaging out the investment. Today, yes, it is available at 95. But across 5 years, will it be available at 95 only? No boss. Yes, as every year increases, now the price of the bond keeps on increasing. Suppose I am standing here. Yes, 4th year is over. I am standing here. I am seeing. Yes, this bond is there boss in the market. Yes, next year it will give me 110 rupees as well as 10 rupees. Tell me, yes, I am standing here. In 1 year, the bond will give me 110 as well as 10 rupees interest. Am I willing to pay 95 only here or am I willing to pay more than that? In 1 year, it is giving me 120 cash flow. So obviously, I will be willing to pay more than that. So what it is telling is, yes, my investment is 95 here, but I want my investment till maturity. Yes, it will keep on changing because my bonds price will keep on fluctuating. So I want to just average out that. So I will take 95 plus 110 divided by 2. I will be getting the average 95 plus 110 divided by 2. I guess it is 100. So 13 divided by 100, it is going to be 13%. Is this clear everyone? Logically we did. Now let us try creating it in the form of a formula. Creating formula is the simplest thing in the world, students. Understand. Yes, I told YTM. It is a return. So I will tell it is average income for the period divided by average investment. Simple. YTM is return. Return, how will I get? Income divided by investment. Yes, actually accurate is there or just average is there? Average is there. So I will tell it is average income divided by average investment. Now how do I calculate the income? Simplest thing in the world. Tell me students, in income what all is there? Interest is there, capital gain is there. So I will take interest I. I want capital gain also. Tell me, how do I get the capital gain? Tell me, at what price I purchased the share? 95. At what price I am redeeming? 110. That means tell me total how much is the return? 15 rupees. Can I tell it is redemption price minus the net purchase price? RP minus NP. You can use other annotations. You can write it as RV, redemption value. Yes. Purchase price, PP, you can write. Whatever you want, you can write. Annotation is in your hands. Okay. So I will tell total capital gain is how much? Redemption price minus net price of purchase. 110 minus 95. Total 15 rupees return is there. But this 15 rupees is for how many years? 5 years. I want for 1 year. Divided by n, divided by 5 years. I got it as 3 rupees per year. Yes or no, everyone? So I will just write, yes, it is redemption price minus net price divided by n. That gives me the capital gain. So I got the total income for the period. Yes, I want to divide it by the average investment. How do I get the average investment? Yes, it is redemption price plus net price divided by 2. Yes, so I got my YTM formula. Is this clear, everyone? The simplest thing in the world. Obviously, yes, once now the formula will start making more sense as to why exactly the formula is the way it is. Is this clear, everyone? Pay attention, look at this, students. Yes, I have written down the formula. Yes, approximate YTM. So step 1, if at all we have a question wherein we have to calculate YTM. First step, I will calculate the approximate YTM using the formula method. So what is the formula? Yes, it is average income for the period divided by average investment. So income, first I will take interest plus capital gain. How do I get the capital gain? Redemption price minus net price divided by n. Divided by, I want the average investment. It is redemption price plus net price divided by 2 into 100. Is this clear, everyone? Perfect. Yes, where? Yes, when I am telling interest, it is the post-tax interest income. All I want cash flows. Yes. When I am telling redemption price, it is the post-tax redemption price. That is redemption price minus capital gain tax. Yes, we will be doing an example, don't worry. Yes, wherein NP, net purchase price, it is a net purchase price, that is purchase price plus incidental expenses, if any. Yes, N is the period to maturity. Is this clear, everyone? Give me a confirmation, accordingly we will continue further. Yes, everyone, but understand one thing, with this formula, the YTM that we calculate, it is not perfect. Why, sir, it is not perfect? Because yes, what I have considered is just the average income and the average investment. So it is just an approximation. Yes, and the institute tells for CA final students also, for CMA final students also. At the inter level, you can use formula method sufficient, but at the final level, institute is telling, boss, you are at the final level, boss, accurate, pakka YTM you should calculate. So then what to do, sir? So then what we did, this was this nonsense? No, it is useful. Using this, I will get an idea as to where my YTM will be falling. Suppose randomly I am telling, yes, using approximate YTM, I understood that my YTM is coming to 13.4%. So that means I got an idea somewhere in the range of 13 to 14 my YTM is falling. Now I want to calculate the exact YTM, the accurate YTM. Sir, what problem is there in this one, sir? This is approximate only, na, sir? Two problems are there. Yes, what all problems are there? Yes, why is it not accurate? Two problems. Firstly, capital gain calculation that I have done, that is just the averaging out. Yes or no? Second point, I have ignored time value of money. First year I am getting 10 rupee interest, fifth year I am getting 10 rupee interest. Both I have treated equally, but I cannot be doing. Why? Time value of money is there. So now keeping the time value of money in mind, keeping the present value concept in mind, I will calculate the accurate YTM. How do I calculate the accurate YTM? Accurate YTM. YTM is what? My return. So actually how much return I have got? How do I calculate? I know all my future cash flows. Yes, I know the investment I am doing. Yes, at which rate if I discount all my future cash flow, I will arrive at the market price of the bond. That is going to be the YTM. Basically my IRR calculation. Yes or no, everyone? So how do I calculate my accurate YTM? Yes, tell me in this case, first year, second year, third year, fourth year, fifth year, for all the 5 years, 10 rupee interest I am getting. With that 110 redemption price I am getting. Yes, I will bring all of them to the present value. Yes, at which rate if I discount, yes, the price will be equal to the price of the bond. Yes, that rate is going to be the exact YTM of the bond. Is this clear everyone? Yes, which is basically nothing but calculation of IRR. From inter days we have been playing along with this. Yes or no everyone? Yes, at which rate if I discount, I will get 95. That is my purchase price. That is going to be our YT. Okay, so let us try doing the calculation. Tell me students, in this case, how much I got my YTM as? I got my YTM as 13%. So let me do one thing. Let me try discounting my cash flows using 12% as well as 13%. Let me try seeing how it comes. Tell me year 1 to 5, 10 rupees interest I am getting. 5th year 110 redemption price I am there. Suppose I discounted 12%. Yes, my present value comes to 98.42. Suppose I discounted 13%. My present value comes to 94.9. Okay. Yes, it is coming close to 95 only. Small difference will be there. That's all. But we don't want any risk in the examination. That is why we are doing accurate YTM also. Tell me now what is needed is interpolation. Tell me students, if I discounted 12%, now how much is the value? 98.42. If I discounted 13%, the value is 94.9. So 12% anyways, yes, I am earning. Tell me if 1% I increase, then the price of the bond will reduce by how much? From 98.42 minus 94.9, it will reduce by 3.52. Yes, I want the value of bond to be how much? 95. That means I want the price to reduce by how much only? Yes, I want the price to reduce by 98.42 minus 95. I want it 98.42 minus 95. 3.42. I want it to reduce by 3.42 only. That means how much percent should I increase? It is going to be plus 3.42 into 1 by 3.52. 3.42 by 3.52 plus 12 comes to 12.97 percentage. Is this clear everyone? Yes, just giving you guys an idea. Yes, 1 or 2 examples are there wherein properly YTM will calculate. The accurate YTM also will be calculated. Is this clear everyone? So look at this, look at this, look at this students. Yes, how do I calculate YTM? 2-step framework. Step number 1, I will calculate the approximate YTM. How? Using the formula method. What is the formula? It is average income divided by average investment. Is it the perfect YTM? No, it is just approximate. Now once I have got an idea as to how my YTM rate, where my YTM is going to lie. Yes, one step beyond that, below that. Suppose I got it as 13.5. I will discount at 13% as well as 14%. Now I will, using interpolation, I will calculate the accurate YTM. Step 2, I will calculate the accurate YTM using IRR. Yes, YTM is that rate at which present value of all future cash flows. Yes, at YTM. Yes, present value of future cash inflows, if I discount, will be equal to the purchase price. That is present value of cash outflow. So at which rate it is happening, that is going to be the exact YTM. Is this clear everyone? Yes, it is calculated using IRR method. Is this clear everyone? Now some additional pointers for us for examination. Okay, firstly, marks will be allotted for calculation of accurate YTM only. So calculation of accurate YTM is compulsory. Okay, you cannot escape that. Point number 2, if 2 discounting rates are already given in the question, suppose there is a question on calculation of YTM. Question already told me, yes, 12% discounting rate, present value factor is this, 1 year, 2 year, 3 year, 4 year. Yes, 13% discounting rate, present value factor is this. Now tell me, why on earth am I calculating approximate YTM? Is it having marks? No, it is not having marks. Why? So that I can get an estimate of which present value factors to use. So if present value factors are already given in the question, then I can directly jump step 1. Step 1 is not needed because I need not estimate, question is only giving me. So directly accurate YTM only I will be calculating. Is this clear everyone? Okay, perfect. Third thing is YTM in case of irredeemable bond. Tell me students, in case of irredeemable bond, the only income I am getting is what? Interest. So I can tell, yes, YTM yield, it is nothing but income divided by investment. In case of irredeemable bond, I am only getting interest. And how much I have invested? It is a market price. It is interest divided by current market price into 100. Is this clear everyone? Next I am having, yes, YTM in case of semi-annual coupon payment, we will discuss it, and YTM in case of zero coupon bond also we will discuss. But before that, let us go into the questions. Okay, let us quickly have a look at the summary. Yes, we are discussing concept number 2, which is yield. In that first point was current yield, interest divided by market price. Second thing is YTM. I have told you two-step framework. Step number 1, I will calculate approximate YTM. That is average income divided by average investment. Step number 2, I will calculate accurate YTM using IRR technique. Is this clear, everyone? Perfect. So let us have a look at one or two examples so that things will be making more sense for us. Yes, everyone. So now let us do one thing. Let us get into an example. 2-3 examples, different variety examples let us do on calculation of YTM. Yes, one of the most expected questions for us in the examination. Okay, example, a 5-year 1000 rupees government of India bond pays 9% annual interest. 1000 rupees is the face value of bond, 9% annual interest it is paying. 5-year bond it is. So 5 years maturity. It is currently trading in the market at 950 rupees. Today at what price it is trading? 950 rupees. Calculate the current yield and YTM. Okay, boss. What's the first thing we have to be doing, boss? First thing we have to be doing is, okay, draw a line. Line should always be straight. Okay, tell me today at t is equal to 0. Yes, at what price I am purchasing the bond? Yes, purchase price is 950 rupees. At 950 I purchased. Tell me every year how much interest it is paying? 9% interest on 1000 rupees. 9% means 90 rupee. 1, 2, 3, 4, 5. 90, 90, 90, 90, 90 it paid. Okay, boss, perfect. At the end of the life, at what price we are going to redeem? Nothing is given. That means the default assumption is it will be redeemed at par. That means at 1000 rupees I will redeem. Is this clear, everyone? Okay. First thing is calculate the current yield. Current yield, only interest I am considering. It is going to be interest divided by current market price. Tell me interest is how much? 90 I am getting on 950. So 90 upon 950, it is going to be how much? 9.47%. Okay, next is going to be calculation of YTM. First one, let us calculate approximate YTM. Firstly, look at this, students. Even without writing down the formula, I can do it. Look at this, yield to maturity. Firstly, what all income I am getting? Boss, firstly, interest I am getting 90 rupees. Is this the only income? No, sir. Capital gain also I am getting. 950 I purchased. It becomes 1000. So total how much gain I will get? 50 rupees. 50 is for how many years? 5 years. That means every year is how much? 10 rupees. So total it becomes 90 plus 10,000. Yes, it is average income divided by average investment. Tell me at what price I purchase? 950. The value becomes how much? 1000. That means what is the average investment value? 950 plus 1000 divided by 2. It is 975. So you can do 90 plus 10, 100 divided by 975 into 100. You can get it as 10.25%. Or else in a detailed way we can write down the formula also. It is interest income, capital gain, which is redemption price minus net price divided by n, divided by average investment, which is redemption price plus net price divided by 2 into 100. Tell me interest income is 90. Yes, I purchased that 950, I am redeeming at 1000. So it is going to be 1000 minus 950 divided by 5 divided by 1000 plus 950 divided by 2. You simplify this, you will be getting 10.25% only. Is this clear, everyone? Okay, perfect. Approximate YTM I got, no issues. Now, will I be having marks for approximate YTM? No, boss. What I have to calculate? Accurate, exact YTM I have to calculate. Then why on earth I did this? So that I get an idea as to where my YTM will fall. This will give me 99% accuracy, boss. Somewhere 10.2, 10.3, 10.4 range only my YTM will be there. Okay, now tell me, I want to discount. Using which all rate I will discount? It is somewhere 10.25. So I will discount at 10%, 11%. I will see where it gets closer. Okay, so let me try doing that. Step 2 is calculation of accurate YTM. Tell me if I go for a bond, what all I am getting? 1, 2, 3, 4, 5. 90, 90, 90, 90, 90. Interest I will get 1000 rupees, redemption price I will get. So I will tell year 1 to 5, 90 I am getting, 5th year 1000 I am getting. So let me try discounting at 10% as well as at 11%. So tell me at 10%, 1 divided by 1.1 equal 0.620 MRC 3.791. So 90 into 3.791 equal 1000 into 0.621. Oh, this calculator doesn't even have grand total, because of it is taking time. Oh, I guess it is coming close to 1000 rupees if I am not wrong. 1000. Give me a confirmation, students. 90 into 3.791 M plus 1000 into 0.621 M plus MRC. It is 962.19. Yes or no? Perfect. At 11%. Same. 1 divided by 1.11. 1, 2, 3, 4, 5. Fifth year is 0.593. 3.6958696. Okay. 90 into 3.696. 1000 into 0.593. It is 925.64. Okay. Yes, my calculator is there in the office. Here I am having another calculator which doesn't have GT option. Normally ensure that you have a calculator which has GT, grand total option. Your calculation in SFM becomes very simple for you there. Otherwise, unnecessarily M plus, you will keep on playing with them. Okay, fine. Now, understand. Yes, I have to calculate YTM through interpolation. Simplest thing in the world. Look at this, students. If I am discounting at 10%, how much I am getting? 962.19. If I am discounting at 11%, how much I am getting? 925.64. Tell me how much I want to get. Tell me at what price it is at trading. 950. So I want to get 950. So I will tell very simple, boss. At 10%, 10% return I am getting. Boss. It's a bit more than 10% only I am getting. Yes or no? Somewhere between 10 and 11 I am getting. So how do we do this? Simplest thing in the world. Tell me, if I increase my rate by 1%. Yes, if I increase my rate by 1%. Yes, the value of the bond will reduce by how much? Yes, from 962.19, it will come down to 925. 962.19 minus 925.64. Value will reduce by 36.55. Yes or no, everyone? Perfect. I want my value to reduce to how much? Yes, assume I am standing here always. Yes, I am standing at the lower rate. Here I am standing. Yes, my value right now is how much? 962.19. Where I want it to come? I want it to come to 950. That means 962.19 minus 950. I want it to reduce by 12.19 only. That means how much percent I should increase? Okay, simple. It is only telling I should increase how much percent? 12.19 divided by 36.55. 36.55. It is going to be 10.33%. It is going to be the accurate YTM. Is this clear, everyone? Give me a confirmation, students. So this was giving me somewhere 10.25%. Accurate is 10.33%. Is this clear? I hope the calculation of YTM is clear for you guys. Give me a confirmation, everyone. Accordingly, we'll do one more question where capital gain adjustment and all is also there. Yes, everyone. So let us do one more example. Beautiful Maja question. Okay, wherein we are having tax rates also. Beautiful, crazy. Okay, high likelihood of a similar question coming in your examination. Maximum adjustments have incorporated it. Look at this. A 4-year 1000 rupees bond offers 10% annual coupon. Okay, boss, great. It is available in the market at 900 rupees. Okay, incidental expenses on purchase is 5% of market price. Great, crazy. Investors tax rate is 30% on interest and 10% on capital gain. Calculate current yield as well as YTM. Firstly, current yield, simplest thing in the world. Tell me what is current yield? Yes, it is going to be interest divided by current market price. Tell me how much is going to be my interest? Interest is going to be 1000 into 10%. 100 is the interest. Tell me what is the current price right now at the time of purchase? How much I have paid? It is available at 900. 900 rupees I am paying for that. But 5% incidental expenses also I should be paying. So total how much amount I have invested? 900 plus 5%. 945. Yes or no? Yes, current market price. Now or alternatively you can keep it 900 also. Doesn't make much of a difference. Okay, like this adjustment is nowhere there in the institute book, so there is no standardization. However you want, you can be doing it. Okay, yes, now comes calculation of YTM. This is where you have to be very careful, students. Okay, yes, are you ready for the Maja? Yes sir, we are ready for the Maja. Okay, first let me write down the detailed formula. YTM, it is average income divided by average investment. Let me elaborate and write. I interest, capital gain, yes, it is redemption price minus net price divided by n. divided by redemption price plus net price divided by 2 into 100. Okay, this is where we have to be careful. So many places tax adjustment is there. Always understand, students, in finance, everywhere what I want is the cash flow. Net cash, how much I am getting. Simple. So in case of interest, tell me, students, yes, what is the face value of bond? 1000 rupees. How much interest it is giving me? 10%. So how much interest I am getting? Yes, 100 rupees interest I am getting. But the moment I get the interest, in one hand I got 100 rupees. Who is standing here? Nirmala Thai is standing here. Cash is coming. What she wants? She wants tax. How much tax she wants? 30% on interest. So 100 rupees I got. The moment I got, who is standing and saying, Nirmala Thai is standing and saying, 30% tax I paid. That means net how much cash only I got? 70 only I got. So whenever I am telling interest, it is always interest post tax. Is this clear, everyone? Okay, perfect. Yes. Next thing comes the net purchase price. Yes. Whenever I am telling net purchase price on the maturity date, sorry, net purchase price, it is a purchase price. Okay, fine. Tell me at what price I have purchased the share. Today in the market I go, yes, share is available at 900 rupees. So I thought, okay, 900 I pay, I will get the share. 900 I paid. Did they give me the share? No. They are telling, boss, wait. Incidental expenses is also there, which is how much? 5%. That also you pay. So total how much I am paying today? Yes, 900 anyways I am paying. Plus 5% incidental expenses also I am paying. So it is 900 plus 5%. It becomes 945. Is this clear, everyone? Okay, perfect. Next, third thing is capital gain tax. Tell me, students, at what price, yes, the bond is available today. Yes, 900 rupees is the bond price. Yes or no, everyone? Perfect. Yes, redemption is going to be at what price? 1000. So tell me total how much capital gain is there? 100 rupees capital gain is there. La 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 la, Maja is coming. We were very happy telling, boss, the 100 rupees capital gain is there. Yes or no, everyone? I will do one thing. Let me just ignore this incidental expenses part. Okay. Otherwise, you guys would be doubtful throughout. This adjustment is nowhere there. Just I created out of the blue myself. Okay. Because once this comes, your mind at different places, should I consider incidental expense, should I not consider? Different place, different probability will start coming. Let me ignore that. Let me keep it plain simple. Okay, everyone. Okay, that adjustment was nowhere there in YTM. So let us not get into that. Okay, fine. Capital gain. Tell me, students, at what price I have purchased? 900. What is the redemption price? 1000 rupees. How much capital gain was there? 100 rupees capital gain was there. Yes, we were very happy. What we were singing? La 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 la. Maja is coming. That time who is standing and saying? Nirmala Thai is standing and saying, capital gain. 100 rupees. Where is the tax? How much tax she wants? She wants 10% tax on the capital gain. So tell me, what was my capital gain? Yes, I purchased at 900. I am selling at 1000. 100 rupees capital gain was there. On that 10%, 10 rupees capital gain tax you took. That means tell me on the redemption date, net cash, how much only I am getting? Boss, bond is redeemable. The moment bond is redeemable, okay, yes, company is paying me 1000 rupees redemption price. But when I am trying to take it into my pocket, am I in a position to take it? No, boss. Nirmala Thai is telling 10 rupee capital gain tax, you give it to me. So that means net cash, how much only I got? It is redemption price minus capital gain tax. 1000 I was supposed to get, but 10 rupees capital gain tax I paid. So net 990 only I got. This is how I will be calculating my redemption price. Always, before you calculate your redemption price, calculate the capital gain tax and keep. And here you just do redemption price minus capital gain tax. Is this clear, everyone? Okay. Years to maturity. How many years is there to maturity? 4 years. Yes, now that these numbers are clear, yes, aram se I can calculate my approximate YTM, accurate YTM. Only this was important. Now tell me, how do I calculate? Tell me, students. Interest, 100 rupees I got, but 30 rupees tax I paid. So net 70 only I got. Redemption price, net, did I get full 1000 rupees? No, boss. 10 rupees capital gain also I paid. Now that means 990 only I got. Yes, minus purchase price was 900. So 90 rupees capital gain is there for how many years? 4 years. Yes, that comes to 70 plus 90 by 4 is going to be 22.5 divided by, yes, average investment. Yes, it is going to be 900 plus 990 divided by 2, which is going to be how much? 900 plus 990 divided by 2. Is it 945? So it is 70 plus 22.5, 92.5 divided by 945 into 100. It is going to be 9.78%. This is the approximate YTM. Using this accurate YTM I have to calculate. I will discount at 9%, 10%. Yes, I will interpolate accordingly, arrive at the accurate YTM. Is this clear, everyone? Give me a confirmation, students. Okay, perfect. So this was the concept of YTM. Now one more example is there, which is YTM in case of semi-annual coupon payment. Quickly I'll tell calculation and all those things, you guys take care of it. Look at this, students. A 2-year 1,000 rupee bond carries a 10% coupon paid semi-annually. Oh, how are we paying? Every 6 months we are paying. It is trading at 970 rupees. Calculate current yield and YTM. Current yield, anyways, it is simple. Tell me current yield. Yes, I am paying 10%. Yes, 10% is per annum. That means for 6 months it is going to be 5%. Yes or no? So how much interest I am paying? 1000 into 5%. 50 rupees I am paying on 970 rupees. That means how much is the return? 50 divided by 970. It is going to be 5.15% for 6 months. That means if I want it on per annum basis, into 2 I will do. It is 10.31% per annum. Current yield. This is not a big deal. Yes, the most important thing is calculation of YTM. Simple, uniformity of data. Every data has to be uniform. That's all. Now understand, yes, how will I be doing the calculation? Yes, YTM formula method. It is average income for the period divided by average investment. Okay. Every calculation I should convert it into a period of 6 months. Tell me interest. Yes, coupon payment was how much? It was 10% per annum. That means effectively it is 5% for 6 months. So on 1000 rupees it is going to be how much, dear? Yes, it is going to be 50 rupees. Is this clear? Yes. N, time to maturity. Question is telling it is 2 years. I will convert into 6 months period. That means it is going to be 4 period of 6 months. Is this clear? Accordingly I will do. Look at this, students. Yes, tell me average income for the period divided by average investment. It is interest plus redemption price minus net price divided by N divided by redemption price plus net price divided by 2. Yes, tell me 1000 rupees. How much I am getting? 50 rupees coupon I am getting. Yes or no? Plus redemption price is going to be how much? 1000 rupees. Today it is trading at how much? 970 rupees. Capital gain is going to be how much? 30 rupees. 30 rupees is for 2 years. That means 30 rupees is for 4 period of 6 months each. Yes or no? Divided by 4. Divided by average investment is 970 plus 1000 divided by 2. Comes to 30 by 4 is 7.5 if I am not wrong. 57.5 divided by 970 means 985. 57.5 divided by 985. I guess it is 5.83% or 5.84%. Yes, now comes the most important thing, students. Pay attention. Yes, this YTM that I have calculated, tell me, students, this income that I got is for full year, is for 6 months. It is for 6 months. That means the yield, the return percentage that I have got, that is also for 6 months. Yes or no, everyone? Perfect. If I want to convert it into per annum, how will I convert? Simple. 5.84% is for 6 months. That means into 2, I will be getting 11.67% per annum. Is this clear, everyone? Perfect. Now here I have done approximate YTM using same principle. Accurate YTM also I will be doing. In case of accurate YTM, what I will be doing? Same thing I will tell. All calculation will be for 6 months period. First period 50 interest, 50, 50, 50. 1000 redemption price will be there. Yes. Again, when I am discounting, it is for 6 months period. There I got some 5.3%. I will discount using 5%, 6%. Accordingly, yes, I will interpolate and arrive at the YTM. Is this clear? Once I have arrived at my final YTM, now I will convert it into per annum basis. Yes, simple lesson for us. Look at this, students. Whenever I am having semi-annual interest payment, uniformity of data, everything should be for a period of 6 months. Do all calculation for a period of 6 months. So interest will also be for 6 months. Years to maturity will also be in terms of 6 months period. So once I do all the calculation, I will get my YTM. That YTM will be for the 6 month period. Now I have to, in the end, last step, I will convert my YTM into per annum basis. Is this clear everyone? Give me a confirmation. Yes everyone, so now we have one final point in case of YTM, that is YTM in case of a zero coupon bond. Sir, what on earth is it, sir? So there is a zero coupon bond. Tell me, in case of zero coupon bond, is there interest? No sir, there is only redemption price. Okay, so how do we calculate YTM? Normal approach is there. If you want normal approach, you can follow, but there is a shortcut also. Quickly, takka, we can get the answer. Sir, what is normal approach? Step 1, calculate approximate YTM. Step 2, calculate accurate YTM. Let me see the example. Accordingly, I'll tell. Now look at this, students. Example number 11 we are having. A zero coupon bond having a face value of 10,000 is currently trading at 7,000 in the market. Okay, great boss. Bond will mature after 5 years. Yes, calculate current yield and YTM of the zero coupon bond. Tell me, zero coupon bond, is it paying any interest? Interest divided by current market price? No. That means 7,000. Yes, current yield is going to be 0. Okay, perfect. Now YTM I want to calculate. Now understand, yes, either approach number 1, detailed approach I can go. That is, first I will calculate approximate YTM, average income by average investment. Using that accurate YTM I will do. All those things I will get. But there is a shortcut also. Sir, what shortcut is it, sir? Simple, understand students. Tell me. Today, yes, I am standing here. At what price bond is available? 7,000. So if I invest 7,000 today I purchase bond, how much I paid? 7,000. At the end of 5 years, till 5 years, in between, will I be getting any cash flow? Nothing I am getting, sir. But at the end of 5th year, how much amount I will get? Yes, it will be redeemed at par. 10,000 I will be getting. Yes or no, everyone? We know present value to future value. Yes or no? Yes, present value into 1 plus r to the power t gives me future value. Tell me, into 1 plus r to the power of how many years compounding is there? 5 years. I am getting 10,000 value. So a very simple thing. Yes, we know, boss, we know that. Look at this, everyone. Present value into 1 plus r to the power of n gives me my future value. Today I invested 7,000. Yes, 1 plus r to the power of 5. 5 years if I compound, I am getting 10,000. Yes, what on earth I want? I want to know this r. That only is my actual rate of return. That only is my YTM. Yes or no? Now how do we calculate, sir? Simplification, let us try doing. Okay, if you want, you can create a formula out of this also. It is future value divided by present value to the power of 1 by n minus 1. Who nonsense wants to remember the formula? Okay, look at this. Aram se GGB things, we'll do it. If there's something which is really technical, we'll by heart and keep. Okay, yes, 99.9% things are simple basic GGB maths, which we can do it without by heart. Look at this. What I will do? Here 7,000 is getting multiplied. I will take it to the other side, becomes divided. So 1 plus r to the power of 5. It is 10,000 divided by 7,000. Yes or no, everyone? So let me write down the number and keep 10,000 by 7,000. It is going to be 1.4285. 1.4285. Till here is it okay? Okay. Now tell me, here it is 1 plus r to the power of 5. Yes, I want to eliminate this. How do I eliminate this? Both the places, I will multiply the power with 1 by 5. So what will happen? Understand. Yes, here it will get multiplied by 1 by 5. Here also it will get multiplied by 1 by 5. 5 gets cancelled. I will be having 1 plus r. There it becomes 1.4285 to the power of 1 by 5. Is this clear, everyone? Simple logic. Understand. Here into was there. There it becomes division. Here plus was there. There it becomes a minus. Yes or no? So here to the power of 5 is there. I take it to the other side. It becomes inverse. Always ulta it becomes. So what will happen? Therefore 1 plus r is equal to 1.4285 to the power of 1 by 5. Till here, are you guys clear? Yes, sir. So therefore 1 plus r is equal to 1.4285 to the power of 1 by 5 is nothing but point. Is this clear? Till here, are we on the same page? Yes, sir. Simple JUJB 3rd standard maths. Nothing more I did. Is this clear? Yes. Just remember, here power is there. Power goes to the other side. It becomes 1 by power. Okay, fine. Now, how do we calculate, sir? How on earth will I calculate this? Yes, there is the concept of dirty power. Yes or no, everyone? Yes. Sir, we don't remember, sir. Don't worry, I'll tell you. Yes, simple. Take your calculator. Okay. Write down the base number. Write down the base number in the base. Yes, which is 1.4285. What you have to do? 15 times press square root. Yes, where is square root in this? Okay, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 15 times we press, sir. What we have to do? Minus 1. Okay. Next, sir, into power, that is my power is 0.2 into 0.2. Next, sir, plus 1. Next, sir, into equals 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Hopefully let it be fine. Okay, I'm just hoping that this number will be correct. So I got the answer as 1.0739. Okay, this is the value of 1 plus r. Therefore, what is the value of r? Yes, 1 goes to the other side, it becomes 0.0739. It is in terms of decimal, that is r is equal to 7.39%. Yes, this is going to be the shortcut. Is this clear, everyone? Simple. How to do dirty power in terms of steps? First, write down the base number, press square root. You can do it 12 times, 14 times, 15 times. 15 times gives you the maximum accuracy. Do a square root 15 times. Yes, minus 1 into power plus 1 into equals 15 times. You will be getting the value. Is this clear, everyone? Sir, we don't want to get into all these things, sir. Is there a formula we will by heart and keep? Yes, the formula is there. Look at this. Value of r is equal to, I guess, future value divided by present value. Yes, to the power of 1 by n minus 1. If you want by heart and keep. Who wants to keep this? This is simple. Present value into 1 plus r to the power of n is equal to future value. Same thing, only they have played. Is this clear, everyone? Okay. Using this, quickly I can get the answer. Otherwise, approximate YTM, accurate YTM, discounting rate, all those things we have to do. Here, aramse we can be getting it. Is this clear? And institute has followed this approach only. So it is better that we follow this approach only. Is this clear, everyone? Okay. So quickly let us summarize what we have discussed in terms of YTM. Okay. So yield, that is the actual return. Two things can be there that we have discussed. One is current yield. My interest is how much percentage of price. One is YTM. It includes interest also, capital gain also. Yes. Now, first step is going to be approximate YTM using formula method. Simple thing is, it is average income divided by average investment. How do I get average income? It is interest plus the average capital gain, which is redemption price minus purchase price divided by n. Yes or no? So the formula is going to be interest plus redemption price minus net price divided by n. That gives me average income divided by average investment, which is redemption price plus net price divided by 2 into 100. Where I, it is the post-tax interest income. Yes, redemption price, it is the post-capital gain redemption price, which is redemption price minus capital gain tax. Yes, net purchase price, it is purchase price plus incidental expenses. Is this clear? Once I have got approximate YTM, accurate YTM also I will calculate. How? I will discount at two rates. Yes, at which rate it becomes equal to my current market price, that is my YTM. Interpolation technique I will be doing. Is this clear? Some additional notes. YTM for irredeemable bond. Irredeemable bond, only interest I am getting. So it is interest divided by current market price. Yes, YTM in case of a zero coupon bond. Yes, either long procedure I can follow or dirty power is there. Yes or no? It is present value into 1 plus r to the power n is equal to future value. Present value, that is my market price is given. Future value, redemption value at par is given. N number of years is given. R using dirty power I will calculate. Is this clear, everyone? Yes, in case of semi-annual interest payment, YTM. Yes, do all calculation for 6 months period. Interest also you will do for 6 months period. Year also you will calculate in terms of 6 months period. Do all calculation. You will get YTM for 6 months. Last step, convert it into per annum basis. Is this clear, everyone? Any doubts till now? Shall we continue our discussion? Yes, everyone. Now understand, yes, there is one more concept called as the realized YTM. Now YTM, it is the yield to maturity. Yes, it is based on two main assumptions. First assumption is that investor will be holding the bond till maturity, till redemption. In reality, not necessary. Second assumption is that every interim cash flows are reinvested at the YTM rate. Now, not getting into too much discussion on what exactly it is. Okay. Now, throughout, yes, whenever I am doing present value factors, it is using compound interest. Yes or no, everyone? Tell me, students, normally I am telling, okay, suppose today at t is equal to 0, 100 rupees I invested. At the end of 2 years, how much I am getting? Assume at 10%. What I will do? 100 into 1.1 whole square. So 100 into 1.1 into 1.1, 121. So what I have done, I have taken compound interest, that is every interim cash flow I am reinvesting at the same discounted rate. So YTM also is assuming the same thing. Every interim cash flow I am reinvesting at YTM rate, not getting into too much explanation. But in reality, not necessary that should be the rate. Yes. In that case, we have something called as a realized yield or realized YTM. Quickly, just the calculation I will tell you. Okay. So in simple, YTM means it is the theoretical return. Company is telling, boss, if you hold till maturity and every interim cash flow, if you reinvest at same YTM rate, this much return you are getting. But realized yield, that is the actual return that the investor is getting. Is this clear, everyone? Okay, perfect. So how do we do the calculation? Very simple. One workbook, example I'll show. Simple, quickly realized yield calculation will get over. Look at this, everyone. Yes. Maja Limited issued a 10% bond. Okay, great. Having a face value of 1 lakh. Okay, amazing. Maturity of 3 years. Great, boss. Bond is issued at 1 lakh rupees only. 1 lakh rupees only we issued the bond. You are required to calculate the following. First one is YTM of bond. Yes, now in this case, YTM aram se quickly we can do. Sir, how, sir? Yes, tell me, coupon is how much? 10%. Yes, YTM, sorry. Okay. Face value is how much? 1 lakh rupees. Bond is issued at what price? 1 lakh rupees only. Is there a premium? No. Is there a discount? No. That means, is there a capital gain? No. That means, how much is a coupon? 10%. That means, YTM should also be how much? 10% only. Yes or no? Go back to the basic ratios. Tell me, bond is issued at 1 lakh. Redeemed is also at 1 lakh only. So capital gain is equal to 0. Yes or no, everyone? Tell me, coupon is 10%. I told you, in YTM, what all return I am getting? Interest also I will get, capital gain also I will get. Here capital gain is 0. That means only interest I am getting. Interest is how much? 10%. So my YTM is also going to be 10%. Okay, this is one basic thing we should be remembering. Sir, I don't remember, sir, what to do? Okay, you know the normal way of calculating YTM. Step 1, approximate YTM. Step 2, accurate YTM. Do that. You will get 10% only. No need to worry. Is this clear, everyone? Okay, fine. Second requirement, calculate the realized yield. Okay. If interim cash flows are reinvested at 7%. Yes, third one, interim cash flows cannot be reinvested. Okay. Now, directly with this example only, I am going to explain you guys the concept of realized yield. Okay. Yes, it is already late, not getting into too much technicalities, and in our entire study material, only one question is there. Okay. But from a conceptual perspective, it's a beautiful concept. Understand what is happening. Okay. Bond is there. Yes. Let us draw from scratch. Okay. Let us draw a line. Line should always be straight, sir. Okay, fine. Tell me, how much is the life of the bond? I guess life of the bond is 3 years. Face value is 1 lakh. Then coupon is 10%. Okay, great, boss. 0, 1, 2, 3. So what all cash flows I am getting? Tell me. First year, 1 lakh is a face value. So 10% of that, 10,000 interest I got. Second year again 10,000 interest I got. Third year again 10,000 interest I got. It will be redeemed at 1 lakh rupees. Yes, for calculation of realized yield, simple philosophy, simple crux you have to remember. I will take all cash flow to the last date. Tell me, what is the last date? This is the last date. I will take all my cash flows here. Yes, first year 10,000 rupees I got. Yes or no? Yes, assume I am the company or the investor. You purchased the 1 lakh rupees bond. First year, yes, I gave you 10% to coupon. That is 10,000 in coupon I gave you. You are having that 10,000 rupees with you. Yes, you are having that money. What you will do? You will reinvest. At what rate you are reinvesting? Look at this situation. Yes, calculate realized yield. Situation 2. If your interim cash flows are reinvested at 7%, you are telling, you looked in the market. You were thinking 10% I can reinvest. That was YTM's assumption. But you are seeing in the market only 7% is there. So what you will do? Yes, this 10,000 rupees you will reinvest at 7%. So what will be the value? You will tell 10,000 into 1.07. For how many years you are reinvesting? Yes, you are standing here. 1 year, 2 year. So to the power of 2. So how much you will be getting? 10,000 into 1.07 into 1.07. Just pictorially I am trying to explain to you guys. Format also will do, don't worry. It comes to 11,449. Now second year again you got a coupon of 10,000 rupees. But you want to take all cash flows to maturity. So you will reinvest. At what rate you are reinvesting? Yes, you wanted to reinvest at 10% YTM rate, but boss, opportunity is not available, only 7% is available. So you will invest at 7%. 10,000 into 1.07. For how many years? 1 year only, to the power of 1 comes to 10,700. So can you guys tell me at maturity, total how much cash flow I am getting? 10,000 was there, 1 lakh was there. Yes, second year cash flow I brought here, first year cash flow also I reinvested, brought here. So can you guys add and tell me the total value here at maturity? It is 1,10,000 plus 11,449 plus 10,700. Is it coming to 132,149? Yes or no, everyone? Perfect. Now the same, this is what I have done pictorically. I will be doing it in the form of a table. Look at this, students, pay attention. Yes, calculation of step 1, calculation of total amount at maturity. Year cash flow, balance years, total amount at maturity. Look at this, how we are going to do the calculation. Yes, tell me, first year how much cash flow I got? 10,000. Second year 10,000. Third year 1,10,000. Now how many balance years are there? Suppose first year I got cash flow. For how many years I can reinvest? Sir, 2 years, sir. 1, 2. Okay, so 2 years are pending. Second year I got cash flow. For how many years I can invest? Sir, 1 year is pending, sir. Suppose third year I got cash flow. I want at the last date. For how many years I can invest? Sir, 0, sir. Today only I want the cash. Okay, great. 0 year. So when I reinvest, how much return I will get? 10,000 into 1.07 whole square. 11,449 it will be. Here 10,000 into 1.07. It becomes 10,700. Third case is 1,10,000 is there. I am not reinvesting. So I will be having 1,10,000 only. If you want, you can do 1,10,000 into 1.07 to the power of 0. Now don't make it 0. Anything to the power of 0 is 1. Okay. So basics, third, fourth standard math should be clear, or else you can just leave it, because here only I am standing, boss. I am not reinvesting. This much only amount will be there. Okay, fine. Great. 1,10,000. You add all of this, you are getting 132,149. Okay. Now look at this. Look at this. Yes. Now again my dirty power will come into picture. So what I am telling that, boss, today at t is equal to 0, how much I had invested? How much I had invested in the bond? Issued at 1 lakh rupees. 1 lakh I had invested in the bond. Yes or no, everyone? Today 1 lakh I had invested. At the end of 3 years, total how much value I am getting? 132,149 I am getting. That means effectively how much return I am getting. Look at this, everyone. I am telling very simple point. Pay attention. T is equal to 0. 1 lakh I invested in a bond. Today 1 lakh I put in a bond. I am telling all interim cash flows. Don't give me anything in between. Reinvest. Last date, tell me how much I am getting. Third year I am getting 132,149. Yes, that means I want to know at what rate I am getting the return. Yes or no? Into 1 plus R. For how many years we are reinvesting? 3 years. So simple, we have the formula. Present value into 1 plus R to the power of n is equal to future value. How much I invested today? 1 lakh. 1 plus R. For how many years we reinvested? 3 years. Yes, total at the end of the life, how much I got? 132,149. So can I tell 1 plus R to the power of 3 is equal to, this comes this side, into becomes a divide, yes or no, everyone? So it becomes 1.32149. Now here I am having to the power of 3. I want to eliminate, so it becomes inverse of that. So 1 plus R is equal to 1.32149 to the power of 1 by 3. Yes or no, everyone? 1 by 3, can I write it as 0.333333? Okay. Now I have to do this calculation. How to do, sir? Simple, sir. We know, sir. Dirty power, dirty. Do the calculation. Da. First, write down the base 1.32149. Square root 15 times 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 minus 1 into power, which is 0.3333. Take it to end of the calculator. Write down 12 times. Okay. Plus 1 into equal 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Yes, how much you are getting? 1 plus R. 1.0973. Therefore value of R is going to be 0.0973, that is 9.73%. If you want, you can get the proof also. That is, you reinvest 1 lakh at the rate of 9.73%, you will be getting this value only. If you want, you can check. Yes or no? So it is 1 lakh plus 9.73% plus 9.73% plus 9.73%. You are getting close to that only. 1,32,122 you are getting. Is this clear? That is your realized yield. Now I have not gone into the depth of logic. Just quickly I have told you how to calculate realized yield. Look at the steps, students. Yes, very simple to calculate realized yield. Just remember, take all cash flow to the last date. Is this clear? Using my actual reinvestment rate. That is, all interim cash flow I will take to maturity. In the last date, what is the total cash flow is there, I will see. So step number 1, calculation of total amount at maturity. Year cash flow, how many balance years are there? Total amount at maturity will be there. Yes, now using that, once I got what is the total amount at maturity, yes, now I will calculate the actual rate, the realized yield, using the concept of dirty power. That is, I will tell present value into 1 plus r to the power of n is equal to future value. This I will simplify, I will arrive at the value of r. Is this clear, everyone? Dirty power steps I will be using. Is this clear, everyone? Okay. Now in that, one more point is there, students. That is, quickly, just a minute, I will take from you guys. Yes, if interim cash flows cannot be reinvested, sometime question tells you that interim cash flows cannot be reinvested. That means, tell me what is my reinvestment rate? 0%. I cannot reinvest only. Yes or no, everyone? In that case, what will be the situation? Look at this, students. First year 10,000 I got, second year also 10,000 I got, third year 1 lakh plus 10,000, 1.1 lakh I got. Tell me, if question tells at 10% I reinvested, at 15% I reinvested, at that rate I will reinvest. Question is not telling anything, or question is telling it can't be reinvested. That means there is no opportunity available. I cannot reinvest. So reinvestment is 0%. Tell me 10,000 rupees is there. Yes, I invested 0% for 2 years. How much only I am getting? 10,000 only I will get was. Yes, into 1 plus r, 1 plus 0, 1 to the power of 2, it is 10,000 only. Yes, here it is 10,000 into 1 to the power of 1, it is 10,000. Basically, there is no income. Yes, this only amount will be going to maturity. Yes or no? Using this, I will calculate the realized yield rate. Is this clear, everyone? Give me a confirmation, students. Is this clear? Perfect. So let us quickly revise the concept of yield. With that, we will end this session. In the next session, we will continue further. Okay? Aram se just 1 minute first to revise. Yield. 3 things are there. Current yield, YTM, realized yield. Current yield, only interest I am taking. It is interest divided by current market price. Yes. Next is YTM. Interest also I am taking. Capital gain also I am taking. Yes. Now, how do we calculate YTM? Step 1, approximate YTM I will calculate using formula method. It is average income divided by average investment. Average income, interest is there, plus average capital gain, which is redemption price minus net price divided by n. Divided by average investment, it is redemption price plus net price divided by 2 into 100. Is this clear, everyone? Where interest, I will be taking post-tax interest. Redemption price, it is redemption price minus a capital gain tax. And net price, it is purchase price plus incidental expenses, if any. Once I have got the approximate YTM, yes, using IRR concept, I will calculate the accurate YTM. That is, present value of cash inflow should be equal to the current market price or present value of cash outflow. Is this clear, everyone? Some extra pointers. YTM for irredeemable bond. Irredeemable, only interest I am getting. So it is interest divided by current market price. Yes, YTM in case of a zero coupon bond. Either long approach I can follow or shortcut is there. What is shortcut? Yes, it is a concept of dirty power. Yes or no? Present value into 1 plus r to the power of n is equal to future value. Today's price is given. Future value is face value, redemption price. 1 plus r I will calculate. Yes or no, everyone? Next is in case of semi-annual interest payment. Yes. Crux, do all calculation for 6 month period. Interest also should be 6 months period. Years, that also I will be converting it into 6 months. In the end, I will get YTM for 6 months. Last step, convert it into per annum basis. Is this clear, everyone? Perfect. Next thing is calculation of realized yield. Simple point. Take all cash flows to last date. Yes, you reinvest using the actual reinvestment rate. I've got all cash flow at the last rate. Yes or no? For that, we have the format year, cash flow, balance years, total amount at maturity. Now, yes, I know that present value into 1 plus r to the power of n is equal to future value. Present value, it is the price of the bond, today I invested. Future value, total amount at maturity. Or I want to know, using dirty power, I will be calculating. Is this clear, everyone? If reinvestment is not possible, that means reinvestment rate is 0%. Is this clear, everyone? I hope this is clear. So in today's session, till now what all is over? Equity valuation fully is over. Okay, valuation of equity shares, dividend based valuation, yes, other methods of valuation, that was over yesterday only. Today we went into special areas. In that, first we discuss bonus shares, next we discuss buyback of shares, next we discuss right shares. Then we started with bond valuation. In that, okay, unit number 1, first was bond valuation. How do I calculate value of bond? Present value of interest plus redemption price. Next we went into concept 2, which is going to be YTM, yield. In that, current yield, yes, YTM, as well as we have discussed the realized yield. Okay, now there is one more concept, which is the concept of spot rate versus forward rate, spot interest rate versus forward interest rate. I will not be discussing it here in the revision, yes, because IRRM basics only, that thing is. Again, yes, only one example is there, again not very important from the examination perspective. Also, yes, if you want, you guys just revise it yourself. Okay, in tomorrow's session, yes, we will be taking our discussion forward and going into beautiful concepts of duration, yes, immunization, convertible bonds, etc, etc, etc. Oh, it's a lot of time, a lot of energy, but I hope you guys have thoroughly enjoyed it. Students who are watching it subsequently on YouTube, if these sessions have added value to you, why Kanjusida? Yes, put down your emotions, yes, put down your comment. Yes, I really love hearing your feedbacks, and if this has added value to you, please do share it to your friends as well. You are our only source. Is this clear? That's all for this session. See you guys in the next session. YouTube people, anyways, the video will continue, don't worry. Yes, everyone, so let us continue our discussion, my dear students. So we are discussing the chapter security valuation. In that, two parts. First is equity valuation, second is bond valuation. Equity valuation is completely over. In that, two main topics we had. First is valuation of equity shares. Yes, dividend based valuation, other methods of valuation. Second was other special areas. In that, we discussed bonus issues, right issues, buyback of securities. Done, understood. Then we came to bond valuation. In that, the first unit is over, wherein the first concept we discussed was valuation of bonds, present value of future cash flows. Second concept we discussed was yield. In that, first we told current yield, interest divided by current market price. Second thing that we had discussed was YTM, yield to maturity. Yes, step 1, calculate approximate YTM, formula method. Step 2, accurate YTM using IRR technique. Yes or no, different cases we had seen. Yes, next one was realized yield. We told us a very simple principle, take all cash flow to the last date, using that we will be doing the calculation. Till here, I hope everything is crystal clear. Yes or no, everyone, give me a confirmation. Perfect. So now we are going to take our discussion forward. Unit number 2, beautiful Majja concept. Yes, it is going to be the concept of duration. So duration and its related concepts. In this, all in all, 3 main points we will be having. First is understanding duration and volatility. Yes, based on that, we are having something called as convexity. Based on this, we are also having one more point called as bond immunization. Now here in the revision video, I will not be discussing the concept of convexity. Trust me, convexity is also very simple thing only. But if you pick the last 10, 12, 14 attempts, you will hardly be finding any question either in the past paper or in the RTP. So from an examination perspective, this is one of the least important things. So I don't want to be spending more time there. Okay. So that is why I will not be discussing it here. But apart from that, it's a very simple bacha jujubi concept only. But let us try understanding the concept of duration and volatility beautifully. Bond immunization also in a very beautiful way. So are we ready, everyone? Give me a confirmation, my dear students. Yes, sir. So first let us start with the concept of duration. Yes, duration is a very simple point. Should I tell you something? There is a formula. You by heart the formula. Duration is over. Sir, what is the formula, sir? I have written down the formula. Yes, duration is equal to, yes, sigma t is equal to 1 to n, t into c divided by 1 plus I to the power of t plus n into m divided by 1 plus I to the power of n whole divided by p. Seems difficult, huh? Don't worry, there is a shortcut formula also. What is that, sir? Shortcut formula. D is equal to 1 plus ytm divided by ytm minus 1 plus ytm plus t into c minus ytm whole divided by c into 1 plus ytm to the power of t minus 1 plus ytm. Sir, this is shortcut, sir. That only was better. Okay. Yes, coming back to the point. Yes, we are not going to touch any of these things. Logically, I will not tell you, will only tell me what exactly is duration. Okay, so let us slowly get into this. Yes, duration in the simplest of the sense means it is the average time for which my investment is blocked in the bonds. Suppose we invest in a bond, 1000 rupees. On an average, for how much time my investment is blocked, that is what duration is. Very simple. Just remember this sentence. What is it? It is the average time for which our investment is blocked in the bond market. Okay, boss. I'll give you guys a very simple example. I want you guys to be telling. Yes. Suppose I calculate the average study hours per day. Yes. Day 1 I studied 2 hours. Day 2 I studied 4 hours. Day 3 I studied 6 hours, 8 hours, 10 hours. Can you calculate the average study hours? Simple, sir. Yes. You do addition of all of these divided by 5. You will be getting the average study hours per day is equal to 6 hours. Now tell me, does it mean that every day I studied for 6 hours? No. Some days I studied for 2 hours. Some days I studied for 10 hours also. But on an average, I have studied for 6 hours. Yes or no, everyone? Yes. Suppose I am telling the average speed of a car is 60 km per hour. In 1 hour, yes, we travel 60 km. Does it mean that this entire 1 hour, my car was going in exactly 60 km only? No, boss. Sometime when it was highway, it was going at 100. Sometime it was also stopped. But on an average, the speed was 60 km per hour. Yes or no, everyone? So duration means on an average, I am stressing on this word. This is where beauty lies. This is where magic lies. On an average, in how much time my investment is recovered in the bond market. Is this clear, everyone? Okay, let us get into the game. Yes, imagine. I decided I am going to quit teaching. Why, sir? No maja only in life. Da. So I decided we'll start some new business. Okay. For that, I wanted a loan to start my business. Okay. How much loan you want, sir? 1000 rupees loan I want. So I meet the bank manager. We have money buy from HDFC Bank. I tell money buy, I want a loan. 1000 rupee loan you want. He told, okay, I'll give you the loan. Yes. In how much time you will return the money? Yes. Situation 1, assume I'm telling in 5 years I will return the money. Yes. So T is equal to 0, I borrow the money. 5th year, yes, full principal of 1000 plus interest I am going to pay. Is this clear, everyone? Okay, perfect. That means, can you guys tell me for how much time the investment is blocked? Now think from the perspective of bank manager. Okay, for the bank manager it is his investment. For me it is the borrowing. Okay, for one person it is asset, for one person it is liability. Okay, however you want, you can think. From my perspective, yes, in how much time, yes, I am repaying the money. From his perspective, in how much time he is recovering the money. Okay, perfect. So tell me, in how much time he is recovering the money? 5 years. Whether full investment is recovered in 5 years? Yes, sir, full investment 5 years we are paying. So what is going to be the duration? 5 years. Okay. Now comes the second situation. I am telling, money by 1000 rupees loan I want. But yes, this is how I want the loan. Treat it as 5 different loan. Yes, 200, 200, 200, 200, 200. He is asking what nonsense it is. I tell money by wait. Yes, 200 rupees loan. Na? First year I will pay with the interest. Assume 10% is interest. Yes, next 200 loan. Na? Second year I will pay. Next 200 loan, third year I will pay. Next 200 loan, fourth year I will pay. Next 200 loan, fifth year I will pay. Is this clear, everyone? Okay, he told, okay, you do whatever it is. So basically you want 5 loans, 200, 200, 200, 200, 200. Yes, first 200 rupees loan, first year I will pay with interest, that is 200 plus 10%, 220 I will pay. Second 200 rupee loan, yes, second year I will pay, 2 years interest. Third 200 rupees loan, third year I will pay. Fourth 200 loan, fourth year I will pay. Fifth 200 loan, fifth year I will pay. Is this clear, everyone? Okay, fine. Now in this case, now think from the perspective of money buy's lens you are putting. Yes, tell me total how much investment he has done. Okay, 1000 rupees investment he has done. Yes, tell me. Yes, whether the entire money he is getting in first year? No, sir. But 20% money he is getting in first year. Yes or no, everyone? Perfect. Yes, whether entire money he is getting in the last year? No, sir. Only 20% he is getting in the last year. So tell me, can I tell that the duration of investment is equal to 5 years? If I tell that, is it going to be correct or it is going to be incorrect? Sir, it is going to be incorrect. Why? In the 5th year, I am recovering some money, but I am not recovering the entire money in 5th year. Yes or no? Only one part of the money I am going to recover. Yes or no, everyone? Give me a confirmation. First situation, entire money I recovered in fifth year. So I told my duration is 5 years. In this case, only one portion of money I am receiving in the fifth year. Last installment I am receiving in the fifth year. Yes or no, everyone? So that means what is the average duration, sir? Yes, very simple example. Yes, look at this, everyone. So average time for which the investment is blocked for the investor, can I tell 5 years? No, only the last payment is made in 5 years. So sir, what is the average time for which the investment is blocked? Yes, Moneybuy is thinking average, on an average, for how much time my fund is blocked. Look at this, everyone. Yes, in first year, how much fund I repaid? 20%, 200 I repaid out of 1000. Second year, again 20% I paid. Third year, 20% I paid. Fourth year, 20% I paid. Fifth year, 20% I paid. So can I calculate the average time for which the investment is blocked? Yes, boss, very simple. So I will tell, yes, boss, 20% of fund is recovered in first year. Yes, 20% of fund is recovered in second year. 20% of fund is recovered in third year. 20% of fund is recovered in fourth year, plus 20% of fund is recovered in fifth year. Yes or no, everyone? Perfect. So if I do the calculation, I will get it as 3 years. So what is the duration of investment? On an average, again stressing the word on an average, in how much time the investment is recovered, or on an average for how much time the investment is blocked. So when Moneybuy is telling, okay, I gave him a loan 200, 200, 200, 200, 200. On an average, for how much time my fund is blocked? It is blocked for 3 years. Does it mean that entire fund I will be getting back in 3 years? No, boss. Some fund I got in first year also. Some fund I will be getting in fifth year also. Some fund I got in second year also. Some fund I will be getting in fourth year also. But on an average, I can tell that my entire investment is recovered in 3 years. Is this clear, everyone? Going back to the very first example. Average study hours per day is 6 hours. Does it mean that daily 6 hours I studied? No, boss. Some days I studied 2 hours also. Some days I studied 10 hours also. On an average, I have studied 6 hours per day. Average speed of the car is 60 km. Does it mean that full time I was traveling 60 km? No, boss. Sometimes it was at 0 also. Sometimes it was at 100 also. On an average, it was traveling at 60. So when I am telling a duration of the bond is 3 years, does it mean that entire money I got in 3 years? No, boss. Some money I got in first year, some money I got in fifth year, but on an average, I got my investment recovered in 3 years, or my investment is blocked for 3 years. Till here, whether things are clear, give me a confirmation. Now the same calculation, let us try doing using the table. Pay attention, everyone. So what I am telling is how much amount I have invested from the perspective of Moneybuy. Yes, 200, 200, 200, 200, 200, total 1000. So let me try calculating the proportion of it. Tell me 200 out of total 1000, it is 20%. 200 out of total 1000, 20, 20, 20, 20, 20%. Tell me this 20% of fund we have recovered in first year. So 0.2 into 1 is 0.2. Next 20% of fund we have recovered in second year. Makes it 0.4, 0.6, 0.8, 1. You add all of it. You will be getting the weighted average duration is equal to 3 years. Is this clear, everyone? Yes or no? So I have written down interpretation of duration. What is a duration? It is the average time. Yes, stress is on average time for which the investment is blocked. Is this clear? So when I am telling duration is equal to 3 years, it means that yes, as an investor, my investment is blocked for on an average 3 years. Some fund I will be getting it earlier than that. Some fund I will be getting it after that. But on an average for 3 years it is blocked. Is this clear, everyone? Okay, fine. So if duration is equal to 3 years, does it mean that my full principal is recovered in 3 years? No, boss. Some principal I am recovering it before that. Some I am recovering it after that. But on an average in 3 years I am recovering. Is this clear, everyone? Okay, fine. Now the final twist for us before we actually look at an example and understand. Yes, suppose cash flows are given. Yes, tell me cash flows, they will be in different period. What I'll have to do? I'll have to eliminate the interest component. Yes, bring it to present value terms. That is when I'll be getting the investment. Yes or no, everyone? Perfect. So for us, in the question, cash flow will be given. From that, first step is I will calculate the investment amount. Then I'll calculate the percentage of investment proportion. Then I will see the duration. Then I will calculate the weighted average. Look at this, everyone. Suppose question is telling if I invest in a bond today, cash flow is as follows. First year I'll be getting 220 rupees. Second year I'll be getting 242. Third year I'll be getting 266.2. Fourth year I'll be getting 292.8. Fifth year I'll be getting 322.1. So first what I will calculate, how much I should invest in a bond, assuming that my YTM is 10%. So what I'll be doing, very simple. Yes, step 1, yes, I will calculate present value. Tell me 220 I will get in the first year. That means today how much I'm willing to invest. Assume 10% YTM divided by 1.1. I will be getting 200 rupees. Same, yes, all my cash flow I will bring it to present value. Yes or no, everyone? Step 1, I will be calculating my investment. So look at this, everyone. Year cash flow, present value factor at the rate of 10% present value. Yes, every year cash flow I have written. Present value factor, I got my present value 200, 200, 200, 200, 200. I got 1000. Yes or no? From here I know the story. Tell me total 1000 rupees I invested. Yes, in that 200 rupees investment I have recovered in the first year. This is the interpretation. Understand, students? This is the interpretation. I can directly tell you steps, but it is important you guys know exactly what is the duration. Okay, beautiful concept it is. Based on it, so many beautiful things are going to come up ahead for us. Okay, so what is it telling? What is it telling? Every year how much cash flow I am getting is given. Yes, once I discount, I will be getting the investment. The very simple meaning is this. Okay, boss, today if I invest 200 rupees, after 1 year 220 I will be getting with interest. Correct? At 10%. Perfect. Today if I invest 200 rupees, after 2 years I will be getting 242. 200 plus 10% plus 10%. Yes, similarly all these things are there. Now tell me total how much I invested? 1000. In that 200 rupees investment I will be recovering in first year. So that means how much percentage investment? 20%. 200 divided by 1000. Yes, 200 investment I will be recovering in the second year. Yes, that means weight is 0.2. 200 in the third year, 0.2, 0.2, 0.2. Yes, the duration, 20% investment I will recover in first year, 1, 2, 3, 4, 5. So I will be doing my calculation. I will get it as 3 years. Is this clear, everyone? Okay, perfect. So once this is clear, once this much is clear, we will directly go into our workbook, solve one example. With that, more things will be clear. This we will do it logically. After that, I'll tell you a framework to quickly solve it as well. So that any question comes, you will be in a position to crack it. So are we ready, everyone? Give me a confirmation, my dear students. Yes, everyone. So let us have a look at this example. Okay. RCB invested in 1000 rupees bond having a coupon of 10%. Sir, RCB, sir. Isala cup namde. Isala cup namde or not, we don't know. But Isala attempt namde. Yes, on this attempt should be ours. Okay. Now, invested in 1000 rupees bond. 1000 rupees bond was there. They invested their money. Okay, great. Yes, coupon was 10%, having a maturity of 3 years. 3 years was the maturity. Okay. YTM of investor is also 10%. Investors YTM is also 10% only. Okay. Step 1, calculate market price of the bond, duration of bond and its interpretation. Both the things together will do. Tell me, students, I purchased a bond today. Okay. First year, how much I will be getting? 1000 into 10%, 100 I will get. Second year also 100 I will get. Third year also 100 I will get. At the end of the life, redemption price 1000 I will be getting. Yes or no, everyone? I have to discount these cash flows. At what rate I have to discount? 10%. Yes or no? Coupon is also 10%. YTM is also 10%. So 1000 rupees only is going to be the present value. Yes or no, everyone? Perfect. Now let me try calculating the duration of the bond. Pay attention, everyone. Just beautifully, without even having the need to by heart anything, let us do it. Logically, let us do it. Okay. Tell me, students, first year how much cash flow I am getting? 100 rupees cash flow. To get 100 rupees in the first year, how much investment was needed? 100 divided by 1.1. Yes or no, everyone? 90.9. Okay, boss. Second year, how much I am getting? 100 rupees. In that, how much year interest is there? 2 year. So let me eliminate that. Yes, that means how much I should be investing divided by 1.1 whole square. Yes, it is 82.6. Yes or no, everyone? Third year, how much I am getting? 100 rupees interest also I am getting. 1000 principal also I am getting. Yes, it is after 3 years. So 3 years interest I will be eliminating. So that means divided by 1.1 to the power of 3. So yes, 1100 divided by 1.1 to the power of 3, I will be getting 826.1. Yes, so if I add all of these things, I will be getting 999 point something, which is nothing but 1000 rupees. Yes, this is my investment. Till here, is this clear? Yes, sir. This Jujube, sir, from foundation days we are doing. In foundation also we did, inter also we did, final again we are doing, sir. No life only, sir. Okay. Till here, is this clear? Anyone is having any doubt? No, sir. Present value, even in our sleep we can do so. Okay. From here are game stats. Pay attention. Very beautiful, very simple. Tell me, students, Assume we are that investor. Tell me total how much we have invested. 1000 rupees investment we have done. I am giving you, yes, the interpretation, reading of the lines. 1000 rupees I have invested in a bond. In that, how much investment I am recovering in the first year? Sir, 90.9 rupees. Now, first year only I recovered, sir. How? First year I got the coupon, na. So, when I am getting that coupon, that amount I recovered. How much? 90.9. But, sir, 100 rupees I got, na, sir. In that 100, yes, interest is also there, na, first year. So, in terms of my investment, total 1000 I invested. In that 90 rupees investment, I recovered in first year. 82 rupees investment I recovered in second year. Balance 826 investment I recovered in third year. Is this clear, everyone? So let me try calculating in terms of percentage. Tell me total 90 rupee investment, 90.9 out of 1000. So how much percentage investment? It is 0.0909. That is basically 9.09 percentage of investment I recovered in first year. Okay, yes, 0.0826, that is 8.26 percentage investment I recovered in second year. Yes, 0.826, that is 82.6 percentage investment I recovered in third year. If I have to calculate on an average in how much time my investment is recovered, what I'll tell, sir, 0.0909, that is 9.09 percentage of investment was blocked for 1 year. 0.0826, that is 8.26 percentage of my investment was blocked for 2 years. 82.6 percentage of investment was blocked for 3 years. So can we calculate the duration? 0.0909 into 1, 0.0826 into 2, 0.826 into 3, grand total. Is it coming to 2.7341? Yes or no, everyone give me a confirmation. The same thing using a table also I can be doing here. Separately I showed the calculation. Here also in the table I can be showing the calculation. 0.0909 into 1. 0.0826 into 2. 0.826 into 3. You do a summation. Here you will be getting 2.7341 years. Is this clear, everyone? Perfect. So this is how we will be calculating duration. Yes, interpretation also I told, logic also I told, and how to do in the exam also I told. So how do we do the calculation of duration? Yes, so look at this, very simple. Here I will write cash flow, I will write present value factor, I will write present value, I will be writing. Till here any given day we were doing, even in our sleep we were doing. Now what we have to do? Yes, present value. Yes, this shows the investment total, how much money we invested was. Using that, what I will calculate? Proportion or weight I will calculate. That is how much percentage money, yes or no? Yes, suppose here year 1 is there. Yes, this divided by this tells me how much percentage of my investment is recovered in first year. Yes, proportion, yes, into duration gives me weight into duration. Yes or no? In our case, 0.0909, 9.09 percentage of my investment was recovered in first year. So it becomes 0.0909. Yes, 0.0826, 8.26 percentage of my investment was recovered in 2 years. That gives me, accordingly, you do a summation, this will give you the duration. Is this clear, everyone? Perfect. Now, this is a detailed way for calculation of duration. There is one shortcut wherein you can save some time. Sir, can we do it for the exams? Yes, dear, definitely you can do it for the examination. How we can do it? Look at this, students. Yes, firstly, yes, interpretation of duration. Yes, duration of bond is 2.74 years. It means that on an average, the total investment is recovered in 2.74 years. Some investment, obviously, before that I will recover. Some investment after that I will recover. But on an average, in 2.74 years, I am recovering. Okay, great, boss. Yes, there is one more way for me to do the calculation. Yes, that is using the concept of products. How do we do that? Look at this, students. Duration calculation, if I want, can I also write it like this? Look at this, students, pay attention. Yes, first I told 9.09 percentage of my investment I recovered in first year. How did I get 9.09? Simple, I had here 90.9 divided by 1000, that gave me 9.09 percentage, yes or no? This is recovered in first year. Balance 82.6 I recovered in second year. So I wrote it as 82.6 or 83 rupees. Out of total 1000 I recovered in second year. 826 out of 1000 I recovered in 3 years. Okay, this is how I had written logically. Yes, this is telling 9.1 percentage of investment I recovered in first year, 8.3 percentage investment in second year, 82 percentage in third year. Now if you see, everywhere division is 1000. So this I can write it as a common denominator 1000, and all of these things I can write it together. So I can write it as 91 into 1 plus 83 into 2 plus 826 into 3 divided by 1000. And this I can, if needed, I can write it as, tell me what is 91, 83 as well as 826. It is the individual present value. Yes or no? Every year what is the present value? So I can write it as summation of present value into the duration whole divided by 1000. It is nothing but the price. So I can tell, for this I can call it as my product divided by price. Sir, what nonsense it is, sir? Nothing went to our mind. Wait, I will show it with table. Things will start making sense. Look at this, everyone. I will write down the same thing. Year 1, 2, 3, 100, 100, 1000, 100. I guess it is a 90.9, 82.6, 826,000. Something like this we'll be having. Is this clear? Now, previously what we were doing is 90.9 divided by 1000 I was doing, into 1 I was doing. That is what I was writing here. 82.6 divided by 1000 I was doing, into 2 I was doing. That is what I was writing in there. Here what I am doing, this divided by 1000, in the last I will do. So what I will do, present value I got, directly duration. Yes, this much money is recovered in which year? First year. 82.6 is recovered in second year. 826 is recovered in third year. So I will do this, I will call it as product. So 90.9 into 1, 82.6 into 2, 826 into 3. It comes to 2734.1, and I will tell my duration is equal to product divided by price. It is 2734.1 divided by 1000. You are getting it as 2.73 years. Again, I got the same answer. There individually I was dividing by 1000. Here total I divide by 1000. Is this clear? This is faster for me. Sir, which one to do? Anything you do, you are getting the same answer only. Sir, both of them are approved, both of them are approved. Yes, sir, which one you are going to recommend? This. Why? Because it is going to be faster. Is this clear, everyone? So all in all, if I have to sum up, okay, this is the formula the institute has given for calculation of duration. Look at this, everyone. All these nonsense formulas they have given. Yes, what we are going to keep it on the back of our mind. Yes, entire concept, background, all those things I have told. Okay, now for us, how to solve in the examination? Very simple, using the concept of product. Yes, year I will write, cash flow I will, present value factor I will write, present value I will get. These things any given day we were doing it. Now, for every present value, duration will be given. Duration is as good as the life only. Yes or no? This much amount is recovered in first year. This much is recovered in second year, so on and so forth. What extra thing I am going to do? Yes, I will add another column called as product, which is present value into duration. Yes, every row, whatever is a present value into duration, I will keep on doing. I will do the summation. I will call it as product. And here, summation of the present value. Anyways, I am having the price. So what I will tell, duration is equal to product divided by price. Story over. Is this clear, everyone? Give me a confirmation. Yes, obviously, yes, for us to understand the logic, first approach is better, because everything I can logically keep telling this much percentage first year, this much percentage second year. But for the examination, this is going to be faster. Anything you can do, you will be getting the same answer only. Is this clear? You do 1 or 2 examples by yourselves, you will start getting that confidence, that clarity. Is this clear, everyone? Give me a confirmation. Yes, everyone. So we have understood the concept of duration. Yes or no, everyone? Give me a confirmation. Yes, we have spent some time, but now for us, if at all we have to understand duration, simple 2 pointers. Duration, what does duration mean? It means on an average, the most important word, on an average, for how much time the investor's fund is blocked in the bond, or on an average in how much time we have recovered the investment. Both are going to give you the same interpretation. Yes. Now, which bond is better? Sometimes a question comes on this. Which bond is better? Yes, bond having a lower duration is better. Yes, I am giving you a very simple example. Suppose you make an investment in one place. Yes, where your investment will be recovered after 100 years. You make your investment in second place, wherein your investment is recovered in 2 years only. Which one is better? Sir, second one is better. Quickly I am recovering my money. Same thing only. Lower the duration, better it is going to be. It is less riskier, faster you are recovering your money. Is this clear, everyone? Okay. How do I calculate duration? Simple, duration is equal to P by P. Product divided by price. How do I do the calculation? Year, cash flow, present value factor, present value. Then I will write down the duration. Duration is basically year only. Again, I am writing it just. Okay. Then I will do present value into duration. I will call it the product. So summation of this I will call it product, summation of present value I will call it price, product by price gives me the duration. Story over. Is this clear everyone? Yes or no? Give me a confirmation. Okay, perfect. Now let us go ahead to the next concept, which is going to be volatility of the bond. Yes, it is also called as modified duration. Now duration was also called as Macaulay's duration. I have not read the complete notes, you can read it. Yes, it is also called as Macaulay's duration. All these things I have written. Okay. Yes. Now volatility is also called as modified duration. Okay. Now how do we calculate volatility? Two approaches are there. One is the logical approach, second is the formula approach. Now what exactly on earth is volatility, sir? Very simple thing. Volatility is telling me that if my YTM changes by 1%, 1% change in YTM. Yes, if my YTM changes by 1%, yes, by how much percent? Yes, change in price. If my YTM changes by 1%, by how much percentage my price will change? That is what my volatility is going to tell me. Yes, so look at this volatility. Yes, it measures the percentage change in price of a bond for a 1% change in YTM. If my bond's YTM changes by 1%, by how much percentage my price is going to change? Now, how can we calculate it? First is logical approach. Now, a very simple example I am giving here only. Yes, now tell me, yes, in our example, RCB invested in a 1000 rupee bond, 10% was coupon, YTM was 10%. I calculated price was coming as 1000 rupees only. I want to calculate volatility. Tell me students, right now how much is my YTM? Right now my YTM is equal to 10%. At a YTM of 10%, what is the price? Sir, 1000 rupees is the price. Volatility, what on earth is volatility telling? If my YTM changes by 1%, if my YTM changes by 1%, by how much percent price will change? Sir, YTM is changing by 1%. 1% means which side, sir? Plus 1% or minus 1%? Any side it can be. So I will do, if my YTM becomes 9%, how much is the price? If my YTM becomes 11%, how much is the price? Shall we calculate? Yes, sir. Let us calculate, sir. Using that, let us try understanding volatility. Pay attention. Yes. Calculation of price of bond for different YTMs. So, tell me what all cash flow I am getting. First year 100 I am getting, second year 100 I am getting, third year 100 interest as well as 1000 principal I am getting. So, if I do, yes, 1 to 300, third year 1000. If YTM is equal to 10%, price comes to 1000 rupees. YTM becomes 11%, price comes to 975.4. YTM becomes 9%, price comes to 1025.1. Calculation if you want, you can pause and do it by yourselves. Okay. Now, what is volatility telling? Yes, meaning is going to be most important, student. If you know meaning, yes, this you can derive it, not a big deal. What is volatility telling? If my YTM changes by 1%, how much percent will my price change? Okay. So here YTM is changing in two places. YTM is increasing by 1%. It is decreasing also by 1%. So in both these cases, let me try calculating the percentage change. Look at this, students. Percentage change in price if my YTM increases by 1%. Tell me originally YTM was how much? 10%. Yes, that time price was how much? 1000 rupees. Assume YTM increased by 1%, that is my YTM became 11%. How much will be the price? Simple, if my YTM is 11%, price will be 975.4. Yes or no, everyone? Perfect. Tell me previously my price was how much? 1000. Now it became how much? 975.4. So by how much my price has reduced? 1000 minus 975.4. Sir, it has reduced by 24.6. From where? Sir, originally it was at 1000, na sir. That means how much percentage my price has reduced? 2.46% my price has reduced. Yes or no, everyone? Yes. Any doubt? No. Till here is it fine? Yes. Now let me see on the other side as well. If my YTM, yes, decreases by 1%, what will happen? Tell me originally my YTM was how much? Sir, 10%, sir. If it decreases by 1%, how much my YTM will become? 9%. Yes, at 10%, how much was the price? 1000. If my YTM becomes 9%, how much will be the price? 1025.1. So how much percentage has the price increased? Tell me, price has increased by 25.1 upon 1000. It has increased by 2.51%. Yes or no, everyone? Perfect. So tell me students, if my YTM increases by 1%, if my YTM increases by 1%, price will change by 2.46%. If my YTM decreases by 1%, price will change by 2.51%. I want to know on an average, if my YTM changes by 1%, how much is the change? Tell me students, when YTM increases by 1%, na 2.46% change is there. When it decreases, na 2.51% change is there. So on an average, how much change is there? It is 2.46 plus 2.51 whole divided by 2. Is it coming to 2.485? Yes or no, everyone? So volatility of the bond is 2.485. What is it, students? Volatility of the bond is 2.485. Sir, what exactly on earth does it mean? Volatility is equal to 2.485. It means that, yes, if my YTM changes by 1%, price of the bond will change by how much percent? 2.485% approximately. Is this clear, everyone? Okay, perfect. Now one basic thing we know. Yes, YTM and price, there is an inverse relationship. YTM increases, price decreases. YTM decreases, price increases. We know from basics only we know. Yes, if you want, we can verify also. YTM has increased from 10 to 11, price has decreased. Here from 10 to 9, YTM has decreased. Yes, price has increased. Yes or no, everyone? That means, tell me students, yes, volatility of the bond is 2.485. What does it mean? It means that if my YTM increases by 1%, tell me what will happen to price? Price will decrease by how much percent? 2.485% approx. Yes, if YTM decreases by 1%, what will happen to price? Price will increase. How much percent? 2.485% approx. Is this clear, everyone? Perfect. This is the logical calculation of volatility. What is volatility telling? It is telling, boss, if YTM changes by 1%, na, how much percent price will change? Sir, how do we do the calculation? Current YTM is there. Yes, let us try calculating the percentage change if YTM increases by 1%. The percentage change if YTM decreases by 1%. Average percentage change I can calculate. That is one detailed, lengthy, logical approach. Now, there is a quick shortcut way for us to do this as well. Sir, will we get same answer? Yes, sir. Sir, can we do that in the exam? Yes, sir. So, for that a formula is there. So, let us try seeing that using the formula as well. Yes, what is the formula approach? This is the approach which is recommended for the examination. Yes, the formula tells that volatility is equal to duration of the bond divided by 1 plus YTM. Let me try seeing whether this formula will work or not. Tell me students, we had calculated duration of the bond previously. How much was the duration of the bond? 2.73 years. Yes, this duration we calculated using how much percentage? Yes, discounting factor 10%. Yes or no? YTM was 10% originally in the question. Okay, so I will tell it is going to be 2.74 years. 2.74 divided by 1 plus YTM. Yes, YTM is 0.1, it is 1.1. 2.74 divided by 1.1, which comes to 2.49. It is going to be the volatility. Tell me previously how much answer I got? 2.485, which is nothing but 2.49. Here also how much I got? 2.49. Tell me, there so much drama we had to do. YTM increases by 1%. How much is percentage change? Decreases by 1%. How much is percentage change? What is the average percentage change? Here, takka, 2 seconds I get the volatility. Yes, tell me students, what is the formula for volatility? It is going to be duration divided by 1 plus YTM. Sir, how this formula came, not important for us. Through differentiation, we are getting it. Is this clear, everyone? It is revision. Okay. Yes, even in this much I am explaining. Is this clear, everyone? Okay, fine. So coming back, yes, how do we calculate volatility? Formula approach is there, which is duration divided by 1 plus YTM. Is this clear, everyone? Give me a confirmation. So let us quickly look at the summary chart. Yes, duration and its related concept. In that first one we have discussed is duration. On an average, in how much time my investment is recovered. Okay, so how do we do the calculation? Simple. Yes, year is there, cash flow is there, present value factor, present value. Yes, duration I will write. Present value into duration, I will call it product. Yes, duration is nothing but product divided by price. First calculation. Second calculation is volatility. Yes, first, what is volatility? Volatility is telling if my YTM changes by 1%, how much percent will my bond price change? How do we calculate? Simple, it is duration divided by 1 plus YTM. Is this clear? Okay. Now using this comes a very important thing, that is estimation of revised market price. Look at this, students. Using this example only, let me try doing it. Pay attention. Let me come back to the question. Okay. Yes, what was the original question? Let me read again. Yes, RCB is there. They invested in a 1,000 rupee bond. Coupon was 10%. Maturity was 3 years. YTM was 10%. I got the current market price as 1,000 rupees only. Yes, we calculated duration. I got it as 2.74 years or something. Yes, volatility, I got it as 2.485 or something like that. Okay, now they are asking, yes, calculate the expected market price in the following situation. They are telling, boss, if my YTM changes, whether market price will change? Yes, boss, it will change. They are telling, situation 1, if my YTM increases by 125 basis points. YTM has increased by 125 basis points. Tell me, students, yes, 100 basis points is equal to 1%. So 125 basis points means how much percent? 1.25%. Yes or no? YTM has increased by 125 basis points. That means how much will be the price? How can we do the calculation? Yes, step 1. Yes, approach number 1. Tell me what was my original YTM, 10%. If it has increased by 1.25% means it becomes 11.25%. Yes, approach number 1 is discount all factors using 11.25%. You will get the exact price. But boss, again we'll have to do all those nonsense now. There is a shortcut for this as well. Okay, that gives me the approximate calculation. Yes, now how do I do it? Very simple. Yes, I've done detailed step by step for you guys so that we never commit a mistake. Pay attention, students. Yes, calculation of expected market price. Situation 1, if YTM increases by 125 basis points. 125 basis points means 1.25%. What are the steps to be followed? Step 1, calculate volatility of the bond. Yes, have we calculated? Yes, sir. We know that volatility of the bond is 2.485. Yes or no? Perfect. Now, step 2, ascertain if the market price will increase or decrease. Whether market price will increase or decrease, I should ascertain. Tell me, students, YTM has increased or decreased? Sir, YTM has increased, sir. So, tell me, if YTM has increased, what will happen to price? Sir, price will decrease, sir. Okay. So, that means I can tell YTM has increased. That means price will decrease. Is this clear? Detailed step by step framework I am giving so that you can never commit a mistake. First, calculate volatility. We would have already calculated. Yes, YTM has increased means price will decrease. YTM has decreased means price will increase. Okay. Step 3, calculate the percentage change in market price. How much percent my market price will change? That is what I want to know. Okay. Now tell me, students, what is the volatility? Volatility is 2.485. What does it mean? Volatility means that if YTM changes by 1%, price will change by how much percent? 2.485%. Yes or no, everyone? In our case, YTM has changed by how much percent? 1.25%. That means price is going to change by how much percent? It is 1.25 into 2.485. 1.25 into 2.485. Price will change by 3.10625%. Yes or no? By this much percent, my price will change. Now, using that, let me calculate step 4, calculate the revised market price. Tell me, it is existing market price plus or minus percentage change. Tell me, my original market price was how much? Sir, 1000 was the original market price. In this case, YTM has increased or decreased? The YTM has increased. That means price, what will happen to price? Price will decrease. So it is minus. How much percent price will decrease? Sir, price will decrease by 3.10625%. So it is going to be 1000 minus 3.10625%. That gives me a price of rupees 968.9. Let me write it as 960. Is this clear? This is how we are going to calculate the revised market price. Situation 2 is there. Takka will do. Pay attention, students. Situation 2. If YTM has decreased by 200 basis points. Tell me, students, YTM has decreased. 200 basis points means 2%. Okay, tell me. First step is calculation of volatility. We have already calculated. Volatility is 2.485. Yes, tell me whether market price will increase or decrease. YTM has decreased. That means market price will increase. Yes or no? How much percentage it will increase? Yes, if I want, I can directly write it as well. It is 2.485 volatility into the percentage change. It is 2. So 2.485 into 2, it becomes 4.97%. Sir, how you did, sir? Very simple. Yes, YTM change, price change. If YTM changes by 1%, price will change by 2.485%. That is the interpretation of volatility. In our case, YTM is changing by how much percent? 2%. So by how much percent it will change? 2 times of that it will change. 2.485 into 2, which is 4.97%. So let me now calculate the revised market price. Existing market price was 1000 rupees. YTM has decreased. That means price will increase plus how much percent it will increase? 4.97% it will increase. So 1000 plus 4.97%. It becomes 1049.7. Is this clear, everyone? Give me a confirmation. So look at the steps to calculate the percentage change. Calculation of revised price using volatility. Step 1, calculate volatility. We would have calculated. Step 2, ascertain if market price will increase or decrease. Sir, how can we ascertain, sir? Basic relationship. If my YTM, there is an inverse relationship between YTM and price. If YTM is increasing means price is decreasing. Yes, YTM is decreasing means price is increasing. Then we'll have to understand how much percent it will change. Sir, how do we calculate that? Very simple. It is going to be volatility into the percentage change in YTM. That is basically I have done it through cross multiplication. Same I have written down as a formula. Yes or no? Yes, I told my volatility is equal to, yes, 2.495. Something was there, 2.485. That means if YTM changes by 1%, price will change by 2.485%. So if YTM changes by 2%, how much percent? Yes, this is what I did, percentage change. Using that revised market price I will calculate, which is existing price plus or minus percentage change. One important note, 100 basis point always means 1%. Is this clear, everyone? Perfect. Now one very important thing for us, yes, is that this calculation of revised market price, is this the exact price? No sir, it is just approximate. Not getting into why it is, because when I was calculating volatility, logically what I did, yes, higher change, YTM increases 1%, YTM decreases 1%. I averaged it out, so it became a straight line. But in reality, there will be a change. Is that it is going to be of convex nature, curved nature. Yes, that adjustment is that convexity adjustment. Convexity adjustment, to be very frank, is not very important for your examination, and because it is revision and because we are lacking time, I am not explaining it here. Convexity is again a very simple GGB thing only, logically only we can derive. There is absolutely no need to by heart formula and keep. I have given you guys a small intro to convexity. Yes, the revised market price that I have calculated using volatility, is it perfect? No, it is approximate. That is why everywhere you see, yes, whenever I used volatility, I have told, yes, volatility, it tells, yes, if YTM increases by 1%, bond price will decrease by approximately. It gives me approximate calculation only. To make it accurate, what I want, convexity adjustment is needed. Is this clear, everyone? Give me a confirmation, students. So with this, one main segment is over, duration is over, volatility is over, calculation of revised market price is over. Quickly let us revise. Duration formula, yes, it is product divided by price. Next, volatility, yes, it is duration divided by 1 plus YTM. Calculation of revised market price. Step 1, calculate volatility. Step 2, understand if your price is going to increase or decrease. How? If YTM is increasing means price will decrease, YTM is decreasing means price will decrease. Step number 3, calculate the total percentage change in the market price. It is nothing but volatility into percentage, yes, change in YTM. And based on that, calculate the revised market price. Is this clear? Give me a confirmation. Yes, everyone. So we are going ahead to the next concept, which is bond immunization. Beautiful concept it is. Yes, practically used by insurance companies, banks, so many places. Okay, so from examination perspective, what we have to do, let us try understanding, not getting too much into the logical depth. But don't worry, from exam, if ever a question comes, however a question comes, how to do, we will tackle that. Okay, but the depth of why it is, the beauty of it, I am not going to explain it here. Okay, in a regular class, we create an example of an insurance company, understand how that risk is, what is the relationship between reinvestment risk, price risk, how it is in the opposing nature, how exactly at duration both will get offset perfectly, so that, okay, the net risk becomes zero. All those things are there, which is not important for exams. It is revision. So, how to tackle a question, that let us do it. Properly we'll do it, framework we'll give it to you guys. Okay, so directly I am coming into the questions. Pay attention, everyone. Question number, example number 17, bond immunization. So all in all, two different cases can be there. In case of 2 bonds, how to immunize. In case of 3 bonds, how to immunize. Okay. Now pay attention, students. Yes, Thala will need, Thala for a reason. Thala will need 7 lakhs after 2 years for his daughter's education. Okay. Thala will need 7 lakh after 2 years for daughter's education. Okay, great boss. For which he has decided to make a one-time necessary investment now. He's telling boss, after 2 years I want 7 lakh. Okay, great. So Thala is standing here. Thala for a reason, 0. After 2 years, how much amount is needed? 7 lakh rupees is needed. He is having a risk. After 2 years, 7 lakh he should invest now. He is telling, boss, I will do one thing. I will make some investment today. So that, yes, by including interest, it will become 7 lakh after 2 years. Okay, boss, let us do. Let us see how much is a YTM. Yes, he has a choice of 2 different types of bonds. Yes, the current YTM is 7%. Tell me how much is a YTM? 7%. So let me discount it using 7%. 2 years back I have to come. Divided by 1.07 whole square. So tell me 7 lakh divided by 1.07 divided by 1.07. Total how much amount he has to invest? 6,11,407 he has to invest. Yes or no? So today he has invested 6,11,407. Yes, so 2 years interest will accumulate and total 7 lakh amount will be ready. Is this clear everyone? Okay. So 6,11,407 he has to invest. Now sir, where to invest sir? 2 different bonds are there. Bond A is there, bond B is there. Price of each bond is given, years to maturity is given. After how much years the bond will mature? Yes, I can get back the redemption value. Yes, duration also is given. Duration is the average time in which my investment is recovered. Yes or no everyone? Perfect. Now question is whether he should invest all his money in one type of bond or should he buy both the bond? If so, in how much quantity he should buy? This will be the question. So we'll have to calculate it using the concept of bond immunization. How to calculate? Step by step I am telling, not getting into too much logical depth. Okay, it is revision. Again I am reminding. Some places I will explain, yes, in the most logical way. Some places from the examination perspective I will quickly tell because it is a revision. Again I am stressing out things. Okay, what are the steps to be followed in order to immunize my portfolio, bond portfolio? Step 1, I will be calculating duration of each bonds. Tell me in this case duration of bond A is how much? 1.5. Duration of bond B is how much? 2.5. Duration of A is equal to 1.5 years. Duration of bond B is equal to 2.5 years. Is this clear? In this example it is given. In your examination question not necessary it has to be given. So we have to calculate sir. We have to calculate. Sir, how to calculate sir? Just 5 minutes back I told you the calculation of duration. Okay sir, we'll do it sir. Okay, perfect. Now based on that we have to calculate weight. How much percentage I should invest in each of the bonds? Okay, very simple golden rule I am telling you guys for the entire concept of bond immunization. We should invest in bond in such a way that our weighted average duration of the bond should be equal to the investment horizon or the investment period. Is this clear? Okay, yes. So we should invest in the bond in such a way that the weighted average duration of bond should be equal to the investment duration. So what is the meaning, symbolic representation, what exactly it means? None of those things I am going to get into. Simple. Tell me, Thala is investing for how many years? Thala is investing today. When he needs the fund, he wants the money after 2 years. That means whatever investment he is doing today, it is for how many years? 2 years. So my investment duration is going to be 2 years. Yes or no everyone? So I should invest in a bond in such a way that weight of the bond should be such a way that the weighted average duration of the bond should be equal to the investment duration, which is going to be 2 years. So how to do it? Look at this students. I am investing in bond A also, bond B also. So weight A into duration A plus weight B into duration of bond B. Okay, tell me duration of bond A and bond B. Do I know? Yes sir, I know sir. Yes, what is going to be duration of bond A? 1.5 years. Duration of bond B is 2.5 years. I just want to know the weight of A and B. That means how much percent I should invest. Yes sir, do we know the percentage we should invest? We don't know sir. Tell me. Yes, whatever we don't know in life. Yes, whom we should assume? Sir, we have to assume our X sir. So let me assume weight of bond A is equal to X. So that means what is weight of bond B? Simple. I know that weight of A plus weight of B is equal to 1. So if weight of A is equal to X, that means weight of B is equal to 1 minus X. Yes or no everyone? Simple. It is just telling the percentage. Total 1 rupee I am investing. In that X if I am investing in A means balance I will be investing in B. Okay. And yes, the very simple sentence I will be using for the entire immunization, golden sentence. yes, we will invest in bond in such a way that the weighted average duration of bond will be equal to the investment horizon or the investment period. That itself is the duration of the liability, which is weight of A into duration of A plus weight of B into duration of B, so on, will be equal to the investment period. Is this clear, everyone? Okay, fine. So how we will be doing it? Look at this. So now let me try calculating. Weight of A I have taken as X, weight of B I have taken it as 1 minus X. 1 minus X into 2.5 gives me 2 years. So let me try simplifying and solving. X into 1.5 is 1.5x plus 2.5 minus 2.5x is equal to 2. Yes, 2, let me bring it to this side. 2.5 minus 2 is 0.5 is equal to this. Let me take it to the other side. 1.5x minus 2.5x is minus x, goes to the other side. X becomes 0.5. Yes or no, everyone? So now we have got the value of x. Who is x da? Yes, investment in bond A is x, which is going to be 0.5. Investment in bond B is again going to be 1 minus x, which is going to be 0.5. So what is the moral of the story? Simple moral of the story, my dear students. Understand, yes, if you get a question on bond immunization, simple principle, we will invest in bond in such a way that the weighted average duration of bond will be equal to the investment period, which is weight of A into duration of A plus weight of B into duration of B plus so on and so forth. In that, duration of bonds individually will calculate. Sometimes it will be given in question. Point number 1. How to calculate weight? Weight of A, if I take it as x, weight of B will be 1 minus x. As simple as that. Yes or no, everyone? Perfect. Now that I have calculated the weights, next what I have to do? Pay attention. I have calculated the weight, boss. This is done. Next what I have to do? Yes. Step 3, I will calculate the total amount to be invested in bonds. Sir, how do we calculate? Tell me, Thala needs how much money after 2 years? 7 lakh he needs. When he is investing, today he is investing, how much he will be investing? He will be investing present value of 7 lakh. Yes or no, everyone? Tell me what is the, yes, yield rate 7%. So it is 1.07. Sorry, 1.07 square. It comes to how much? 7 lakh divided by 1.07 divided by 1.07. It comes to 6,11,407 rupees. Yes or no, everyone? Perfect. So that is the total investment. So total how much money Thala should invest? Total 6,11,407 Thala should invest. Which all bond he should invest? Bond A also, bond B also. How much percentage he should invest? 50% in A, 50% in B. Yes or no? Step 4, I will calculate the investment in each of the bonds. So how will I be doing it? Yes, I will tell bond A is there, bond B is there. How much is the weight? 0.5, 0.5. Tell me total investment is how much? 6,11,407. So in that 50 percentage, 3,05,703. Yes, or 704. I will be investing in bond A. 3,05,704. I will be investing in bond B. Is this clear, everyone? This is the investment. Sometimes question will also ask, how much bond I should buy? Tell me, students, bond A is trading at which price? Sir, bond A, one bond A, na, it is available in the market at 980 rupees. So tell me, one bond is trading at 980 rupees. If I have to invest 3,05,704 means how many bond I should buy? 3,05,704 divided by 980. How much am I getting? 311.9. 312 bonds. Similarly, I will be having price of bond B. I will get the number of bonds to be purchased. Is this clear, everyone? So look at this. I have written down the steps for you guys. Again, stressing out, not getting into the detailed logics. This is a quick revision for you guys. Okay. So the entire philosophy of duration. Invest in bond in such a way that the weighted average duration of bonds, that is weight into duration, will be equal to the, yes, investment duration. Okay, what are the steps? Step number 1, calculate duration of bonds. Okay, given in the question are great, otherwise we will calculate. Step number 2, calculate weight of each bonds. How do we calculate? Weight of bond A, I will take it as x, weight of bond B, I will take it as 1 minus x. Yes, using that I will create the equation. Okay, once that is done, step number 3, I will calculate total how much I should invest in bond. After 2 years I want 7 lakh, but I am investing today. I will be investing present value of the liability. Okay, yes, step number 4, I will calculate the investment in each bonds. Yes, total today 6,11,000 I am investing, but that is invested in 2 bonds now. So bond A 50%, bond B 50%. Accordingly, I will calculate. That is distributor total investment in the ratio of the weights. Is this clear, everyone? Perfect. In case of 3 bonds, sometimes a question will come on 3 bonds. In that case, how to do? Let us quickly see it. Pay attention. Example number 18. Okay. Rocky Bhai will need 10 lakh after 3 years for making substantial improvement in KGF, for which he wants to make a necessary one-time investment today. Rocky Bhai is there. He is telling after 3 years, na? Yes, we want to make substantial improvement in KGF. For that 10 lakh money we want. For that today I want to invest and keep. Okay, great boss, invest today. His current yield is 10%. So how much he will be investing? 10 lakh present value of that. Okay, great. Yes, he is having 3 different types of bond. Bond A is there, B is there, C is there. Price is given, years to maturity is given, duration is also given. Okay. First requirement. Calculate the investment to be made in each of the bonds to immunize his portfolio. He wants to immunize the portfolio if he has to invest 40% of his money in bond A. He is telling, boss, 40% I will put in bond A. In bond B and C, how much percentage to put? That you tell, so that I can immunize my portfolio. Very simple, same steps. Step number 1, yes, I will calculate the duration of each bonds. Tell me, given a duration of bond A, duration of bond B, duration of bond C. Tell me duration of bond A is how much? 3.54. 2 years, 3.5 years, 4 years. Yes, why am I writing it as first step? Because here, because I have created example, I have written down those numbers. In the exam, not necessary it is available. If it is not available, we will calculate. Okay. Step number 2 is calculation of weights. Now, how do we calculate weight? Very simple, students. 3 bonds are there. In bond A, question told 40% I should invest. Pakka ba? Pakka. Bond B, sir, we don't know how to invest. How much percent? Whatever we don't know in life, let us take it as X. Sir, in bond C, how much we should invest, sir? Tell me, total of the weight will be how much? 1. So, weight of A plus weight of B plus weight of C should be equal to 1. Weight of A is how much? 0.4. Weight of B is how much? X. I want to know weight of C. Yes, therefore, weight of C is equal to 1 minus 0.4 becomes 0.6 minus X. Yes or no, everyone? 0.6 minus X. I hope this point is clear. Okay, that is, look at this, students. I have written down the Maja adjustments. Yes, how do we calculate weight of each bond? If I am having 2 bond only, first bond weight I will take it as X, second bond weight I will take it as 1 minus X. If I am having 3 bond, yes, weight of first bond will be given in the question. Weight of second bond I will take it as X. How do I take weight of third bond? I will take it in such a way that the total weight is going to be equal to 1. That is, weight of bond 1 plus weight of bond 2 plus weight of bond 3 is equal to 1. In such a way, I will be taking the weight of third bond. Okay, boss, I did it. Yes, now what I want, I will be investing in bond in such a way that the weighted average duration of bond will be equal to the investment duration. That is, 3 bonds are there, weight A duration A plus weight B duration B plus weight C duration C should be equal to investment duration. Tell me, Rocky Bhai wants to make investment in how many years? 3 years. That means it should be equal to 3. Weight of A is 0.4 into duration of A is how much? 2. This is X into duration of B is how much? 3.5. Yes, this is 0.6 minus X, if I am not wrong. Yes, into 4. Yes, 0.4 into 2 is 0.8 plus 3.5x plus 4 into 0.6 is 2.4 minus 4x should be equal to 3. So, let us accumulate all the places together. 3.5x minus 4x, it is going to be equal to minus 0.5x. Take it to the other side, becomes 0.5x. Yes, 0.8 plus 2.4, 2.4, 3.2, this comes this side, minus 3, it becomes 0.2. Therefore, x is equal to 0.2 divided by 0.5, which is equal to 0.4. Yes or no? Yes. Important in life, don't forget who is your x. Therefore, weight of B is also 0.4. Therefore, weight of C is 0.6 minus 0.4, which is 0.2. Yes or no? So, what is going to be the percentage investment? In A, 40%, B, 40%, C is going to be 20%. Yes or no, everyone? Perfect. So, once my weights are clear, next steps are anyways going to be simple jujube only. Yes, step 3, calculate total investment in bonds. Tell me how much money Rocky Bhai wants after 3 years? 10 lakh he wants. Today he will be investing present value of that, which is going to be how much? I will discount it at 10%. So, it is going to be 10 lakh divided by 1.1 to the power of 3. 10 lakh divided by 1.1 divided by 1.1 divided by 1.1. 10 lakh divided by 1.1 divided by 1.1 divided by 1.1. It is going to be 7.513 lakhs. Yes or no, everyone? That means individually how much I should invest? Bond A is there, B is there, C is there. Weight was 0.4, 0.4, 0.2. Total investment is going to be 7,51,315 rupees. You will distribute it in the ratio. Yes, if you want to calculate the number of bonds, that also you will be doing the calculation. Is this clear, everyone? Perfect. Now one very important thing, students, very important thing for us to remember. Note, if there is a change in YTM, tell me students, if my YTM will change, yes, whether my price will change, present value will change? Yes sir. If present value will change means whether duration will change? Yes sir, duration will change. Tell me, if duration will change means whether the weighted average duration will change? Yes boss. So if my YTM will change, my bond will no longer be immunized. That means sir, in order to immunize, what I'll have to do? I'll have to calculate the revised weights. So sometimes question will ask that way. Question will tell you, okay, existing situation, calculate the weights in order to immunize the portfolio. After that, they'll tell, suppose the YTM changes and becomes 11% and the revised duration of bonds is this much. Whether the bond is still, whether the portfolio is still immunized, we'll tell no. I will calculate the weighted average duration, it will not become equal. Yes, then in order to immunize, how much percentage has to be invested? I will again calculate the weights, as simple as that. Is this clear, everyone? Okay. So look at this complete summary chart on bond immunization. Quickly pay attention. Yes, how am I going to invest in a bond? Yes, we will invest in bond in such a way that the weighted average duration of bond will be equal to the investment duration. Yes, weighted average duration is weight of A, duration of A plus weight of B, duration of B, so on. Should be equal to the investment duration. Is this clear? What are the steps to be followed? Step number 1, calculate duration of each bond. Given in the question, bingo. Not given, we know how to calculate product divided by price. Step number 2, calculation of weights. How will I be investing? In such a way that, yes, weighted average duration, that is summation of weight into duration, should be equal to investment duration. Sir, how do I calculate weight? If I am having only 2 bonds, very simple. Weight of bond A is equal to X. Weight of bond B is equal to 1 minus X. But if I am having 3 bond means, always understand weight of one of the bond will be given in the question. Suppose weight of bond A is given in the question. Weight of the second bond, I will take it as X. Weight of the third bond, I will take it in such a way that the total weight becomes 1. Is this clear? This is where you have to be careful. Here you will sometimes commit a mistake. Using that, you will arrive at the value of X. Accordingly, all the weights will be clear. 2 steps over. Step number 3, calculate the total investment in bond. Total, how much I should invest? It is nothing but the present value of the liability. Okay. Step number 4, I will calculate investment in each of the bond. Total investment I got, I want individually distribute in the ratio of weights. Perfect. Question over. Any kind of question is over. Yes, note, if my YTM changes, accordingly my duration will change. Accordingly, bond will no longer be immunized. So I'll have to calculate the revised weights. Is this clear, everyone? Give me a confirmation, students. Yes, everyone. So if you refer to our notes, we would have given, yes, conceptual understanding of immunization also. Conceptually, what does it mean? Yes, I've written. It is not for exam, but okay. For reading purpose, if you have time, you can read it once so that you get a complete picture as to what exactly is happening. Okay, but not very important for us. Okay, now coming to unit number 2. Yes, the complete chapter of bonds. Okay, we have split it into majorly 4 units. Yes, unit number 1 was bond valuation and yield. In that bond pricing, we understood bond valuation, yield, current yield, YTM, yes, realized yield, we understood. Unit 2 was a concept of duration. In that duration, volatility, calculation of percentage change in market price. Convexity was there, bond immunization was there. Now comes, yes, unit number 3, special areas. In that 2 special pointers are there. First is the case of convertible bonds. Second is going to be the case of bond refunding or callable bonds. So first let us try understanding the concept of convertible bonds. Is this clear, everyone? Okay, beautiful concept. So many times it has been coming in the examination. Some 10-15 formulas are there. Yes, the problem with students is students don't exactly understand what is happening, what they have to be doing. Trust me, one of the simplest areas. We will do it without even having the need to touch a single formula. Okay, so what is the approach I am going to do? I am not getting into the basics. That what is a convertible bond? Okay, you have the option to convert. Either you can hold it as a debenture or convert into share. All those basics, GGB, we know. Okay, but proper game, let us try understanding. Okay, now it is also called as OCD, optionally convertible debentures. I will keep using the name OCD, optionally convertible debentures. So all calculation that will come in my convertible bond OCD, I have bifurcated into three main buckets. We will be doing the calculation also in these three main buckets only. Okay, sir, what all calculations are there? First calculation is a conversion related calculation. Second calculation is a straight value related calculation. Third calculation is going to be payback related calculation. Three calculation: conversion related calculation, straight value related calculation, payback period related calculation. Is this clear? Detailed notes as to what exactly each things are there is there. We will read that, don't worry, but let us try understanding with the help of a simple example. I will not tell, you will only tell me the formula. Are we ready, everyone? Yes, sir, we are ready, sir. So let us get into the game. Pay attention. Yes, example number 19. Yes, convertible bond. Are we ready? Yes, sir. Maja Limited issued a 8% convertible bond. We are Maja Limited, what we did? We issued a 8% convertible bond. So it is having an option, either you can continue it as a bond, or at the end of it, if you want, you can convert into shares. Okay, having a face value of 1000. Okay, great, boss. The market price of convertible bond is 1250. Tell me at what price I issued the bond. Assume you are the bond holder, I am the issuer, we are Maja Limited. I told, boss, one bond you want means 1250, you give. Okay, great. Other information is given below. Okay, number of shares per bond is 20. Number of shares per bond. Tell me, you have purchased one bond. If you want to convert it into shares, how many shares you can convert it into? That one bond can be converted into 20 shares. Is this clear, everyone? Okay. Current market price of the share. For one share, what is the market price? 55 rupees. You are required to calculate the following. First one, explain what is the conversion ratio. Based on that, other calculations are also there. One by one we'll do. Yes, first is conversion ratio. So what exactly on earth is conversion ratio? Look at this, students. It tells us how many shares an investor will get when they convert one bond into equity. Yes, you are the investor, you are having one bond. If you convert it into shares, how much share you will get in this case? Sir, here you told na, sir. Yes, one bond, if you convert into shares, how much shares you will be getting? 20 shares. That only is the conversion ratio. Yes or no, everyone? Okay. It answers the question, how many shares do I get in exchange of one bond? For one bond, how much shares I am getting? Okay. In the example, one bond can be converted into 20 shares. Hence, the conversion ratio is going to be 20. Is this clear, everyone? So, first point is clear. Yes, conversion ratio. Conversion ratio. What is conversion ratio telling? It is telling, boss, one bond, if I convert, yes, how many shares I am getting? Is this clear? Okay, perfect. Then comes the second calculation, which is going to be the conversion value of a bond. Yes, what is a conversion value of a bond? Conversion value of a bond is telling, if I convert my bond today, yes, how much value will be having? You are the investor, you are having a convertible bond today, you are having two options, either you can hold it as a share, bond, or you can convert into a share. Assume you decided today, boss, I don't want this bond, nonsense, let me convert into a share. Tell me, if you convert a bond into a share, how much share you will get? Sir, 20 share you will get, sir. Every share, what is the market price today? Current market price of the share is 55. Yes or no, everyone? Yes. How many shares you will be having if you convert 20 shares, sir? That means what will be your value if you convert your bond into shares today? Sir, 20 shares I will be getting. For every share it is 55. So it is going to be 55 into 20. Sir, my value will be 1100, sir. That means that is my conversion value. Yes or no, everyone? So look at this. Yes, it is the market value of the shares that a bondholder will receive if they convert the bond into equity right now. Today, right now, if I convert my bond into shares, how much value those shares will be having? If I convert my bond now, what is the total worth of shares I will be getting? Tell me, what was the number calculation I did? Yes, it was 55 per share into 20 shares. I got it as 1100 rupees. Sir, formula, sir. Creating formula is left hand's work. Tell me, what is 55 rupees? It is a market price per share. Yes, what is 20? It is the number of shares I will convert. Yes, what is that? That is nothing but conversion ratio. If I want, I can write it as into conversion. Yes or no? This is the formula. So look at these two terms we have discussed. Let me read it also here in our notes. Same things we have written. First one, conversion ratio. It is telling, yes, how many shares will I get in exchange of one bond? That is, for one bond, how much shares I am getting. Okay. Second is conversion value of a bond. One more name is there. It is called as stock value. Stock. When will I be getting stock? In the form of shares. Yes or no? So if I convert it into shares, what is going to be the value of the bond? Yes, it is the market value of the shares that bondholder will receive if they convert into equity right now. How do I get? It is the market price per share. For one share, how much? Into, like that, how many shares I am getting, which is nothing but my conversion ratio. Is this clear? Yes, sir, it is. Shall we take the discussion forward? Yes, sir, definitely, sir. I hope till now discussion is clear. Give me a confirmation, students. Yes, everyone. So from here, Maja is going to start. So are we ready for the Maja? Yes, sir. We are always ready for the Maja, sir. Okay. Then comes conversion premium. What is it, students? Conversion premium. Yes, it is telling how much premium I paid to buy the bond. Yes, it tells us how much extra we are paying to buy a convertible bond rather than buying the equivalent shares directly from the market. Assume you are the investor. Yes or no? Yes. You want to purchase shares only. Maja Limited is there. Yes, Maja Limited bond was there. Maja Limited share was there. You wanted to purchase share only. Two options were there for you. Yes, option number one is directly you could have gone to the share market, purchase the shares. Tell me, if you have gone for the share market and purchased the shares, how much you would have paid? Sir, 55 I would have paid for one share. Yes, like that. If I convert the bond, I am getting 20 shares. That means equivalent 1100 I would have incurred. Yes or no? This is nothing but my conversion value. Perfect. Or else there was one more option for you. Your investor think, yes, two options are there. You want share only. Two option was there. Either go directly to market, purchase share, or option number two, purchase optionally convertible debenture, OCD, convertible bond you purchase, then you convert into shares. Tell me, to purchase this optionally convertible debenture, how much you paid? You have paid 1250 rupees. Yes or no, everyone? Perfect. I guess the numbers are correct. 1250 you paid. That means, tell me, students. Yes, you wanted shares only. You wanted the shares, the equivalent shares. 20 shares you want. That is a conversion ratio. Either directly you could have gone and purchased from the equity market at the rate of 55,100 you would have paid, or you could have purchased this optionally convertible debenture. In that case, 1250 you paid. Now tell me, because you purchased optionally convertible debentures, how much extra amount you paid? How much premium you paid? Sir, directly if you have purchased means 1100 would have been, but I paid 1250 na sir. That means 150 extra I paid. Yes or no? So my conversion premium in rupees is going to be 150. Yes or no, everyone? Perfect. So how did I get 1250? I actually paid. Yes, if I was purchasing the shares directly, I would have paid 1100 only. That means 150 premium I paid. Yes or no, everyone? Perfect. Sir, formula, sir, formula. Don't worry da. Yes. Writing formula is the most simplest jujubes thing in the world. 1250. Actually, how much I paid? It is market price of the bond. If I would have purchased shares directly, how much I should have paid for equivalent number of shares? It is the conversion value. Is this clear? This gives me the conversion premium in terms of rupees. But for us in the examination, now whenever question asks us conversion premium, I will not just be writing in terms of rupees, I will also write in terms of percentage. Always remember, I will also write in terms of percentage. Okay, ratio of conversion premium. Yes, here we express conversion premium as a percentage of conversion value. Yes, very simple, students. Yes, my premium I paid, it is how much percentage of conversion value. Very simple formula. Yes, it is a conversion premium in terms of rupees divided by conversion value into 100. Tell me how much premium I paid, sir? 150 I paid. Conversion value is how much? 1100. So how much percent premium I paid? 150 divided by 1100 into 100. It is going to be 13.63%. Is this clear, everyone? So in the examination, even if question tells us only conversion premium, we will always calculate in the form of percentage. Is this clear? Sir, what is it, sir? Can you tell me? Yes, one mistake students do. Now, do I know the premium? Yes, sir, I know the premium. Tell me, if I purchase shares directly, yes, I'm just writing the numbers. If I purchase shares directly, 1100 only I have to pay. But because I purchased optionally convertible debenture, 1250 I paid. So how much premium I paid? How much premium I paid? Sir, 150 extra I paid. Now I want to calculate it as a percentage. Yes, percentage will be in relation to a base. Which base should I be taking? Sir, should I be taking it in respect of 1100 or should I be taking in respect of 1250? Will be a question. Even if now you are not getting the question, in the exam you will be getting a question. For that, one simple trick I am giving students. Premium. Premium means it is increasing. From where it will increase? It will always increase from the lower value. Yes or no, everyone? Simple example I am giving. Look at this, students. Yes, suppose I am telling I purchased a share. Share was at 100 rupees previously. Now share is at 120 rupees. Tell me how much it has increased. Sir, 20 rupees it has increased. From where it has increased? From where? From where? From 100. From the lower value. Premium is always from the lower value you are going up. Yes or no, everyone? From 100 it increase 20%. So tell me. Yes, share value was 1100. Yes, it became 1250. So extra I paid. How much extra I paid? 150 extra I paid. From where? From 1100. Yes or no? Ideally I should have paid 1100 only for that. But from there 150 extra I paid. That means how much percent? Comes to 13.6%. Is this clear, everyone? Yes, you will never confuse between, okay, yes, some places premium percentage is there. Premium percentage, whenever you are taking, base will always be the lower value. Discount percentage, downside risk you will see in future. Down I am coming. From where I will come down? From up. So it is always going to be the higher value. Is this clear, everyone? Perfect. So it is going to be, yes, conversion premium in terms of rupees divided by conversion value. So look at the, yes, formula, students. Conversion premium, different names. It is called as conversion premium ratio, premium over the conversion value, premium over the stock value. It is telling how much extra I am paying to buy the optionally convertible debentures rather than directly buying the shares. Conversion premium in terms of rupees. Yes, it is market price of the bond. Yes, actually how much I am paying to get the bond. Yes, minus if I would have purchased equivalent share, how much I should have paid. It is conversion value. Yes, conversion premium in terms of percentage. It is conversion premium. Yes, it is divided by conversion value into 100. Is this clear, everyone? Perfect. Yes, next calculation is going to be conversion premium per share. Simplest thing in the world. Conversion premium per share. For one share, how much is the conversion premium? Tell me, students, on a total basis, how much extra I paid? Sir, I paid 150 extra conversion premium. It is to get how many extra shares? Sir, it is to get 20 extra shares. So for one share, how much it is? It is going to be 150 extra I paid, sir. It is for 20 extra shares. So it comes to 7.5 per share. Yes or no? If I want to create a formula, it is a conversion premium in total. Yes, divided by 20 shares. It is nothing but the conversion ratio. Is this clear, everyone? Perfect. That is my conversion premium per share. Very simple. It is a conversion premium. How much extra I paid divided by, it is for how many shares? Gives me for one share how much extra I am paying. Is this clear, everyone? Okay, perfect. Now the final thing I am having is conversion parity price. Question asks me calculate conversion parity price. Yes, what is conversion parity price? In simple terms, if I have to tell, it is the effective price of OCD on a per share basis. Tell me, you as an investor, you purchased OCD, optionally convertible debenture. For that, how much you paid? Sir, we paid 1250, sir. If you convert that into shares today, how much shares you will be getting? 20 shares you will be getting. So tell me, from your perspective, how much you paid? I paid 1250. This 1250 I paid to get how many shares? To get 20 shares. That means for one share, how much I paid? It is 1250 divided by 20. 1250 divided by 20 is going to be 62.5. Yes or no? Yes. So look at this. In simple terms, it is the price of OCD on per share basis. For OCD, how much I paid? 1250 I paid. Yes, it is a market price of bonds, optionally convertible debenture. Yes, that 1250, if you convert today, it is for how many shares? It is for 20 shares divided by conversion ratio. That gives me your conversion parity price. Is this clear, everyone? There are other interpretations as well. It is a parity price. That means right now share is trading at 55 rupees. If my share was trading at 62.5, it would have been at parity. That means I would not have incurred neither loss nor profit. All those interpretations not needed for me. Is this clear, everyone? Give me a confirmation. All the calculations also we did. and without touching formula also we wrote. Is this clear everyone? But very important thing is we should do the calculation in the same order. Yes, there is a reason why I have bifurcated them into buckets. So whenever you get a question on convertible bonds, first you will give a heading, conversion related calculation. In that first you will write down conversion ratio. Yes, one bond if I convert, how many shares I will get. Second, whether question asks or not, you will do compulsorily. Second, conversion value. If I convert into shares today, how much is going to be the value? It is market price per share into number of shares, which is the conversion ratio. Third is going to be the conversion premium. How much extra I paid to get the OCD, which is going to be market price of bond minus conversion value. Fourth, I will be doing is conversion, yes, premium in terms of percentage. It is conversion premium from where it is increasing, from the lower value divided by conversion value. Is this clear? Yes. Fifth one is conversion premium per share. If they ask you on per share basis, total conversion premium is there, divided by number of shares, that is divided by conversion ratio. Okay. Sixth one is conversion parity price. That is, it is the effective per share price of OCD. For OCD total, how much I paid? It is for how many share? Gives me the per share price. Is this clear? Give me a confirmation, students. Now, obviously, once you are listening to this, okay, you might feel a bit confused as to, okay, why exactly these things are happening. You would have understood. Okay, but you solve one question, two question, three question. In this framework, trust me, you will never commit a mistake. Okay, yes, whatever calculations are there, I will show you guys a comprehensive question also, where everything is mixed, but I will do it in these three buckets. First is conversion related calculation. First, I will write down conversion ratio. Then I will write down conversion value. Then I will write down conversion premium ratio. Then I will write down, okay, conversion parity price. Is this clear? Give me a confirmation. Yes, everyone. So shall we continue our discussion? Yes, sir. Let us continue, sir. Any other work we are having? No, sir. This only we have come here to learn. Let us continue. Okay, let us go ahead to the next set of discussion. Okay. Next is going to be straight value related discussion. Straight value of the bond and its related calculation. Understand. Second segment. Okay. One more example I have created. Example number 20. Mandus Limited. Okay. Issued a convertible bond. Sir, what is Mandus, sir? Mandus is a Malayalam term. It means intelligent person. You are a Mandus? Intelligent person. Ah, sir. Yes, you are Mandus, sir. Okay. Now, it issued a convertible bond that has the following terms. What all is given? Face value is 1000 rupees. Okay, great. Coupon is 6% per annum. Okay, amazing. Maturity is 3 years. Okay, great, boss. Market price of convertible bond. Yes, you are the investor. You purchased the convertible bond. How much you are paying? 1150 you are paying. Okay, great, boss. Market required return on a similar non-convertible bond. Yes, you are now having convertible bond, OCD, optionally convertible bond. If you had purchased a similar non-convertible bond, how much return you would have expected? 8% only was sufficient. Yes, calculate. First one is straight value of bond. Yes, what exactly is a straight value of bond? It is the value of bond if it was a regular bond. Straight value, straight. Tell me, students, yes, OCD, optionally convertible debenture, is it straight? No, it is not straight. Sir, what you are talking, sir? Da. Yes. Either it is equity or it is debt. What is it? It is a mix of two. Yes or no? Either it is a share or it is bond. What is it? It is a mix of two. You are telling, boss, instead of optionally convertible debenture, if it was a straight bond, that is a regular bond, normal bond without any extra feature, how much I would have paid for that? Yes or no? Tell me this bond, how much cash flow it is giving. If I invest in a OCD, how much you are getting? Sir, 1000 rupees is a face value, 6% interest I am getting for 3 years. So first year you are getting 60. Second year you are getting 60, third year also you are getting 60. With that third year and redemption price you are getting 1000. Yes or no, everyone? Tell me, if it was a normal bond, there is nothing special is there, just a normal plain vanilla bond, non-convertible bond, how much you would have paid? Yes, normal bond means how much return you are expecting? 8% only you are expecting. That means how much you would have paid? Tell me. Year, cash flow, present value, factor, present value. Yes, year 1 to 3, 60 you are getting. Third year again 1000 you are getting. Yes, what is the required rate? 8%. So 1 divided by 1.08, 1, 2, 3 is 0.794 and grand total 2.577. 60 into 2.577, 1000 into 0.794. Yes, 948 rupees or 949 rupees. Yes or no, everyone? Yes. So straight value of the bond is 949 rupees. That means if it was a normal bond, how much I would have paid? 949 only I would have paid. Yes or no, everyone? Perfect. So look at this. straight value of the bond. It is also called as floor value. Yes, it is the value of the bond if it was a regular bond, that is a normal non-convertible bond. How do I calculate value of bond? Sir, we know, sir, value of bond is present value of all future cash flow. Yes, discount rate, required rate. Non-convertible bond means, yes, market rate of non-convertible bond I would have taken. So it is present value of future cash flow discounted at YTM of regular bond. Is this clear, everyone? Perfect. Now tell me, students, tell me. Second case is premium over the straight value. You are the investor. You want bond only. What all options you are having? Two options. Either option number one, normal non-convertible bond you would have purchased. To purchase a non-convertible bond, how much you have to pay? Yes, just 949 would have been sufficient. Yes or no, everyone? We have calculated straight value of bond 949. Or else option number two, you can go and buy convertible bond also, optionally convertible bond. For optionally convertible bond, how much you are paying? 1150 you are paying. That means, tell me, students, how much premium you are paying, how much extra you are paying. Yes, you want bond only as an investor. Assume I am the investor. I am telling I want bond only, boss. Two options are there. Either directly purchase non-convertible bond, 950 if you pay, same feature you will get. Or purchase convertible bond. You have to pay how much? 1150. That means, tell me how much premium you are paying to buy the convertible bond. 200 rupees extra you are paying. Yes or no, everyone? 200 or 201. Let me keep it as 950 only, round figure. So that, okay, numbers become simpler for me. So tell me how much premium I am paying over the straight value. Yes, I paid 1150. But if it was just a non-convertible bond, 950 was sufficient. That means how much extra I paid? 200 extra I paid. Sir, formula, sir. Chill, I will write down, don't worry. Yes, it is market price of bond minus the straight value. It is a premium over the straight value. Yes or no, everyone? Perfect. Sir, I want to calculate in terms of percent, sir. Dude, very simple. Tell me, straight value is 950 only, but I paid how much? 1150. How much extra I paid? 200 extra I paid. From where? Premium. From where extra I paid? From 950 extra I paid. So it is going to be 200 upon 950. Yes or no, everyone? 200 divided by 950. It is coming to 21.05%. Sir, formula, sir, simple. Yes, it is a premium. From where I am paying premium? From the lower value, which is divided by straight value. Premium over straight value into 100. Is this clear, everyone? Give me a confirmation, students. Look at this, everyone. I have written down premium over straight value, how much extra I am paying. In terms of rupees, I want means it is market price of the bond minus straight value. In terms of percentage means it is premium divided by straight value into 100. Is this clear, everyone? Okay, perfect. Now comes the next thing, beautiful point, which is percentage of downside risk. Beautiful Maja point. Okay, crazy. So are we ready, everyone? Yes, sir, we are ready. Yes, downside risks tells us how much will be the price of a convertible bond. Yes, how much the price of a convertible bond can fall if the share price becomes 0. Now understand, students, how much I paid for the convertible bond. You are the bond holder. Yes, you purchased optionally convertible bond. For that, how much you paid? Sir, 1150 I paid, sir. Great. Yes, why you paid 1150? Sir, two features are there, sir. One, it is having a feature of a bond. Apart from that, it is having that option for me to convert into share also. Tell me, if you are directly just purchase a bond, how much only you would have paid? 950 only you would have paid. Yes or no? Yes, just a non-convertible debenture is available in the market at 950. You would have paid 950 only. Then why on earth did you pay 1150? Because you felt that, okay, there is a chance. If your share price goes up, I will convert it. So for that conversion option, you have paid 200 rupees extra. Yes or no? Inherent value of the conversion option. But tell me, is this secure? Is it sure that, okay, yes, your share price will go up, you will convert, you will get that extra money, growth in the future, all those things. Is it sure? No, sir, risk is there, sir. Yes, what if your company doesn't perform that way? Yes, your share price fall down. Yes, tell me, if your share price will fall down means, yes, will you try to convert your bond into shares? No, sir, I will not convert. Assume your company is not performing good, downside risk. Your company is not performing good, downside risk. Okay, what is happening? Company is not performing good, you are not converting into shares. Yes, tell me, how much will the value of bond still be? Even if I am not converting into shares, my value of bond will still be 950 rupees. Yes or no? Why? Because bond feature is still there now. Yes or no? So in that case, how much maximum my bond value will fall to? Yes, tell me right now how much I paid for the bond. Sir, I paid for the bond 1150. Yes, it is telling how much maximum it will fall to. I am telling boss, assume company is not performing good. Share value, yes, what I thought, okay, it will increase, all those things didn't happen. But boss, bond is there. Fixed return I will be getting. So straight value in any case I would have paid for the bond. How much value still will be there? 950 will still be there. That means tell me how much the value reduced, how much loss happened to me. Sir, 200 rupees loss happened to me. Yes or no, everyone? That is my downside risk. If I want to calculate it in terms of percentage, tell me how much value has reduced. 200. From where? From where? I am falling always from the higher place. I am rising always from the lower place. Premium is always from the lower value. Discount, fall, downside risk is always from the higher value. It is divided by 1150 into 100. So it is 200 divided by 1150 into 100. It is going to be 17.39 percentage. Is this clear, everyone? Yes. So let me write down. Pay attention. Yes. Firstly, downside risk. Where I am currently standing, market price of bond. Maximum how much it will fall and become. It may come and fall and fall up to straight value. Straight value of bond. This is my downside risk in terms of rupees. I want in terms of percentage. It is nothing but my downside risk divided by from where I am falling, right now I am at the market price, from there I am falling, market price of the bond into 100. Is this clear, everyone? Perfect. Give me a confirmation. So look at this, downside risk in terms of rupees, it is market price of the bond minus straight value. Yes. In terms of percentage, it is downside risk in terms of rupees divided by market price into 100. Give me a confirmation. Till here things are fine. So yes, convertible bond calculation I have done in two buckets till now. First is conversion related calculation. What is a conversion ratio? What is a conversion value? Yes, what is going to be conversion premium in terms of rupees, in terms of ratio? Then I told conversion parity price. Sometimes they'll ask conversion premium per share. This is one bucket. Yes, I will give the heading separately. All these calculation taka together I will do. Next is a straight value related calculation. In that I will calculate straight value of bond. Assuming it is non-convertible, what is the value I will be paying? Premium over straight value, how much extra I paid in terms of percentage. Downside risk percentage I will be calculating. Is this clear? Give me a confirmation. Yes, everyone. Now we are having the final bit. Okay, the entire calculation I have split into three buckets. The third bucket, the final bucket, it is the payback period. The premium payback period. Beautiful concept. Pay attention, students. Favorable income differential you can tell, or you can call it as payback period. Period and its related calculation. Okay. Favorable income differential per share. Yes. What is it telling? It tells us how much extra income the investor is earning by holding a convertible bond instead of buying shares directly in the market. Okay. Yes, normally interest on bond is going to be higher than the equivalent dividend if you were to buy the shares directly. Let me come to the example. Example number 21. Crazy Limited. What is the name of Crazy Limited? Okay, issued a convertible bond. Face value is 1000, coupon rate is 8%. Conversion ratio is 20. That means if I convert to shares, I will be getting 20 shares. Current market price of share is 55. Dividend per share is 2 rupees. Market price of convertible bond is 1200 rupees. Okay, fine. Now, you are required to calculate the favorable income differential per share. So first one, let me try calculating favorable income differential in terms of total. Now assume two options are there. Yes, what is favorable income differential telling? It is telling how much extra income I am getting by purchasing an OCD, that is optionally convertible debenture, instead of directly buying the shares. Now tell me, students, assume I purchased one OCD, optionally convertible debenture. Yearly income I will be getting. Tell me, students, convertible bond, what is the income I will be getting? Right now it is in the nature of bond. What I will be getting? Sir, interest I will be getting. Tell me how much is the face value of bond? 1000. How much is the interest? 8% interest I will be getting. That means how much interest I will be getting? If I buy OCD, I will get interest of 80 rupees per annum. Yes or no, everyone? Perfect. On the other hand, I am telling boss, I don't want OCD. Just a normal share I will buy now. Why chumma I will get into all this nonsense? Okay. Similar, equivalent, how much shares I could have purchased? 20 shares I could have purchased. Yes or no? Conversion ratio is 20. Yes, tell me, every share would have paid me how much dividend? 2 rupees. That means on 20 shares, how much dividend I would have got? 40 rupees dividend I would have got. Yes or no, everyone? If I buy equivalent shares, yes, I would have received equivalent dividend. That is 20 shares into 2 rupees, 40 rupees. So tell me how much extra income I got. How much extra income I got by purchasing OCD rather than directly purchasing shares. 40 rupees extra income I got. Yes or no, everyone? That is the favorable income differential. Is this clear, everyone? Perfect. Now it is going into a long analysis of should I buy shares directly or should I buy a bond? Now assume you are the investor. You want ultimately share only. But for that, two options are available. How to purchase share? Either go to the market. Suppose 20 shares you want to buy. Either go to the market, purchase 20 shares. What income you will be getting? Every year dividend you will be getting 2 rupees. So yearly 2 into 20, 40 rupees income you will have got. Or else, there is one more option, boss. You go purchase optionally convertible debenture, hold it for a period. At the end of it, you convert into shares. Sir, why on earth will I be doing it, sir? Wait. If you purchase a optionally convertible debenture, you can convert into 20 shares. Yes, boss. Anytime I can do, anytime. But yearly, how much income you are getting? Sir, 1000 rupees face value is there, sir. Every year it is giving me 8%. So 1000 into 8%, 80 rupees income I will get, sir. That means tell me how much extra income you are getting here. Every year 40 rupees in extra income you are getting. Sir, crazy, sir. Maja, sir. Magic, sir. That is the thing. But wait, if you are getting extra money means you would have paid some extra also. Okay, that is what the next calculation we are going to do. Is this clear? Here, favorable income differential. How much extra income I am getting every year by buying an optionally convertible debenture rather than directly buying the equivalent shares. Is this clear, everyone? Okay. So favorable income differential on total. Yes, income from OCD. Yes, it was 80 rupees. Income from equivalent shares. It was 20 into 2. It was 40. That means how much extra income I got? 40. Now, they will normally be asking calculate favorable income differential per share. It is on total basis. I want per share. Tell me total how much extra income I earn? 40. It is for how many shares, sir? It is for 20 shares divided by 20 shares. That means per share how much extra I am getting? 2 rupee per share. Simple. Jujib. Yes, it is nothing but favorable income differential divided by number of shares, which is nothing but my conversion ratio. Is this clear, everyone? So look at the formulas. Yes, favorable income differential. Yes, how do I get extra income? Where I will be getting higher income? From bond. It is interest on bond minus dividend on the equivalent shares. If I want per share, it is favorable income differential divided by number of shares, which is divided by conversion ratio. Is this clear? Till here, okay. Okay, sir. But understand, everything comes with a cost. You are getting extra income means you would have paid some extra cost. Okay, let me try seeing how much extra cost I have paid. Yes, can I calculate the conversion value as well as conversion premium in terms of rupees? Tell me, if instead of buying my convertible bond directly shares only I would have purchased, means how much I had to pay? Tell me, students, how much shares I would have got? 20 shares. For every share, how much I had to pay? 55. That means how much I had to pay? 55 into 20. 1100 only I had to pay. Yes or no, everyone? Perfect. Yes, calculation already done in basics. Yes, not going into much explanation again. That means tell me how much extra you paid. Tell me, if you purchased 20 equivalent shares, yes, you had to pay 1100 only, but you purchased the convertible bond. For that, how much you paid? You paid 1200. That means how much extra you paid, boss? 100 rupees extra you paid. Yes or no, everyone? Is this clear? Not explaining this again, just 5 minutes back. Conversion value, conversion premium in rupees, in percentage, all those things I have told. Is this clear? Okay. Yes, so now comes my premium payback period. Yes, understand the complete, yes, analysis is coming. I am an investor. Yes, I want shares only. But I have two options to get shares. Option number one, directly I go to the market. I buy 20 shares. Okay. Yes, how much I had to pay? 1100 I had to pay. Or option number two, I purchase an optionally convertible debenture. How much I am paying? 1200 I am paying. Happy or sad? Sad. Why? Extra I am paying. How much extra money I have paid? Extra money I have paid. Yes, extra money paid is 100 rupees. Yes or no, everyone? Yes, that is a conversion premium, that much extra we paid. But wait, boss, if you have paid 100 rupees extra, there is a benefit, secret benefit. Sir, what is the secret benefit, sir? If you purchase shares directly, what I will be getting? Dividend I will be getting. Yes, 20 shares I am having into 2 rupees dividend. How much only income I would have got? 40 rupees. But because I purchased bond, what I am getting? Interest I am getting. 1000 into 8%, 80 rupees interest I am getting. That means tell me how much extra income I am getting. I am getting every year extra income of 40. That is from bond I am getting 80 rupees per annum. If I purchase shares, 40 only I would have got. So that means the extra income is equal to 40 rupees per annum. Extra cost, how much extra cost I have paid, is going to be 100 rupees. That means tell me premium payback period. Yes, premium, how much premium I paid? 100 rupees. To recover that, how much years are needed? Yes, tell me students, I have paid 100 rupees extra. In first year I recovered 40, in second year I recovered 40, third year again I recovered 40, but I want to recover total 100 only. Yes, 2.5 years I would have recovered my premium. Yes or no? Simple cross multiplication. In 1 year I am getting 40 rupees extra income. I want total 100 rupees extra income so that I can recover that extra cost in how many years? It is going to be 100 divided by 40, 2.5 years. Okay, did I touch any formula? Nowhere. Yes or no? If you want to write it, yes, tell me what is 100? It is the extra cost, which is nothing but the conversion premium. Yes, divided by 40, what is it? It is the favorable income differential, extra income. So look at the formula, everyone. Yes, it is going to be conversion premium. Sorry. Yes, how much extra amount I paid divided by every year how much extra income I am getting. That tells me in how much years I will recover the extra cost I have paid. Is this clear, everyone? Yes or no? Give me a confirmation, students. Okay. Yes, Maja adjustments for us. Yes, first secret tip. No one will tell you this. But it is the basics. Every time I am calculating a ratio, should I take this value or this value? I will be having a doubt. Simple thing. Premium, from where increase will be there? From the lower value. I will always take lower value. Yes or no? Yes, conversion ratio. Yes, conversion, premium over conversion value. From conversion value I will take. Yes or no? Premium over straight value. Straight value I will be taking. Downside risk, I am falling. From where I will fall? From higher value. Yes, percentage downside risk. From higher value I will be taking the ratio. Is this clear? That is point number 1. Point number 2, sometimes question will ask me decision making. I am having optionally convertible debenture. Should I convert into share or should I hold it as bond only? Yes, look at this, everyone. Yes, investor is having two options. Either he can continue to hold it as bonds. If he is holding it as bonds, he is only having bond. What is the benefit he will be getting? Straight value of bond. Or he can convert it into shares. Yes, if he converts into shares, how much benefit he will be getting? How much value he will be getting? Conversion value he will be getting. Now, when will investor convert into shares? Yes, investor will exercise conversion option only if the conversion value is higher than the straight value. Is this clear? Yes, situation number 1. Straight value, if he is holding as bond, how much benefit he is having? Conversion value, if he convert to shares, how much benefit he is having? Yes, first case, look at this, students. If he is holding as bond, 1000 rupee benefit is there. If he converts to shares, 950 only benefit will be there. Tell me, as a rational logical person, will you convert into shares? No sir, will not convert. Who will convert? Second case, if I hold it as bond, benefit is 1000 only, but if I convert to shares, I will be getting 1050. Will I convert? Yes boss, I will convert. Is this clear? So I will convert when the conversion value is greater than the straight value of the bond. Is this clear? With this, the entire concept is over. Now I have kept one more example for you wherein everything is there. You guys can try it by yourselves. Is this clear, everyone? Same thing, data, everything is available. Yes, all calculations have to be done. Some 10 calculations have to be done. Yes, convertible bond, whenever you are doing calculation, do it in 3 buckets. First is conversion related calculation. Second is straight value related calculation. Third is payback related calculation. Is this clear? And one more question I have kept, which is going to be on missing figure reverse calculation. This was taken directly from an MTP. You guys can try this as well. All these example questions I have kept. Is this clear, everyone? Okay. Now question number 22. Quickly I will show it to you guys. Framework. All calculations are there. Whenever I am doing calculation, I will do it in 3 buckets. First is going to be conversion related calculation. Second is straight value related calculation. Third is payback period related calculation. I will give the heading that way and accordingly I will be doing. First is conversion ratio. I will read the question. Yes, Falcon Limited convertible bond, face value is 1000, 8%, 3 years maturity, market rate of non-convertible is 9%, conversion ratio is 20. That is, one bond if I convert 20 shares I will be getting. Second thing is going to be conversion value. Whether question asks or not, in this order only I will keep doing, no tension only. Tell me, yes, one share is trading at what price? 45. How many shares I will be getting? 20. So 45 into 20 is going to be how much? 900. Third one is conversion premium in terms of rupees. Tell me, to buy OCD, optionally convertible bond, how much I paid? 1200. But if I had purchased shares directly, how much only I had to pay? Yes, 900 only. That means how much extra I paid? 300. Fourth one is conversion premium in terms of percentage. 300 extra I paid. From where? From 900. Yes or no? 900, 1200. If I purchase share 900 only, but I paid 1200. 300 extra I paid from 900 into 100. It is going to be 33.33%. If it asks you, yes, conversion premium per share. Yes, tell me how much extra I paid? 300. Yes, it is totally for how many shares? 20 shares. So it is going to be 300 by 20. I guess it is 15. Yeah. Yes, next is conversion parity price. Yes, if a question on convertible bond comes, it is halwa, bonus for you. You should aram say dance and do this question. Okay. Yes, tell me how much you paid for the bond. Boss, I paid 1200 for the bond. Yes, by paying 1200, how much? Yes, if I convert, how much shares I will be getting? 20. That means effectively how much it is? 1200 divided by 20, 60 rupees. Okay. First bucket, all calculations I have done. Did I touch any formula? Nothing I did. But you follow this order. Don't jump from this order. Whether it is asked or not, you do it. Is this clear, everyone? Next is straight value related calculation. So what I will be calculating? Yes, first one I will calculate straight value. Straight value is what? Yes, if it was non-convertible bond, okay, how much I would have paid? Tell me what all my bond is giving me. Yes, 3 years is there. 1, 2, 3, 8%. 80, 80, 80 it is paying me. At the end of it, 1000 it is giving me. Yes, if it was non-convertible means 9% I would have discounted it. So year 1 to 3, 80, year 3, 1000, PVF at the rate of 9%, present value. 1 divided by 1.09, 1, 2, 3, 0.772, grand total 2.531, 80 into 2.531, 1000 into 0.772, grand total makes it 974.48. Let me write it as 975. So straight value of the bond is going to be 975. Yes, second thing is going to be premium over straight value. Yes, tell me straight value is going to be how much? 975. But I paid how much? 1200. So how much extra I paid in terms of rupees? Yes, 975 minus 1200, 225 extra I paid. Yes, in terms of percentage if you want, 225 extra I paid. From where? From lower value, divided by 975. 23.07%. Yes, next thing that needs to be calculated is percentage of downside risk. Tell me how much you paid. Sir, I paid 1200, sir. Assume, there is no value for the share only. Yes, its value will reduce, and it will reduce and reach where? It will reach the straight value, 975. So how much it will reduce? 225 it will reduce. From where it will reduce? 1200 it will reduce. So how much percentage? 225 divided by 1200. It is 18.75%. Is this clear? Now understand, yes, here when I was calculating premium, I was going from 975 to 1200. When I am calculating downside risk, I am coming back from 1200 to 975. That way also you can remember. Okay, you are just doing ulta of the, yes, premium over straight value. Okay, fine. Next comes payback period. Here first I have to calculate favorable income differential. Tell me, yes, if I am purchasing, yes, one bond, if I convert, how many shares I will be getting? 20 shares. Now income I am getting. Tell me from one bond, how much yearly interest I am getting? Sir, I guess I am getting 8% interest, that is 80 rupees. This is from bond. If I had purchased similar shares, how much dividend I would have received? 20 shares I would have got. Every share would have paid me 2 rupees. 2 into 20 would have given me 40 rupees. That means how much extra favorable income differential? How much extra income I am getting? 40 rupees. It is my favorable income differential. If I want my favorable income differential per share, 40 extra I am getting for 20 shares. That means it is going to be 2 rupees per share. Is this clear? Yes. If question asks you premium payback period, yes, it is going to be extra cost, which is premium divided by extra income per annum. Tell me, to buy convertible bond, how much extra amount you paid conversion premium? 300 rupees extra we paid, boss. Shares directly 900 I would have got, but I paid 1200. 300 extra I paid. Tell me every year how much I am recovering? 40 I am recovering. That means to recover 300, how much years it will take? 7.5 years. Thakka, we did all the calculation, obviously not in a structured way. Yes, but I have given you those main buckets in which you are going to do the calculation. Is this clear, everyone? Give me a confirmation, students. Maja is coming. Yes, everyone. Now pay attention, pay attention, pay attention. Now, yes, with this we'll have to end the session. Yes. Almost 90% of the chapter security valuation is over. The main crux is over. Now, what all is pending? Let me quickly tell that to you guys. First, there is a concept of bond refunding which is pending. You can call it as bond refunding or callable bonds. That is, you issue a bond in the market, after that interest rates are falling. So, you are cancelling that bonds and issuing a new bond. In that case, two types of questions are there for you. Okay, simple steps you will have to be following, not getting into the logic. Step 1, you will calculate the initial cash outflow. Step 2, you will be calculating annual cost in the existing bonds. Step 3, you will calculate annual cost in new bond. Yes, you take the difference. Existing bond, how much was the cost? New cost, how much was the bond? You will be getting the savings in cost. Yes, then step 5, you will be doing the benefit analysis, wherein you will tell present value of cash inflow. That is, every year you are getting a benefit, saving in cost, take a present value of that minus present value of cash outflow, which is nothing but your initial cash outflow. You will get the net benefit. Accordingly, you will be giving a comment on bond refunding. Is this clear? That is one thing. Next thing you are having is money market instruments. Money market instruments are the short-term securities which are basically issuing for a period less than 1 year, basically for 3 months, etc. 91 days, T-bills, yes, all those things will be there. Yes, in that case, calculation is again very simple. The only thing you'll have to remember is the simple return on investment concept. It is return divided by investment. This, if you know, yes, you are just playing along with this. That's all, nothing else you are doing. And the basic, that dirty power thing, calculation of effective rate of interest, basically you are this thing, present value into 1 plus r to the power of n is equal to future value. Okay, here to the power of n will not be there because basically it is for a period less than 1 year. Now, what all can be there? Yes, either question will ask you calculate how much I should invest today. Yes, T-bill is there. Yes, 3 months later, yes, I will be redeeming it at 1 lakh rupees. Rate of interest is 10% per annum. I will calculate it for the effective period. I will calculate present value. One type of question. Second type of question is rate of interest is missing. Today I purchased at 97,500. After 3 months it becomes 1 lakh. Tell me effective rate of interest. That I can calculate. Yes, one more question is there on reverse repo rates. Is this clear? These 3 types of questions are there. Okay, I have quickly glanced and told it to you guys so that you guys do not miss out on this. And then some small miscellaneous jujube pointers are there. Okay, but these 2 things are again important. I don't want you guys to miss out this. Okay, with this we have finished the chapter revision security valuation, my dear students. From the examination perspective, minimum 15 marks weightage will be there. Equity plus bond together. Yes, we have taken roughly around 6 hours. Yes, not the most logical explanation. Yes, because I know how beautiful, how much more beautiful this chapter can be made. But in the lowest possible time, considering the fact that your exams are close, in the lowest possible time, I have tried doing this. Now, I will upload one more revision video on YouTube, which is going to be a rocket revision of security valuation. In less than 30 minutes, the entire chapter, steps, steps I'll keep on telling. Okay, that will make sense only if you have listened to this once. Is this clear, everyone? Yes, all the resources, that is the notes, yes, the exam workbook as well as the summary charts, I will be uploading on our Telegram group, Think with Tabish. So you can access it from there. You can download, do whatever you want to do. It's all for you guys. And if you have loved the session, means yes, people are watching it on YouTube. You're our only source. So first, if you only watch yourself, only you get the knowledge, you get the benefit, no use that. Share it to all your friends. Second, if you have loved, if this has added value to you, means I would really appreciate if you guys put a comment. It's telling that it is adding value, so that yes, YouTube accordingly recommends to other people, new people who come look at the video, they see the comments, they'll understand that okay boss, it is adding value, accordingly they'll decide to watch the video. Okay, and students who want to purchase the recorded classes for CA Final AFM or CMA Final SFM, you can visit our website www.thinkwithtabish.com and accordingly purchase the classes. Okay, that's all for this video. Yes, a quick mind map only I'm giving, not a revision. 30 minutes rocket revision, will be doing it separately. Yes, security valuation, part A equity valuation, part B bond valuation. In equity valuation, first main thing is a valuation of equity shares. First, based on dividend I'll be valuing, or other methods wherein earnings based valuation was there, next PE ratio was there, yield based valuation was there. Then in equity valuation, special pointers were there, that is in case of bonus what to do, in case of buyback what to do, in case of right shares what to do. Then we came to bond. Yes, in bond majorly what we have discussed here is in three buckets. First one was that concept of bond valuation and yield. Bond valuation, present value of future cash flows. Yield, current yield was there, YTM was there, realized yield was there. Next was the concept of duration. Duration we had seen, volatility we had seen, based on that percentage change in price, bond immunization we had seen. Next one was convertible bonds.